It is 9 a.m. on Monday, August 9th. This is Yahoo Finance Live. I'm Julie Hyman. And let's give you a little tour of the markets here this morning as we get underway. Futures showing a mixed picture after some records once again for the major averages last week. This morning, Dow and S&P futures pulling back slightly. NASDAQ futures up very slightly. But we are seeing more action in other asset classes this morning, most notably in some of the commodities, where we're seeing a lot of concern being expressed about the new spread and intensification of the spread of the Delta variant of coronavirus. In particular, a lot of focus on China, which is a big importer of oil, of course. And data published over the weekend showed that China imported less crude per day in July than in June. And some analysts are saying that's one of the things that is weighing on prices. You see the 5-day price action down 3% for oil prices. We've seen some tumult in the gold market this morning as well. On the flip side, one of the things we continue to watch is what has been happening in Bitcoin. There over the weekend, we saw a big increase in prices, up to $45,000. I think we have the Bitcoin price as well, hopefully, that we can take a look at here this morning. But I guess we've got a little bit of freeze in the works here this morning. So I'm going to move then, since that is not, and come back over here to the desk. Brian Saucy and Miles Odlin here with me.
Take our word for it that Bitcoin was at 45,000.
Doing great.
Exactly.
Imagine a chart of Bitcoin at 45,000.
Exactly. If we can picture it in our minds, we know that that is what is going on. But, you know, it is interesting, you guys, because we continue to see this pattern where stocks sort of continue to mildly push higher, even though they're mixed this morning. Mm-hmm. And really the action is happening elsewhere.
Stocks go up.
Stocks go up. Other stuff doesn't necessarily go up, but stocks go up.
Very clean story.
Yeah, S&P 500, 44th record high on Friday. But for me, guys, this week, earnings season continues to rage on. And there are a lot of fun company-specific stories on tap. AMC, of course, is a name I'm watching. But also some of these SPAC companies are now going to start reporting results. Recent SPACs, SoFi, out earnings. How has it been doing as a public company? Lordstown has been a full-on disaster. How are they doing? Do they have enough cash on their balance sheet to survive into year end? 23andMe reports earnings on Friday. That is a company that has been losing money. Can they suggest that they will turn profitable sometime in our lifetime?
You know, and this is a big week for the so-called memes, too. You mentioned some of them. AMC reports out to close today. Coinbase, which is meme-ish. We'll call it a meme. Okay, it's out tomorrow. 23andMe, I mean, I think, you know, SPACs and memes are sort of separate. Sometimes they interconnect. Mm-hmm. Palantir reports this week also. So a lot of these sort of buzzy names.
Bumble too.
Clover.
Last week, Match.com, they disappointed. How did Bumble do? Is it Bumble taking share from Match? Again, another interesting story. Investors have to pay attention.
We got Hims on there as well. That was another SPAC.
Hims and Hers, yeah. They'll be on later in the week with us.
Big week for chicken. We had chicken deal. Tyson out with its results.
Wendy's too. Big proponent of chicken sandwiches.
And then, I mean, there is Disney on there. Real company.
Disney, you know.
Real company on there amid all the other nonsense. I mean, what has continued to be the story through earnings season is not only are stocks moving significantly more than the market, but we continue to see the market not rewarding companies that come out and beat on the top and the bottom line. And yet, as you noted, Julie, the market continues itself to grind higher, and that's that rotation within the market, leadership moving around different groups. Last week, we actually saw a couple of very nice days for the cyclicals, with rates moving higher on the back of some of those comments that we heard from Jay Powell 2 weeks ago, and then we get that jobs report, and now we're thinking about maybe an easier Fed here, and an economy that is holding in a little bit better than expected, and all of a sudden you see financials taking the lead for a few days. Of course, that's going to be under pressure today with energy under pressure, with oil prices down. But it continues to be the case that the market, the S&P 500 level itself, tells a dramatically different story than what the average constituent tells you, which is a different condition than the market was in, let's call it January, February, when pretty much everything except Apple went up, right?
What's interesting about Disney, by the way, is that it sort of straddles a lot of those different parts of the rotation, right? On the one hand, of course, it has the streaming business that is paying a lot of attention to these days, which benefits from people staying at home more. On the other hand, it has the parks, which suffered through the pandemic, and I imagine they'll be getting some questions on the call about the Delta variant and what that's going to mean for that part of the business, even if it maybe benefits the streaming side of the business. And then, of course, I imagine Disney's going to talk about inflation, too. I mean, even when there was no inflation elsewhere, there was inflation in Disney park prices. So it'll be interesting to see what they have to say.
Yeah, the attendance in Disney parks, it's heavily tracked on Wall Street. It looks like it has come under a little pressure as the variant has spread. But the movie part of the business, I am really curious on how that does. Cinemark, their earnings call last week was very, very interesting, saying that their business in some areas, in some states, are back to pre-pandemic levels, that people go back to and watch movies. That is very interesting. But Miles, Hims is a real company. I use their shampoo. Stuff is great. Tingles. It's awesome.
Disney back to Hims.
Yeah, no, I was just thinking about it. That stuff is great, man.
No experience with Hims.
Yeah.
The other thing with Disney as well is what to make of the cable business in there. We heard, a little bit last week from Viacom. Of course, they lapped second quarter of 2020 when there basically were no sports. And Disney has had an interesting quarter. They had most of the NBA playoffs. The finals finished just at the beginning of Q3, but most of the NBA playoffs were a Q2 event for them. And then, how are they thinking about the upcoming football season? We talked a little bit on the call this morning about, does the spread of the Delta variant change football? I don't really think that's a target audience crossover there, where that's a group that is going to be deterred by, the pandemic. But, we'll see how the football powers that be think about it.
So, and to take a step back for a minute, I know, Brian, you were crunching some of the numbers this morning on how many companies that have reported thus far have beat estimates. And it's a pretty high beat rate, although to Miles's point, it hasn't necessarily mattered in every case.
Yeah, FactSet tracks this. What is it? 87% of the companies have beaten.
I've got it here. So we've got 88% of companies, or 89% of companies, the S&P 500 have reported results. 87% of those companies have reported a beat relative to estimates, and the overall earnings growth for the S&P 500 is tracking at 88.8%. So.
Although
if
really,
you can keep those
it hasn't
straight,
mattered because a lot of these stocks have sold off on these results.
I know. I'm just trying to. We got a lot of eights in here.
Yeah. Really, what I want to see is what the growth rate is from 2019. Right. That's something that we've talked about a lot. Yes, it's 88% from last year, but
and even alongside these earnings beats, B of A is out with a good note, and I have this story on the Yahoo Finance homepage now. It appears that corporate sentiment has started to peak, and they track very closely how execs are talking about inflation and other trends in their business on these earnings calls, and it appears that sentiment has peaked, and there's starting to be a lot of concern on the street on how second half profit margins will look like because of various inflation, labor, supply chain, you name it, and do estimates have to come down even more, which of course would pressure stocks.
And by the way, speaking about inflation, as we look ahead to this week, as we look ahead to earnings, we got to mention inflation data, which is out on Wednesday. We've got the consumer price index that is expected that day for the month of July. Month over month, we're looking at a 0.5% increase, year over year at 5.3%. But if you look at the core, 4.3%. So that is a number that always gets a lot of attention, that I'm sure we will be talking about. And as we have talked about, that's what companies have been talking about on their calls as well.
And just to go back to those 19 numbers, so right now S&P earnings for the second quarter, basically about to come in around $51 for the overall index. In the second quarter of 2019, it was $41. So 25% increase relative to 2019. And I think, last week we had Goldman Sachs coming out, upgrading their price target. This morning, Credit Suisse comes out. They put a 2022 price target on the S&P of 5,000. And I think that theme, the top-down strategy type theme of are analysts, strategists too conservative, continues to be yes. I mean, right now, the overall estimates for what third and fourth quarter earnings for the S&P 500 will be puts full year earnings at about $205. But we've seen over the last 2 quarters, analysts were at least 10% conservative relative to where we came in. So if you get a 10% beat on third quarter, fourth quarter earnings, which right now are estimated for $52, $53, you're looking at closer to $220 in earnings for the S&P 500 this year. And you have bullish strategists talking about 217 next year. So I think overall, maybe what's really bolstering the index is that everyone remains too conservative. And is that a bottom up story? Is it a top down? Ultimately, there continues to be too much conservatism from, the folks who are guesstimating all these results.
One target that stood out to me in my weekend reading, 3,800, B of A looking at for 3,800 on the S&P 500 to year end. That's about a 14% dip from current levels.
But where is that coming from, though?
Yeah.
No, I'm asking, they say it's multiple compression, right? So their view is that rates are going to be going materially higher, thus making it challenging to put a 21 or 22 on the S&P.
Yeah, it's hard to keep that target right now. When you see a Goldman at 4,700, B of A at 3,800, I mean, that is the range.
I think it's hard to keep the target because the S&P is at 40, 42, 44, whatever we're at this morning. Record highs,
Yeah, so. Well, as you say, conservatism has not been correct in this environment, by and large.
And you don't get in trouble for being too conservative on earnings overall, because generally earnings get revised down as you go through any one quarter, and generally strategists end up being too optimistic. But we have a 6% economy. Are we going to go back to a 2%, 1.5% economy next year? Are you telling me that an S&P 500 overweighted to technology, where the 5 biggest companies are worth trillions of dollars, churning out profits every quarter, exerting tremendous operating leverage over this cycle, are those companies going to all of a sudden start reporting poor results, and now we're going to end up with huge earnings misses? I just don't see it.
Well, I guess a few people do out there.
That's fine. That's their job, not mine. I'm just in the cheap seats.
Exactly. Luckily for all of us, that's where we all are. All right, let's take a break right now. Berkshire's out with earnings. There's one company the stock is buying that's making headlines that Miles noted. We're going to talk about it next.
All right, welcome back to Yahoo Finance Live. Over the weekend, we got quarterly results from Warren Buffett's Berkshire Hathaway. The company reporting $69 billion in top-line revenue, A-share earnings per share coming in just over $18,000. I think that's more fun than the B shares, which are divided by 1,500, gets you to $6.70 adjusted earnings per share. Always liked the nice big 5-digit earnings per share that you only get, of course, Berkshire Hathaway A shares trading in the, I think, mid 300,000s at this point, 400,000, something like that. But of course, the big headline here continues to be the cash pile that Warren Buffett is sitting on, some $141 billion as of the end of the second quarter, and how Buffett is putting some of that cash to work, of course, with Berkshire repurchases. Joining us now to discuss all things Warren Buffett and Berkshire Hathaway, Yahoo Finance editor-in-chief Andy Serwer. Andy, the buyback story for Berkshire, of course, is has been ongoing, but has really over the last couple of years taken on a new phase as we saw those buybacks reinstituted. And I mentioned this morning in the morning brief, people will ask, what will Buffett buy? And I suppose the answer is right in front of us. There's not going to be another big acquisition, at least so far as Warren Buffett currently believes.
Yeah, Miles, you also noted that the last acquisition he made, Precision Cast Parts, not working out so well in the sense that he had to do $1 billion write-off and had to basically apologize for it. Likes the business still, but suggested that he overpaid for it. So if that's your last big deal, maybe you're a little gun shy. I mean, it's difficult to suggest that about Warren Buffett, but it gets tougher and tougher. It's the tyranny of large numbers to find a company that's big enough to actually move the needle for Berkshire Hathaway. And of course, one thing that's very different nowadays, you guys, is just the huge amount of money that's in private equity right now, that's floating around and sloshing around in SPACs. I mean, everyone's looking for a deal right now. So he does not have this territory to himself anymore at all.
Well, and there are also fewer deals, of course, Andy, is the other side of that, right? So what can we sort of extrapolate, not just about Berkshire itself and the environment, but the bigger environment here?
Yeah, well, I mean, as Miles can tell you, I've been saying things have been frothy for too many years. So, yeah, things are frothy. There's no question about that. And there's just so much liquidity out there. And with Berkshire, it's a tough place to be, I guess. You got your $140 billion in cash, which sort of is at the same level it was before. You've got a situation where you're buying back stock. It's a little bit less than the prior quarter. There's nothing to buy. Your investments are doing okay. I mean, he had a big snapback. We shouldn't undersell that point. Operating revenue up 21%, operating earnings up 21%, the stock up 23% year to date. But really kind of a steady as it goes quarter. And, I think that's kind of reflective perhaps of what you guys were talking about in the previous segment, which is, we're kind of climbing this wall of worry right now with the Delta variant. And, that is kind of, you could argue, not a bad place to be. It makes it difficult to buy things, but it's kind of an ultimate hold market, right?
And do you think part of the hesitance on the part of Buffett to go out and buy an acquisition signals it's going to be a different Berkshire Hathaway when he is no longer at the company, and perhaps some of these companies that they do own, maybe they get spun off. Maybe some of the stakes in these companies like a Coca-Cola, maybe they get sold off too.
Yeah, I memean, speculating is the ultimate parlor game, right, Brian? For Berkshire shareholders and Berkshire watchers. It's funny because, he's going to leave his successor in a more difficult situation than he's in the sense that, again, finding things is harder than ever, right? So it's not like, oh, gee, I'll just, go and buy the MGM film library. Well, oh, Amazon just did that. I mean, there's just so many people out there looking for these things. And when you do a deal like Precision Cast Parts, there is a tremendous amount of risk because you're buying something that's so big. And so, if it is Greg Abel and company, it's going to be very difficult to fill those shoes. And maybe it is just on autopilot. And, there are a lot of people out there who have suggested what you're saying, Brian, that like the next CEO of Berkshire Hathaway is going to be the person who spins things off. And that would be a very different company because, buy and hold forever with a great manager in place running a great business has been the MO of this company for many, many decades.
And perhaps, we're staring at the future of Berkshire, or have been for some time, with Ted and Todd, Ted Wesher and Todd Combs running the equity parts of the business, of the holdco, as we can call it. That's where the returns will likely come from, the diversification, as it were. And then, the other thing gets sold down. And Andy, it also struck me going back and rereading this year's annual letter. Warren Buffett spent some time talking about how bad conglomerate structures can often be. And I thought, sort of telling Berkshire shareholders, I've always tried to not end up being a bad conglomerator, which he says have earned their reputations. And the way you do that is you go buy average businesses that you don't really understand, you pay too much for them, and then it bleeds into other parts of the enterprise. And perhaps he is content to let, private equity and SPACs and others, take their chance at companies that Buffett himself and others might believe are overvalued or just not of high quality.
Yeah, I mean, isn't it funny, Miles, that, there's a couple points like that where he says, it's bad when you do this, except when I do it, it's okay. And so far that's worked out. I mean, there's a conglomerates thing. It's also taking, big risks in concentrated risks in equities, right? Don't do that. Of course, I do it, and it's worked out.
Yep.
You should diversify. I don't diversify. I mean, the big stake in Apple is the case in point. You could say, oh, Apple, everyone owns Apple. But I think the point that those guys would make is that it was still, when they bought it, and perhaps today, I mean, they still own a lot of it, underappreciated. It's hard to imagine, the most popular, widely held stock, but it's still underappreciated. I guess that's the thesis.
I think that is the thesis. And again, talking about the engineering side of that, walking us through the math of Apple repurchases their shares, we get paid the dividend, we reinvest that into Apple, voila, we own more of the company without doing, a whole lot of work. But always fun to check in on what's going on with the Buffett empire. I think his birthday's coming up in a couple weeks. Maybe we'll do another round of Buffettology. This is 92 for him, Andy? 91, do you remember?
91. Yeah.
91. So we'll do that. I think it's August 28th or something around there, if I'm not mistaken. Yahoo Finance Editor-in-Chief Andy Serwer, thanks for stopping by. I hear we'll see you in person on Thursday. Rumor has it.
That's it.
Rumor has it. All right.
Down the hatches, Miles.
That's right. Looking forward to that, Andy. We'll see you in a few days. All right, coming up on the other side of this break, we'll have the opening bell here on this Monday morning. Futures set for a mixed open here as we get the trading week underway. Emily Rowland of John Hancock is going to stop by to talk about some of the market action we've seen in recent weeks and what we can expect coming up. Back with that conversation coming up right after this break.
Setting up for a mixed open here on this August Monday. Let's talk about where we could go from here. Joining us is Emily Rowland, co-chief investment strategist at John Hancock Investment Management. Emily, it's good to see you. I'm wondering if can you hear me okay, Emily? Oh, I think we have lost Emily here this Morning. What I was going to ask Emily about is sort of this idea of are we as good as it gets? You know, we keep sort of
The show started at 9. We know the show started at 9. Like, what are we, 25 minutes and we're still waking up, still getting into this?
I'm still waking up,
Oh, my
so
goodness.
it makes sense that everybody else is still waking up too. I don't know.
Oh, look alive.
What is awake?
As Coach Dibble used to tell me, look alive here.
What is awake? It's gold. Julie, you flagged this to us this morning, a potential gold flash crash. And now the prices seem to have come back a little bit, but still, that was a jarring move to kick off the day.
Well, okay, you know what is amusing about the gold trade is okay, we've got oil down, maybe there are some concerns in markets about Delta variant, healthy economy, all this other stuff. Where's the safety trade now? It's in Bitcoin. It's in Bitcoin. Exactly. It's a real thing. And I think that when we talk about where does Bitcoin fit into the conversation, obviously there is a lot of news on the cryptocurrency side with the infrastructure bill, what's going to get through, what's not going to get through, what's going to get regulated, what's not. I will be honest, I try to keep up with that. I really have no idea where we're at in all that conversation. And that, of course, is going to feed into price and the legitimacy of all this, that, the other. But I think the role that strategists find interesting about cryptocurrency is when you have these moments of the market viewing thing X as good or bad, does crypto react in some sort of discernible fashion such that you can call it a risk on or risk off part of a broader strategy? And it does feel like through time we're starting to see Bitcoin emerge as a safety trade of sorts. Not all the time, not necessarily in the same size as you might prefer, but it does respond with some safety characteristics.
Well, it's funny because the sort of conventional wisdom that we've talked about is that Bitcoin doesn't really correlate with anything. But sometimes it does. It's like,
but it does.
Enough.
Right.
Correlates enough.
Well, you get the
correlative.
We've been talking a lot more folks in crypto over the past month, and you do get the sense that however you define an institution, that demand is starting to emerge, whether it's a hedge fund or something larger. People want to get into the space in a big way. We had talked to Fidelity's head of crypto last week, Tom Jessup. He's hiring about 70% more people. I don't think you do that if you don't see demand for the product.
Yeah, well, you don't get in trouble with your clients telling them that we're thinking about cryptocurrency.
Right, exactly.
You know?
We're going to take another try at Emily Rowland. I think she's good now. Chief Investment Strategist at John Hancock Investment Management. There she is. I see her, so that's a first step. Emily, it is good to see you. So as we've been talking about here this morning, you know, we have seen this incredible earnings period where companies are beating by a high margin. We're seeing big growth. And yet, both from an economic and an earnings perspective, things feel like a little tippy here. Are we getting to the downslope?
Well, the good news is that the earnings engine is continuing to power on. We look at next 12-month earnings growth, so what analysts on the street are telling us is going to happen over the next 12 months, and earnings estimates continue to move higher on the back of this new economic cycle that's unfolding in the U.S. Now, the challenge, of course, is that peak year-over-year earnings growth is probably behind us at this point, and that makes a lot of sense mathematically. We were in a recession this time last year, so the base was very depressed. The comps were very easy to beat this quarter. And of course, we're coming in at numbers like 90% year over year earnings growth, 25% revenue growth. So record numbers as far as earnings growth goes. And because those numbers are going to moderate in the quarters to come doesn't mean that earnings engine is not continuing to kick into gear. So we like the earnings picture. We like the fundamental picture in the U.S., but it's going to get a little bit trickier for companies to emerge as leaders as the quarters here progress.
So, Emily, if one is concerned about the Delta variant numbers, concerned that we are now past the peak in profit margins for this year, what is the safety trade? Where do you go?
You want to look for quality companies. You want to look for those that have great competitive positions in their industry. You want to look for companies with great balance sheets, ones that have the ability to ward off margin pressure and exhibit pricing power in this new economic backdrop. So for us, that means areas like technology, areas like communication services. We still want to have some cyclicality in a portfolio. As I mentioned, we are in a new economic cycle. We're nowhere near a recession. For that, we want to embrace sectors that have that cyclical upside, but don't necessarily need higher rates or need higher commodity prices in order to show market leadership. So industrials is actually the poster child for those types of companies that can do well based on an infrastructure package. But again, probably won't be penalized if we see the yield curve continue to flatten here. You're going to get industrials when you go in particular down down into the mid-cap space.
All right, and there we see live pictures from the floor of the New York Stock Exchange, getting today's trading session underway. Hilton Grand Vacations ringing the bell there. Sal, we talked to them, Diamond International, they're closing the deal today? We talked to them when they announced that, right?
I think we have.
Am I imagining that?
I think we have talked to them.
Yeah.
Business on the comeback trail.
Timeshares, right?
HGV.
This is timeshares?
You own any?
No. I'm not a boomer. I don't have a timeshare. Come on now. Come on. All right. We're still, of course, joined by Emily Rowland with John Hancock. Emily, so you talked about liking some of that, industrial, some of those cyclical, parts of the market. I'm curious how you see that fitting into just where the overall rotational forces in the market have been within the last few weeks. We have seen some big shifts, back towards growth, then maybe back towards some value. I guess two-parter here, what do you think drives that? Is it really just a rates trade? And how long can that go? I mean, are we going to be in this same kind of environment into 22 and maybe even 23?
Yeah, growth and value are actually neck and neck so far this year, and you've seen these huge shifts. Oftentimes it has been related to rates. So of course the idea is that as rates go up, that benefits more cyclical parts of the market, financials in particular, which is going to lift the value complex. And then when rates come down, reflecting a more moderate growth backdrop, that typically rewards growth or those parts of the market that have longer term cash flows that are discounted at a lower rate. There is this big schism that seems to have opened up between growth and value investors. I'm here to tell you that they can live together. We want to embrace both in this market. Again, that quality factor is going to be found more on the growth side of the house, but we still want to have that beta in the portfolio. We want to have offense to play the cyclical recovery that continues to happen here in the US. Yes, the Delta variant is creating a potential risk to that view or potential idea here that maybe the reopening takes a little bit longer, but overall, still not near a recession, want to play the unfolding economic cycle, but want to be thoughtful about the fact that peak stimulus, peak growth, and peak earnings are probably behind us at this point.
And Emily, we were just talking a few minutes ago about Warren Buffett and how he is not finding any bargains out there. It sounds like from what you're saying that finding a bargain isn't necessarily the most important thing, right? Even if something is, on a relative basis, expensive, it can still go up.
Yeah, Julie, it's such a great point. And when we look at the PE ratio, it's actually more about the denominator to us. So prices can continue to move higher, but as long as earnings are moving right alongside them, that's really what we're watching. And as we all know, over time, stock prices are driven by earnings. And yes, there's nothing cheap today. There's no low-hanging fruit. But actually, when we compare next 12-month PE ratios across U.S. and international equities, they're actually looking the best in the U.S. in the small and mid-cap space, believe it or not. So next 12-month PE for example, mid-cap value is trading just below its 20-year average. I've heard a lot of people talk about emerging markets looking cheap, especially after some of these regulatory challenges in China. Yes, PE ratios have come down, but emerging markets are actually still trading above their 20-year average. So we're looking for relative value, in particular in U.S. mid and small cap equities.
And as you say this, the Russell 2000 is outperforming today. It's about 0.5%. Emily Rowland, thanks so much. Good to see you, co-chief investment strategist at John Hancock Investment Management. We want to check in a few opening bell movers here. Let's talk chicken, you guys. Why not? We love to talk chicken here. Tyson Foods was out with its earnings this morning. It beat estimates. The company reporting EPS of $2.70, 163 was the average analyst estimate. I mean, we know what's going on here, right? Chicken prices are going higher. The expense line for Tyson, though, of course, is also going higher. I was telling you guys an anecdote on my vacation last week that as we were driving through rural Maryland and Virginia, there's a Tyson plant, and they were offering starting salary $20.65 an hour. A big sign outside the plant, by the way.
Yeah.
Trying to get those workers.
That's pretty good. And, just staying on the cost side of things, Tyson noting inside their chicken business, $410 million of higher feed ingredient costs compared to last year. And they're also highlighting production inefficiencies. Worth noting, despite all that strong demand in chicken, that business still operated at a loss in the quarter.
Very interesting.
You see strong demand for beef, strong demand for pork. Meat, bull market for meat.
Protein.
Pro-cyclical protein market. All we talk about on this program is your fake meats over here, Sazi. Tyson letting us know it's still a real thing.
I'm a big proponent of the Beyond Meat meatballs. I'm sorry. And you know what? Actually, no. I don't apologize. I think they're quite good.
I think you should apologize.
You have to apologize.
Brutal.
There's also a chicken deal this morning, by the way. Sanderson Farms, which is a big egg producer, also chicken producer number 3 chicken producer in the U.S. Cargill and Continental Grain are buying the company for about $4.5 billion in cash. They're combining it with Wayne Farms, which Continental owns, which is the 8th largest in the U.S. So obviously it'll be a bigger combined company here.
Sanderson getting gobbled up today.
Oh, no.
Yeah.
No, you didn't.
Oh, yes.
That doesn't work.
It does work.
It doesn't.
No? It doesn't work?
Because that's a turkey. They sell chickens.
I'm sure there are turkeys in there somewhere also, you guys. And then another deal that I know Miles...
Any kind of poultry.
Miles is
Very
excited.
foul. This is foul behavior.
Another deal that I know Miles is excited to talk about that has nothing to do with chicken that I can discern.
You can certainly buy chicken at some of these locations.
Yes, there you go. DraftKings is going to be buying Golden Nugget online gaming, all stock deal. $1.5 billion is the implied equity value here. And what did you call it this morning? SPAC on SPAC crime?
SPAC on SPAC crime. Yeah. I mean, this is it. This is a SPAC. DraftKings SPAC buying the Golden Nugget online gaming SPAC, which came to market last year.
How hot does the sports betting market continue? We just talked to Gannett's CEO last week. He struck a deal to now get involved with the sports betting space. Bally's, we've talked to this numerous times. They are getting deeper into the sports betting craze. Of course, look at us here at Yahoo Sports. We're in the sports betting craze as well. It's amazing just the longevity of this trade. It's going on at least, 2 years? 2+ years?
Yeah, I mean, it has a lot of the same elements as the cannabis trade, right? Where everyone was smoking weed and betting on sports in their free time. Now you can do it, legally, and you can do it on your phone, and so every state's going to eventually legalize it. So there's this big, regulatory tailwind for the whole sector. But I mean, I don't know. Well, I know you're not watching sports. I don't know how much sports you're watching, Saz, but I am now finding the tie-ins more and more intrusive, and they're all around when you sign up. Go sign up for, this app and then bet on this outcome. This was in the golf yesterday. Like if you bet on something with end, it was like you can enter some $10,000 contests, right? But I'm sitting there and I'm thinking, who's watching this that wants to bet on golf that hasn't already downloaded and started betting on golf? So so I'm asking about the CAC of the marginal consumer for sports betting, and I know that everyone's going to tell me that there's a huge market out there. There's a huge TAM. So the market, in my view, though, is like it's 16-year-old boys that are going to turn 18 and then legally be allowed to open an app.
Or it's older bettors who maybe haven't adopted yet.
Maybe.
Perhaps.
Maybe. I should have asked my father if he's interested in opening a DraftKings account.
Yes, the Mr. Udland indicator. Yeah. It's an important indicator.
If he has his reading glasses, maybe. But otherwise, I don't know if it's going to happen. He actually cut the cord though, so maybe he is. Maybe he's millennializing himself the older that he gets. I have cable and he cut the cord. What do we make of this?
You have to come back and do some market research.
You did some. You spent your vacation market researching chicken competition, and I unfortunately did no market research this weekend. You do any?
Every day.
Yeah, Sazi lives.
What do you got? You got channel checks?
Go down
for
the supermarket. I see inflation in the supermarket running rampant. I'm in Target, Walmart. Things are out of stock. It's chaos out there, Miles.
And widespread staff shortages in Outer Banks restaurants is my other vacation report. All right, coming up next, we're going to get some field research from Jared Blickery. He's live on the floor of the New York Stock Exchange. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Monday morning. We see all three majors are in the red to get today's session underway. Let's go down to the floor of the New York Stock Exchange where we find Yahoo Finance's Jared Blickery for his look on what catches your eye on this Monday morning. Jared.
Well, I'll tell you, I'm thinking back to Friday. As the day was progressing, I was looking at not only the indices, but really the bond market, the 5-year and the 10-year, and just seeing them shoot up and really kind of confirm that good news was in fact good news. Those beats, not scaring investors thinking that the Fed is going to put the brakes on too quickly. Are those moves going to be continued today? Usually the movements for the week are determined by the first hour of trading Tuesday morning, so the next 24 hours going to be critical to that. But I've not only been looking at the 10-year, there's a huge amount of activity in the commodities market, guys. If we got a few minutes, I'd love to spend some time on that.
Let's do it. We have a few minutes. Let's talk about what's going on with oil prices here this morning.
Yes. All right, crude is just getting whacked here, and this has to do with demand concerns out of Asia. We just got some import-export numbers out of China. Those disappointed. China was actually paying less for crude, or buying less crude in July than they were in June, and so it might be a little bit of a slowdown over there. Now you take that in combination with the US dollar, which was surging Friday because of the strong payrolls report. Crude oil is a global commodity. It is a commodity. It's fungible, so it's reflecting global demand, whereas what's happening in the U.S. is more idiosyncratic. So you put it all together, I think the U.S. dollar has some more room to run to the upside. That's not necessarily bad. It's just reflecting the potential for higher interest rates in the U.S. as we're seeing in the Treasury market. So you put it all together, it's not bad. August is still that low volatility, low volume month where we tend to have volatility spikes. We tend to have more VIX spikes in August than any other month as traders wrap up their vacations, people get ready to go back to work and to school. But nevertheless, the markets are not in the worst place right now. In fact, they're pretty nicely situated. Would like to see breadth pick up in the NASDAQ. If that happens, I think we got the green light for another march higher.
All right, Jared, can we talk a little bit about what's going on in the coins quickly?
Yes.
Bitcoin,
All right,
45,000. All right, so question, is this all about the legislation, and can you help us make sense of where we stand right now on the role that crypto regulation does or does not play within that infrastructure bill?
I think it's really overblown. I think if they had hastily passed the measure, it doesn't look like they're going to do that. It would be a little bit of a blow for crypto, but price precedes narrative. We've seen price picking up over the last few weeks as sentiment has shifted. So Bitcoin, I look at price levels. Bitcoin above 45,000, that's another nail in the bullish case here. And I'm liking the price action. I think the price was at 45 or 48,000 when I said we're in a crypto winter. That was months ago. It's looking like we're pulling out of that right now.
All right. That's it. Jared Blickery, live on the floor of the New York Stock Exchange. Jared, appreciate the time. I see what this, I didn't read the T's, so I was confused of what this is. Now's the time to go down to the lobby and grab yourself a snack, because when we come back, one of the premier meme stocks, AMC, set to release its earnings today. We're going to discuss the prospects for the movie theater chain and also how to think about that underwhelming box office debut for Suicide Squad over the weekend. Back with that whole conversation coming up here right after this.
AMC Entertainment set to report second quarter results after the bell today. And joining us now to discuss what to expect is Chad Bynum. He's Macquarie Group senior analyst. Chad, in as much as the numbers matter to the diehards for AMC, let's talk about what to expect here. As Brian Sazzi mentioned earlier, Cinemark reported late last week, and perhaps we can extrapolate some encouraging things for AMC. What is your outlook?
Sure. Thanks for having me, Julie. So a couple of the highlights we talked about from Cinemark and then also a few of the other chains that have released second quarter earnings. What we saw was revenues were generally off roughly 70% versus the two-year comparable period back in Q2 2019. However, the big positive for everybody was actually an opportunity to break even on cash flow. And that's what we saw from Cinemark, from Marcus. IMAX was another company, a little bit of a different business model, but again, they're burning less cash, or actually no cash, which is positive going forward. But on the core fundamentals, clearly we're seeing lower demand for movies that are coming out. That was evidenced this weekend with Suicide Squad, which came in a little bit below expectations. For the back half of the year, we were expecting that U.S. admission revenues would be off somewhere between 10 and 25%. We've brought down our estimate, and then that brings down our estimate for 2022.
Chad, do these companies, AMC, Cinemark, do they still have that access to capital they need potentially later this year?
I think AMC was able to address some of these issues in the last quarter. They'll talk about that tonight on the earnings call. They still have significant amount of deferred rent that they will have to pay. These weren't debt forgiveness rental agreements. But yeah, currently they have some cash on the balance sheet. They'll burn less. I don't know if they'll be able to access the markets as they were in the first and second quarter, just given, what happened with the proxy and the lack of options for AMC.
Out of all the main theater chains, you see some of the stocks we're showing on the screen, AMC, Cinemark, IMAX, National CineMedia. Is there one theater chain that you're concerned that may not survive this?
From a margin perspective, IMAX is a very asset-light business model. They have a clean balance sheet. They're in the best position. They have global diversification. That stock has been hampered just with what's going on in China from a headline standpoint. Cinemark, on the traditional exhibitor space, they were generating 25% margins pre-pandemic. When we talked to them on Friday, they actually said they still believe they can get back to those levels. They have very low cost in terms of utilities, labor, wages, et cetera, and they're more outside of urban markets. AMC is always the one just because their rent is extremely high. They're center city, New York, LA, Chicago, some of these bigger markets, and it's just going to be harder for them to generate positive margin and positive free cash flow.
And, Chad, thinking about just the general setup for the movie business, I mean, we heard a very different, tone from Viacom last week when they came out with their results, trying to be very, when we talked to the CFO on the program, I thought they were trying to be extremely explicit in their talent friendliness, let's say, relative to some other brands that we'll hear from later this week. Have we maybe underrated the shift that's happened, though, with the distribution of movies during the pandemic? And have we opened a Pandora's box here, to use kind of the industry's phrase? And is that maybe not being reflected in some of the theater chains, quite as much as it ought to be?
I think we can't be naive in the conversation around theatrical windows. We won't go back to 3 to 4 months. Pre-pandemic, the average was about a 75-day window at the theater versus at the home. Now it's certainly coming in somewhere between the 30 and 45 days. I think all the studios believe that this is the correct model. They still do believe that, there is something that is created and generated at the theater, but consumer, they want things now. They can't wait 3 or 4 months like maybe they would years ago. So they've had to adjust. And I think that's just something that we're going to have to live with. And, with the day and date releases, as we've seen with some of these movies, that's going to be a very tricky situation because, like we saw with Scarlett Johansson, a lot of the artistic and financial, benefits that come in the industry aren't being rewarded like they were in the prior business model.
And Chad, I wanted to ask about Suicide Squad because it did not meet its projections in the theaters over the weekend. And what are we to take away from that? Are we to take away that people are worried about the Delta variant and there are some bigger implications for the theater business? Is it just because of this movie? What's your takeaway?
Yeah, I think we had lowered expectations as a result of mask compliance and the Delta variant, but this did come in below, to your point. Part of it may have been as a result of prior reviews on, the predecessor movie. Part of it, I think, was probably the Delta variant. It's really, it's tough to tell. I think we were seeing some good momentum in the movie theater going business. We're seeing that with premium content, premium showings. That's resulting in good ticket prices and really a movement towards IMAX or premium type showing. So we were, slightly optimistic that this could come in above expectations. It's really the romantic comedies and some of those lower budget movies. Those are going to take a lot longer to recover. But this is certainly hurting the names. I think that's one of the reasons why the stocks are down today. They all sold off hard in July when the reopening names sold off. And I think this will put pressure on them for the next month or so.
Hey, Chad, we've been sort of joking this morning about our own market research we've been conducting on different topics. Have you been going to the movies? What have you been seeing? What have you been noticing? Are people buying more drinks, less? I mean, what's happening out there?
I personally haven't gone back to the movies yet, just given the approach that my family is taking. I think it's a tricky one because the numbers that we're seeing clearly show that there's no price elasticity. There's people that want to go do, lots of things, whether it's vacationing or going out to restaurants or going to the movies, and the operators can charge whatever. And those people who want to go are going to continue to go. So we're seeing really strong pricing, but the attendance is still well off of prior levels. You do have a slew of differentiated content that comes out in the next couple months. That'll probably get me, back into that environment. But, we've always said the movie theater is a place where kids can escape parents and parents can escape kids. And I think parents right now aren't choosing to escape their kids, get a babysitter, and go to the movies. They're doing other things that maybe they weren't able to do, during the past 18 months. And this has kind of been pushed back in the priority scale.
And to your point, there's also, of course, safety concerns about bringing it home to your kids. So it's telling, that in itself is market research, that you are not there yet. And I think a lot of people are in the same boat. Chad Vinan, Good to see you. Macquarie Group Senior Analyst, thanks for being here. Coming up next, a new look at coal at Kohl's, perhaps. Brian Sozzi's going to tell us what the company is doing by bringing Sephora into its locations.
All right, welcome back to Yahoo Finance Live. Another day, another retailer being taken on by Yahoo Finance's Brian Sazi. Got a deal here, Sazi. Sephora going into Kohl's.
Yeah.
Good? Bad?
Well, I want to spew a little positivity on Kohl's
Hey,
for
there
once.
you
It has
go.
probably not happened in 2 years, but we're starting to get some analyst notes come from Kohl's recently met up with the investment banking folks on Wall Street to take them through their new Sephora store inside of Kohl's. That trip recently happened at a Ramsey, New Jersey Kohl's location, and there you have that location here. That photo comes compliments of Jefferies analyst Stephanie Wissink. And I think it's a lot bigger than a lot of people thought. So on the outside, the signage is very recognizable. Definitely don't see that on the front of JCPenney, where the Sephora stores have historically lived. Another picture from the fine folks at Jefferies. This area in the store is 2,500 square feet, taking up a large portion of the location. 125 brands, 8,500 SKUs or stock keeping units. This is a serious bet by Kohl's. Coming off, it's part of a 10-year partnership that they inked several months ago. Right now, they have 4 of these locations open. By the end of October, 200 of these Sephora inside Kohl's will open. As you can see on that map there, and of course, you see me inside of a Kohl's shopping bag. But anyway, yes, most of these stores are going in New York and California to kick things off here. So a big push by them, by Kohl's, right out of the gate. Generally speaking, Wall Street likes these stores. They like the look. They like the feel of them. You have Jefferies coming out here after meeting with Kohl's management, most specifically CEO Michelle Gass. $71 price target on Kohl's, reiterating their buy rating. You have Rob Durbel over Guggenheim reiterating his buy rating on the stock, $70 price target. So a lot of bullishness on Kohl's as they open up more of these makeup shops ahead of back to school and the holiday season. But guys, this is not happening in a silo. Kohl's is not the only one doing this. There is a full-on makeup war happening right now. You have Kohl's doing what it's doing, and then you have Target this month. By the end of this month, they will have 100 Ulta at Target stores open. Eventually, that will reach 800 stores. You'll probably see a couple more, maybe 50 to 100 more open inside of Target by year end. But the makeup wars are very much on, and Kohl's is so far leading that war. I can't believe I just gave a shout out to Kohl's.
Where else did we have you last week? The little graphic. We had you in the bottom
energy
of
drinks.
Energy drinks.
Yeah.
That's right. You were drinking the Monster Energy drink. I ran some errands on Friday after the show, and I noticed there was a 3 for $5.50 Monster promotion happening at a 7-Eleven.
That's bad for margins.
Yeah.
Good for Brian Sazi.
Well, I'll just add to it, just to balance this out a little bit here, real quickly. Shares of Kohl's since CEO Michelle Gass took over May 2018 down 16%.
Sure.
So she has a lot to prove here.
You know what else is in that shopping center out in Ramsey, right across the street from Don Bosco, where that Kohl's is located? There's a Panera in there.
Yeah.
Which brings us to our next hour.
You're so
where
good.
We'll talk, hey, how about that? How about that? We're going to talk about Panera's family of brands taking new shape. We will also discuss the code red for humanity. That's what the UN is saying after a severe warning about climate change. We'll talk about the report's findings coming up right after this. All right, just after 10 o'clock here in New York City on this Monday morning, August the 9th. I'm Miles London, joined by Julie Hyman and Brian Sazi. Let's take a look at where stocks are trading early on in this week's session. We see all three majors are lower. NASDAQ off some 4 basis points. No major moves there. Dow off some 0.3% as we get the week of trading underway. And the parade of corporate earnings continues, even with about 90% of the S&P 500's market cap having reported their results. Dozens of big players on deck, maybe some minor, let's say some bit players within the market story. Meme trades, SPACs, as Brian Sazi mentioned. AMC's out after the bell today. Got a number of SPACs out with their results. Disney coming out on Thursday after the close, probably the week's big highlight. And later on this hour, we're going to be joined by the CEO of Panera, as that company combining its brands under one umbrella, the Panera Brands umbrella. So the company no longer Panera Bread, but we'll discuss what we need to know about that new combination coming up again later on in this hour. But we begin our conversation this morning with the latest on the coronavirus outbreak and some comments that we have heard from Anthony Fauci over the last couple of days as we continue to square up this school year with the spread of the Delta variant continuing rapidly throughout the country. Yahoo Finance's Anjali Khemlani joins us now for the latest on these developments. Anjali.
Thanks, Miles. Yeah, we are looking at, of course, the raging surge in Florida with the Delta variant really causing a lot of concern, as well as the restrictions that the state government has placed on some of these school districts, and broadly speaking, on not looking into mask mandates or any such efforts. And so this weekend, Dr. Anthony Fauci talking about one reason why that may change in the near future. Listen to what he had to say about boosters.
I hope, I don't predict, but I hope that it will be within the next few weeks. I hope it's within the month of August. If that's the case, you're going to see the empowerment of local enterprises giving mandates. That could be colleges, universities, places of business, a whole variety, and I strongly support that.
This coming from the FDA approval that is supposed to be just weeks away. We've heard from the FDA saying as much, and this could play a major role as we see around the country with private businesses, schools, and et cetera, asking for vaccine mandates or mask mandates as a result of deciding against or for what states have been able to impose. So it should be pretty interesting once that comes out. Of course, Florida is now the epicenter of the virus and the pandemic here in the U.S., with more than 20,000 cases reported just on Sunday. So a lot coming to a head pretty shortly. We also heard a headline out of Norwegian, which was able to enforce basically a vaccine passport, making sure that guests are mandated to have vaccines before getting on board. So a lot of this you're starting to see come out, and it only fares to build up over time. Back to you guys.
All right, Yahoo Finance's Anjali Khemlani with the latest on the coronavirus pandemic. Well, let's turn our attention now to the risk that climate change poses to all of us here on planet Earth. The UN calling this a code red for humanity. In its latest climate report, Yahoo Finance's Rick Newman joins us now for this uplifting story on this Monday morning. Rick, and I think it does keep in step. And I remember the IMF warning about the risks of climate change to the economy. It was their big report just about a month before the pandemic, so we all kind of forgot about that. But there has been a lot more conversation from these big multinational technocratic groups with these kinds of very dire, very stern warnings about the threat of climate change.
Yeah, and this is the same, this is the same United Nations panel that's been doing these reports since the 1990s. It's considered the definitive source of scientific data on this. What's new about this is basically they are able to narrow the point at which we're going to cross this threshold that world governments have set, which is a 1.5 degree Celsius increase in global temperatures. They think it's now going to happen by 2030. That's about 2.7 degrees Fahrenheit for those who don't speak metric. But this has changed from something that seemed like a distant threat, something we really didn't have to worry about for a few years or even a decade or two, to something that's basically right around the corner. And we're getting real world reminders of this all the time lately because of floods in Europe, wildfires in the American West and in Greece. And what the UN panel is saying at this point is that, look, the evidence is now completely definitive. This is basically all caused by the burning of carbon by humans. There's no natural explanation for it. And we're getting close to the point of no return where we're just going to cause lasting, irreversible damage to the planet that's going to harm humanity and kill people.
Close to, but not quite there yet, because the report also says we can still make meaningful changes, right? I mean, what are they saying is sort of the most important?
Yeah, so what seems impossible at this point is to reverse the warming that we've already had. So something very close to that 1.5 degrees Celsius. What this report says is we can meet that target of limiting global warming to just 1.5 degrees Celsius if the entire world adopts rapid and aggressive amelioration efforts. So that is stuff like President Biden is talking about, half of all cars being electric vehicles by 2030. And then we've got to talk about the electrical grids. You've got to get the electrical grids over to carbon neutral. I think Biden's target on that is 2050. But it's not just the United States, it's every country in the world. I mean, there's considerable reason for skepticism here. Miles, no, I don't think anybody turns to me for good news, and this news is actually pretty bad. I mean, we are probably not going to hit that 1.5 degree limit and stay there. We're probably going to blow through it. And some of these things are just irreversible. I mean, one of the things that I noticed is this report says that even if we do stop, let's say we do hit that 1.5 degree limit and we don't go past it, sea level rise is not going to change. It's whatever it rises to, that is going to be the new normal for at least a couple centuries. And even if we are able to hit that climate target, we're still going to have higher sea levels. And the outlook for how high sea levels could go is, I mean, it's drastic. Sea levels could rise by 7 to 10 feet by the end of this century, which would just completely wreck, coastal communities everywhere around the world.
Yeah, most definitely. On maybe one of the more positive fronts in terms of what we are doing to try to reduce emissions. There's a report out today from Bloomberg New Energy Finance that we could see at least 2/3 of global car sales being electric by 2040. Now, of course, the source of that electricity is important in terms of emissions as well, but at least I guess directionally it's going to the right place.
Yeah, I think that's right, Julie. I would point out that this is not automatic. There are still some things that have to, some big things, technology breakthroughs, for example, that have to happen for that level of adoption of electric vehicles. For one thing, the batteries have to get cheaper, and not just a little bit cheaper. They have to get substantially cheaper. We need technological breakthroughs such as a solid state battery rather than a lithium-ion battery and other things like that. I mean, we're clearly moving in that direction. And we also are going to need a network of charging stations comparable to the network of filling stations we have right now. Biden does want to spend a lot of money to get the government in this game to help establish this infrastructure. That's part of the couple of bills that are now going through the legislative process on Capitol Hill. So, yeah, there are reasons to be optimistic about the adoption of electric vehicles, but it's not a given.
All right. Yahoo Finance's Rick Newman. Has the sun come out, Rick? We're in the dark hole. Is anything good happening here on this Monday?
Too much sun. Don't go out in the sun.
It's going to be like 98 degrees on Friday here in New York.
The good news, the tomato growing season in Yonkers, New York is going to get longer.
Have you saved them from the squirrels this year, Rick?
Yeah.
All right.
The squirrels are on the run.
That's good news.
All
there
right,
you go.
squirrels on the run, tomatoes thriving in Rick Newman's garden. That's what we got for you this Monday morning, folks. All right, Rick Newman, thanks so much. All right, well, coming up, if you're taking a cruise out of Florida, you may be required to show your vaccination status despite the state's opposition to COVID-19 vaccine passports. Julie Hyman has that story and more coming up in Down to Business right after this break.
Alibaba has fired a manager who was accused by another employee of sexual assault. The woman described the alleged incident in an 11-page account on Alibaba's intranet, which was then shared via social media platform Weibo. The company has come under fire in China for acting only after the accusations became public. The battle for workers isn't limited to hospitality and restaurants. According to the Wall Street Journal, Jefferies will join Goldman Sachs in offering starting pay of $110,000 to first-year analysts. That matches the top of the pay scale for junior bankers. JP Morgan, Citigroup, and Morgan Stanley earlier this year raised their first-year pay to $100,000 from $85,000. Jefferies has turned up its fight for talent as it has climbed to 8th highest on the league tables of total investment banking revenue. And Norwegian Cruise Line will be permitted to require passengers provide COVID vaccination documents. That follows a federal judge's ruling yesterday. The company had sued the state of Florida, which passed a law prohibiting businesses from requiring vaccination proof. Norwegian's first trip from Florida scheduled to depart Miami on August 15th. Meanwhile, Florida's coronavirus case count is rising at nearly the fastest rate in the nation. It's up 84% over the past 2 weeks, to a daily average case count of more than 19,000. Miles?
All right, let's take a look at some of the trending tickers here on Yahoo Finance at the Wi-Fi interactive touchscreen. And we see movement here, real-time update. But we see Gold Nugget Online Gaming, GNOG, getting acquired by DraftKings in that all-stock deal. Of course, bringing the online gaming assets of Fertitta Entertainment, Tillman Fertitta's overall, family of gaming and entertainment and so on, casino brands, bringing that in with DraftKings. Interesting part of that transaction as well. Fertitta Entertainment has been going through the process of a separate SPAC transaction with Fast Acquisition Corp. And Gold Nugget itself came public via SPAC. DraftKings also came public via SPAC. So you have one SPAC buying another SPAC, and that second SPAC being acquired by the one SPAC is part of a carve-out from another company going through the process of a SPAC acquisition. Of course, all fun here in the world of financial engineering. That's why you have the folks over at Jefferies getting paid more for their work on investment banking. SPACs have been a big part of why Jefferies has climbed up the league tables over the last year or so. Just looking at a couple other trending tickers here on Yahoo Finance this morning, we take a look at Coinbase. That company is set to come out with its first quarterly results since its direct listing later on this week. We have seen shares, repair themselves somewhat, let's say, after some of that disappointing initial trading that we saw. Stock trading in the 300s on those initial days of trading. 234, you might recall, was the reference price for where Coinbase shares had traded in the secondary market just ahead of the direct listing. So we've seen a little bit of momentum here for the stock, a little bit of repair as you've had an overall more positive outlook within the cryptocurrency space. Also trending today on Yahoo Finance, of course, is Bitcoin itself, sitting right around 46,000 or so. Let's take a look inside today's markets because we have not a lot going on the headline indices. Mixed picture here. Looking at the NASDAQ 100, Tesla, big mover. Moderna up about 7%. Really, so far as we can see, the biggest mover within the NASDAQ 100 is Moderna, right there at a 7% gain. But if we look at the sector action within today's market, healthcare, staples doing the leading, energy, obviously oil prices under some pressure, doing the lagging. And we were talking with Emily Rowland earlier on in the program, and we'll of course talk with strategists throughout the next week about the rotational characteristics, let's say, of this market and the way we have seen so many regime changes, quick ones really, within the last month or so. Value leading, growth leading. Of course, beginning of this year was all value cyclicals. Then as the 10-year came down, growth has done a lot of that work. Today, materials, industrials are the laggards within the overall market. XLF also lagging the overall S&P 500, which right now is off just 19 basis points. But you look over the last couple of months, and you can see technology, healthcare, and consumer discretionary have really been the workhorses, as materials, industrials, and energy have been laggards over that period. All right, coming up on the other side of this break, we'll turn our attention to the world of sports. Talk to a couple investors making big plays into the sports world opportunities that we see there as we head into the second half of this year. Back with that conversation coming up right after this.
Alternative asset manager Blue Owl is on the prowl for some slam dunks, recently taking a 5% stake in the Sacramento Kings. Let's see what else the newly created money manager has cooking. Joining us now is Blue Owl co-founder and co-president Mark Lipschultz and co-president Michael Reese. Good morning to you both here. Mark, let me start with you. Certainly catching a lot of attention with that new investment in the Sacramento Kings. Why'd you make that play?
Well, listen, thank you so much for having us this morning. Really a pleasure to be here. I'm going to actually turn that to my partner and friend Michael here.
Yeah, thank you. We're really excited about our strategy we call Home Court, which is our joint venture with the NBA. We have two early positions, one in the Phoenix Suns and the other you referenced, the Sacramento Kings. And it gives our investors a way at a smaller denomination to participate in the growth and excitement that the league offers from an investment perspective.
So, Michael, how would an investor, how do they earn a return on this stake?
Well, we've seen a tremendous increase in value of the overall sports and media industry. Investors in our funds are able to participate in both the cash flow dynamics that the league offers, as well as the long-term appreciation. You invest in the fund, and at some point you have the right to exit and get the appreciation that your position has achieved over that period of time.
And Mark, it's Miles here. I'd love if we could maybe just back up and talk a little bit about the structure here of this company and the structure of the SPAC transaction and sort of how it fits into this conversation around SPACs. I mean, I think us here in the media, we kind of paint it all as, one big thing, but certainly within that space, it's just a structure and there's a lot of opportunities in there. And I'm curious, how you guys see yourselves fitting into that.
Well, that's a fantastic and perceptive question. The SPAC is itself just a structure, as you said. And for us, frankly, it offered a really critical structural tool to achieve the strategic end. The mission for us was to bring together the direct lending business of Owl Rock with the GP Capital Solutions business of Dial and bring those two together. And to do that, we needed to have a vehicle, as you say, a structure, and the SPAC served as that structure. Sitting here today, we're just like any other public company that has gone through an IPO. The SPAC was quite small as a portion of our capital structure. And so today we're a publicly traded company, and that happened to have been the mechanical way for us to become the one-stop shop for capital solutions for the alternatives industry. And so
it's Julie here. What does that mean exactly? For folks out there who are not necessarily familiar, right? When you talk about alternatives, alternative assets, I know part of your business is direct lending. The other is alternatives like the the NBA stakes that you were talking about. What are some of the other, what's sort of the breakdown of the portfolio, if you will?
Well, Julie, think about the overall alternatives industry as a growth industry. And it needs capital to grow in a number of different ways. And you mentioned direct lending. We have one of the leading platforms for making loans at the portfolio company level. But we also have additional pools of capital to buy into the firms at their GP level, at the management company level, and to lend to those firms as well. So we want to be the provider of picks and shovels to the alternatives industry, not doing the deals directly, but as I said, providing the capital that they need to accomplish their objectives, whether it's across the buyout space, infrastructure, real estate, et cetera. We have pools of capital to meet all those needs.
Mark, I talked last week to one of your competitors, Apollo, and they told me they remain long the United States. Are you still long the U.S. despite all the concerns we're seeing about peak growth, COVID variant, you name it?
We certainly are. The U.S. economy continues to be extremely strong. We see this through, we have hundreds of companies in our portfolio. So we have an interesting lens into it and heavily U.S.-centric into that picture. And businesses are thriving, and there's certainly challenges. Inflationary pressures are very real. The wage issues and finding workers is certainly a challenge. But the businesses are really doing well. We have a particular focus as a firm on lending capital to the technology sector. And as I think is apparent to everyone, this is an area of tremendous growth that is thriving. And I think there's little reason to think it's going to slow down.
It's interesting to hear you guys talk about the growth there, because when you hear from the traditional banks, when they reported their numbers, lending was pretty lackluster. That was one of the areas where they were just not seeing a lot of demand. So what's different with the clients to whom you're lending versus what a traditional bank might see?
So But here's the reason our business exists, which is to provide capital to mid-size and upper middle market, in our parlance, businesses that are growing. And that is really an area the banks no longer focus on. We make loans and hold those loans. So we have long dated. In fact, in the case of Blue Owl, over 90% of our capital is permanent capital. This is a really important attribute of our business, but it's really important as it relates to our ability to deliver capital. So we keep our capital. We can provide very long dated solutions or very tailored short dated solutions to these companies that really aren't served by the banks anymore. And just like banking of old, where loans used to be made and then retained by the bank, and there was a relationship between the bank and the borrower, and it was about mutual success, that's really what we've brought back to the picture. And with private equity in particular driving a lot of borrowing, we in fact have never been busier. We just had our busiest quarter ever in terms of loan origination.
And Michael, back to you on sports. How big do you envision that part of the portfolio getting, and how far away are you from another deal?
Well, the overall industry has been dominated by individual investors, and we all know the names that own the teams across all different leagues. This is really the very beginning of the process for institutions and more retail investors to have their ability to access this. So it's really early days. The institutional investment in sports is just getting started, and we think it could be quite substantial over time.
Well, we look forward to following your journey. Blue Owl co-founder and co-president Mark Lipschultz and co-president Michael Reese. Good to see you guys. Have a great week.
Thank you, too.
Thank you so much.
Up next, a new powerhouse platform in fast casual dining has emerged. The CEO of the newly minted Panera Brands joins us to discuss Panera Bread's merger with Caribou Coffee and Einstein Brothers Bagels. That's right after the break.
All right, well, Panera Bread is joining forces with Caribou Coffee and Einstein Brothers Bagels to form a new Panera Brands under which the three businesses will operate. And joining us now to discuss is CEO of Panera Brands, Naran Chowdhury, also still the CEO of Panera Bread. Naran, thanks so much for jumping on this morning to talk a little bit about the deal. So I just want to start with how you guys are seeing the recovery in your businesses. We've talked to a lot of fast casual operators over the last year with strong consumer spending, people more out and about, what the trajectory has been like for those three portfolio companies, over the last year.
Thanks, it's great to be here. Well, the trajectory has been very strong. And as you mentioned, I think as a result of the macroeconomic conditions like stimulus payments, vaccinations, and a general desire for consumers to get back to the life as they once knew it, coupled with some of the pivots we made as brands through the pandemic, more off-premise, more digitally focused, and rapid-fire innovation, we are seeing a tremendous recovery across all three brands this year. And in fact, the momentum is building week on week. So we're feeling very good about where we are and how things look going forward.
Take us through why you're bringing all these brands together under one roof. Are they going to share rewards programs? Are they pulling from the same food suppliers? How are you thinking about it?
Yeah, I think so. It's a very exciting development. If you think about it, this creates one of the world's largest fast casual restaurant brands with 4,000 stores across 10 countries, 115,000 employees. So, much larger in scale. And I believe we can be stronger together and we can grow faster. So the real reason to do this is to leverage the competencies that we have, such as our digital ecosystem, our omni-channel network, our supply chain, as you mentioned, our innovation strength, and also the capability of franchisees that we have at Panera Bread, and that we can leverage these assets across all three brands to grow much faster. That really is the intent.
It's also a pretty easy way to tell Wall Street a story. Do you have any timeline on when you might become a public company again?
Well, as you can imagine, we are always thinking about various options all the time, but at this point in time, we have not really made a specific decision on when exactly that might happen or if it's going to happen.
It's Julie here. I have a little bit further questions on bringing the three brands together. Do you expect to have cross-selling? Are you going to have Caribou Coffee in Panera Bread, for example? Are you going to sell Einstein Bagels in a Panera, for example, or in a Caribou? How is that all going to work?
So I think the way to think about this is that we believe that these are three iconic brands with the unique roles in the lives of our customers. So we're going to be very focused and dedicated at ensuring the independence of these brands and make them the best version of themselves, respectively for our consumers, whilst leveraging the back end to really turbocharge growth across all three brands. But so I don't really see any cross-selling, et cetera, happening. We just want to delight our customers who are looking for those specific value propositions across each one of those individual brands. I think the good thing is that these three brands are very complementary. So Panera leads on lunch, Caribou Coffee leads on coffee, and Einstein Bagels leads on breakfast. So they're very complementary, synergistic, and we plan to grow them faster by leveraging our unique competencies at the back end.
Yeah, Naran, I was thinking about the different day parts, as you guys will call them, that they fit into, and it seemed to me as a portfolio of, if anything, maybe skewed slightly more towards the morning hours with the coffee and the bagels together. And I'm curious how you guys have seen that part of the business. We hear from a lot of competitors in the fast casual space that they're all very interested in breakfast. They want to make more breakfast investments, but certainly with these three already have a strong foothold there. How have you seen that specific day part as a growth area?
So I think the pandemic has been transformational in the way in which consumers are accessing brands, as you can imagine. And interestingly, lunch has had headwinds. Even breakfast has not been that strong as it was before. The day part that has really exploded has been the dinner evening day part for families at home, working from home, and the weekend day part, interestingly. So therefore, over the last year or so, we have not only protected and strengthened our breakfast and lunch day parts, we have gone very aggressively for evening, end of the day family meal solutions. At Panera Bread, we launched the flatbread pizza, and we launched warm bowls as a meal solution for families for the evening day part or for the weekend. And we partnered very quickly with third-party aggregators so our consumers could access our offerings for that additional day part is the evening day part. So I would think that probably Panera Brands is a unique combination of brands that have relevance across all three day parts, not only breakfast and lunch, as you mentioned, but we are seeing tremendous tailwind and growth in the evening day part as well.
When your parent company purchased Caribou in December 2012, it had about 610 stores at the time of the deal. Now, about 713 or so. Why hasn't growth there been faster in terms of store base? And is that chain profitable?
That chain is profitable. In fact, all of our three brands, the brands are strong, the model is profitable. And I think coming through the pandemic, we have actually become even stronger, all three brands. The brands are stronger, the model is stronger. We're looking at asset-light models go forward across all three brands to accelerate growth even faster. So these are smaller box stores with fewer seats, more off-premise orientated, more digitally fired up, so that we can really serve our customers in the best possible way as they emerge with these fundamental changes in the way in which they're accessing these brands. So yes, all three brands are profitable, they're doing extremely well. And I expect that with this creation of the platform, the growth of both Caribou and Einstein Bagels will be much faster than it may have been before.
You know, I believe I went to a Panera last week, and it, like many other fast casual chains, had a hiring sign. What have you guys been doing in terms of wages? Have you been raising wages? Have you been having trouble finding people?
Yeah, that's a real challenge out there. It's very hard to find workers, as you know, impacting not only our cafes, but also our supply chain. They're also facing the same challenges. So just to give you a sense of how large that challenge is, we've had to hire 10 to 12,000 people in the last 2 months. Now, we've successfully been able to do that, but it continues to be an uphill task. And then also you want to hold on to the employees that you're hiring. So yes, we have moved very quickly on relooking at our entire value proposition for our associates, be that wages. So wages range up to $15, depending on where you are in the country, free meals, additional benefits, career progression, clear career paths for our associates. So it's centering our value proposition. And fortunately, I think our brands are very well regarded by employees as being great places to work. So we are able to find them, but it is hard. I'm actually thinking that maybe this is a short-term friction between demand and supply, and hopefully things should settle down over the next few months.
Just looking at the competitive environment, we've seen really eye-popping sales growth this year. Chipotle, McDonald's, the pizza players. Have you lost any share in your brands?
We've actually gained share. I mean, we have this black box index that we track. And I think we got quite badly impacted by the pandemic. About 12 months ago, we lost half of our business. But we have not only fully recovered to pre-pandemic levels, we're growing even much faster on top of that and gaining market share over the last several months. Like I said, primarily as a result of the pivots we've made, redefined ourselves. We are relevant not only for breakfast, lunch, but also dinner. We are more accessible not only for on-premise, but also off-premise. You can access us not only in digital ways, but also in the cafe, et cetera. So broadening the relevance of the concept, making it more and more accessible, has given us tremendous momentum across all three brands as we're recovering from the pandemic and moving forward.
All right, we'll leave it there. Really appreciate the time this morning. Panera Brands CEO Neeran Chowdhury, congratulations on the combination. I know we'll be in touch as you guys continue your journey here. Thanks for the time.
Thank you very much.
All right, coming up, we're going to take a look at what's moving markets on this Monday morning. Got a mixed picture here. Dow off some 28 basis points, almost 100 points. NASDAQ is currently trading in the green. Back with more on all of that coming up right after this.
Let's check in on Washington now. Democrats releasing their $3.5 trillion budget plan this morning. This as we've got infrastructure going on. We have talk about the debt limit going on. Jessica Smith is here with us to wrap it all up. Jess?
Hey, Julie. Yeah, Senate Democrats did release that $3.5 trillion budget plan this morning. This is laying the groundwork for that reconciliation package. So the rest of President Biden's agenda that he was not able to get done through bipartisan talks on the infrastructure plan, which, as you mentioned, is still working its way through the Senate. Now, the Senate budget plan is going to include universal pre-K, 2 years of free community college. It extends the child tax credit. It has a slew of measures designed to fight climate change. It expands Medicare and the ACA. It has paid leave, workforce development and job training, and much more. So a lot of the human infrastructure that President Biden has wanted to get done, and how the Democrats plan to pay for it: increases on corporate taxes. It says international tax reform, tax increases on the wealthy, ramped up IRS enforcement, healthcare savings, and a carbon polluter import fee. Now, in a statement, Majority Leader Schumer did say that Democrats with control of the Senate will use reconciliation to benefit the working class, not the billionaire class. Now, as soon as they do wrap up talks on infrastructure, as soon as the Senate is able to pass that bill, which could happen as early as tomorrow, unless they all agree to move faster on that, and then they will move for this budget resolution. Majority Leader Schumer has noted that this could change. This is just really starting the debate on this. The final reconciliation package could change, but this is a big first step to get that done. He has said he wants to finish this before they leave for the August recess. Guys?
We shall see. They have set goals before, so we'll see if they meet this one. Thanks, Jess. Appreciate it. Coming up next, more on today's market action, plus what we're watching this week. Stay with us.
All right, welcome back to Yahoo Finance Live on this Monday morning. Mixed picture here in the markets for the major averages as we get today's trading underway. Let's go over to Yahoo Finance's Inez Ferre for more on today's action. Inez.
And Miles, let's take a look at commodities, specifically oil, WTI and Brent crude under pressure this morning, down more than 3.5% for each. This is because of a couple of reasons. You've got the Delta variant, you've got concerns about that, and also you've got some data coming out of China with respect to imports, which missed estimates. Exports slowed in the month of July. So that's why you're seeing some of this pressure on oil because of concerns over a slowdown. Now, WTI last week was down about 7%. So the big story there is oil. Taking a look right now at the NASDAQ 100, we are looking at some of the outperformers. Moderna up more than 9%. Tesla up 2% on that Jefferies upgrade. And then looking at what's happening on the Dow retreating from its highs from last Friday. We're seeing a bit of a mixed picture here, but we've got Merck that's in the green, Walmart in the green. And if we just take a look at the sector action right now, we can see that healthcare, financials is in the green, energy is underperforming, as well as industrials. Thus, you're seeing a little bit of pressure there on the Dow. And then finally, just looking at some of the meme stocks today, we are watching for AMC up more than 1.5%. AMC will be reporting earnings after the bell today, guys.
All right, Yahoo Finance's Inez Ferre with a look at what's going on in the markets. And one name, Brian Sazi, that Inez mentioned there, Tesla up about 2% on that upgrade. I know had your attention earlier on
Tesla
in the program.
Certainly always very much excites me. It is the top trending ticker right now on the Yahoo Finance platform. Getting some bullish comments out of Jefferies this morning, looking for Tesla shares to potentially rally another 22%. The play seems to be there. Tesla is just going to continue to be Tesla, pumping out those cars that everybody's going to buy. Not me, but everybody else.
Well, and more profitably so. Jefferies is talking about the ability of car makers to boost margins. And so it's interesting that, this was not something that Tesla is good at making cars now.
You want the market research? I am seeing Teslas everywhere. I've seen more Teslas over the past 3 months in my life than I've ever seen before. They're all over the place.
I'd hope so. It's like a $900 billion.
Yeah, well, yeah, hopefully, right? Well, usually I thought they were just confined to the coast.
Sorry, $700 billion market cap.
You know what you're not seeing anytime soon?
What's that?
Lordstown.
Oh, no.
Lordstown this morning saying in a filing that Workhorse had sold off part of its stake in the company. I guess Workhorse was an early investor in Lordstown. There's some
there was some co-mingling there.
Spackergies.
Yeah, that now former CEO of Lordstown, Steve Burns, he waved goodbye to the company he basically pretty much destroyed. He founded Workhorse. Workhorse took that stake in Lordstown. Workhorse now selling $79 million worth of its stake in Lordstown. Why? Because it makes sense. It's not clear that Lordstown will survive, and if they do survive, will they ever actually get electric vehicles to market? Really, really unclear.
Yeah, and the Lordstown Workhorse, then you look at the Golden Nugget and the DraftKings deal, and we were talking to the folks, Mark Lipschultz and Michael Reese over at Blue Owl, and I think the SPAC structure, there was never anything inherently wrong with the SPAC structure, and it's still a totally fine, good structure. It's an efficient structure, in many ways, and we are starting to see, to some extent, a maturation, I think, of the SPAC market. Now, granted, these guys are running a SPAC. They would agree with that. They think that that's what's happening, but Lordstown's at 5. Or 6. It came public at 10, right? Pretty much everyone's lost money on that thing. And it certainly, Lordstown and Nikola and some of these others, they certainly give the whole space a bad reputation. But I kind of look back at, the group of SPACs that I had created in this, Yahoo Finance portfolio. And I'm now realizing I have to take some time and rework this thing. I feel like there's a lot more here than just, you've got the Chamath SPACs and a couple other hangers on and they all mooned and then they all crashed. And, now we're getting into maybe the more boring part where you do some work, you say, this one's actually doing this, this was a fake company, and so on and so forth.
Hippo got slaughtered.
Okay, there you go. It would be really interesting to see the list of all the SPACs that we have seen and putting them in those different buckets, including the ones that have not been able to buy anything.
Right.
Because there are some of those on the list also.
Yeah, and it goes, what was one of our first conversations in today's program was Warren Buffett, what he's buying, what he can't buy. I mean, you do the math on how many SPACs there are out there, how much money they have, how much money private equity has to deploy. There's not enough businesses. The math does not add up. So there's either going to be uncalled capital commitments from private equity, which is certainly going to happen. That happens. That's not a big deal. And then there's going to have SPACs that redeem, because you cannot come up with enough businesses that are of a quality and size such that you would be able to get something through. And a lot of the really, let's call them more speculative, wishful thinking type companies, many of them have come public. We talked to a lot of different ideas, let's say, companies over the
nice way of putting it.
They had some very big pie in the sky ideas, but weren't making any money. And like a lot of that bid has already been hit. So it'll be interesting to see how the space continues to grow into itself in the years ahead. All right, it's going to do it. On behalf of Brian and Julie, it's going to do it on this Monday morning. Zach Guzman picks up our live markets coverage for the next couple of hours coming up right after this break.
Welcome into Yahoo Finance Live as we cross the 11 a.m. Eastern Time hour. I'm Zach Guzman. As Kiko is out today, going to be running you solo through the trading session in our hours. As you see, the Dow pulling back more than 100 points here. The S&P 500 in the red as well. The NASDAQ, the lone index, in the green. Overall, they're retreating a bit to start the week as oil prices dipped to 2.5-month lows on global demand concerns. As the Delta variant continues to spread, we're going to dig into that supply and demand picture later on in the hour. Plus, unfinished business dragging on in Washington as the infrastructure bill continues to get pushed back. Now, Treasury Secretary Janet Yellen also pressing hard to raise the debt ceiling through regular order, asking Democrats and Republicans to come together. We'll have the latest there on both fronts. And back to school in the COVID era all over again. In our Back to School series this week, we'll profile how teachers and staff are gearing up to get back in the classroom safely. One superintendent from Iowa will share his struggle on a local level, given mask bans and contact tracing cancellations, coming up in just a few moments. But first, another busy week with an updated inflation reading on deck, along with closing innings of earnings season with a big name on deck this week as well in Disney. Maybe you heard of that one. Yahoo Finance's Emily McCormick is kicking us off today with a look ahead, as always. Emily?
Well, Zach, as you mentioned, lots for investors to be keeping an eye on this week. More earnings results and economic data are all slated for release. Now, we did get that JOLTS job openings report out this morning, those at a record high of more than 10 million for June. Now, some of the most closely watched economic reports out later this week will be on inflation, as that debate about how transitory these price increases end up being is still at the forefront of investors' minds. Now, the Labor Department's Consumer Price Index for July is due out Wednesday. To help add another data point to that debate, that headline CPI is expected to come in at 5.3% year on year, down just a tick from June's 5.4% year on year increase. Now, core CPI, which excludes volatile food and energy prices, is expected to have risen by 4.3% in July over last year, to pull back just slightly from June's 4.5%, which had been the fastest pace we've seen in 3 decades. Now, what's really going to be important to watch are those categories of goods that are contributing to these price increases, since a lot of those have been directly tied to reopening behavior and might be starting to lessen in terms of the extent of these increases we've been seeing, like used car and truck prices, for instance, as well as some of those increases in airline fares, as well as apparel prices. Now, a couple other data points to keep an eye on. Of course, we will be getting the producer price index out on Thursday as well. That is also expected to be highly elevated, coming in at 7.1% year on year, slight deceleration from the record high of 7.3% we saw in June, but again, still a historically high reading. And then finally, want to highlight a couple of key earnings reports that we should be keeping an eye on. Of course, after market close today, we have AMC Entertainment, Smile Direct Club, Planet Fitness, and then later this week, we have names including Bumble on Wednesday and DoorDash, Palantir, as well as Disney on Thursday. And that last one is one I'll definitely be keeping an eye on, Zach, since we do have the sort of dual businesses for the reopening trade, as well as the work from home trade with Disney Plus, as well as the parks business. But overall, a pretty strong earnings season we've been seeing for the second quarter so far. Potentially, we will be extending that into this week. Zach?
Yeah, those beats in the current quarter, that has been the trend. Of course, revenue guidance, always the big question. Investors have been digesting that as earnings season rolls on. Emily McCormick, appreciate that. I want to turn to the broader market here as we look at the updates we've gotten today. Of course, Friday's job report came in stronger than expected. The update in terms of job openings out this morning, and the JOLTS survey showing that for the month of June, did see a more than expected job openings added, up to more than 10 million now, from 9.4 million roughly last month. June pace of hiring also rose 4.6% versus 4.2% in the month prior. So for more on where we sit currently in this recovery, particularly when it comes to the labor front, I want to bring on Daniel Morris, BNP Paribas Asset Management Chief Market Strategist and co-head of Investment Insights Center there. And Daniel, appreciate you coming on here to chat. Obviously, a lot of questions about where we sit when it comes to the labor market, but what does the latest reading give you there to digest on top of what we got on Friday? Seems like all things considered, the recovery is still strong here on the labor front.
Definitely strong. Looking for another couple months of close to 1 million in job gains. As the Fed sees that, then I think we can really anticipate that we're getting closer to the taper time. But we're not there quite yet. And I think the message that we got from the non-farm payrolls data and from the JOLTS is that on one hand, the economy is quite eager for people to come back to work. It's just whether or not they're going to be able to. And that's really where what's happening with the Delta variant with COVID becomes important. I mean, we certainly focus on the infection rates as we have over the last year and a half. But on one hand, that's relevant, but really we need to think about what the government response is going to be if infections continue to rise. I mean, clearly governments have changed their response function, their reaction function to the pandemic over time. They're trying to get better at managing or controlling the healthcare aspect while also not hindering too much the economy. And it's that balance that's really going to determine how we progress from here.
Yeah, you mentioned the tapering timeline that everyone's trying to figure out there at the Fed. You know, it had seemed maybe some pull forward in terms of that timeline coming up as some of the indicators had been running hot. But you mentioned the Delta variant. The more that drags on, you know, as good as the JOLTS numbers are here, a bit lagging. So, I mean, when you look ahead, the kind of impact that it could have in terms of companies delaying their pushback, even, you know, return to the office, we're seeing pushback from a lot of places from September to October at the earliest now, if all things kind of level out here. I mean, how does that impact maybe what the Fed thinks about their timeline?
Well, I think that's exactly it. If you kind of imagine all the enthusiasm that we had at the beginning of the year with the passage of the stimulus package, anticipation of all the big infrastructure packages, and kind of thinking, oh, we have the vaccines, things are only going to improve. And needless to say, it hasn't gone quite that smoothly, and that kind of trajectory, the slope, certainly has declined as we kind of come up to these hurdles that we're having to face now, and that's what the Fed's certainly keeping in mind. So I think at this point, it's going to be wait and see what the data tells us. If we can get another couple more months of this really strong job creation, at the same time, hopefully we'll see in the US a pattern similar, frankly, to what we've had in the UK in terms of infection rates falling, given that the vaccination rates seem to be sufficiently high. You know, that's going to be kind of our best case scenario. If we get that, sooner talk about tapering. But I think we've all learned at this point not to be too optimistic when it comes to the pandemic.
Yeah, and then maybe that's a good reminder, too, as investors are kind of trying to weather the storm here and figure out if now's a good time to start to get defensive. I mean, when you look at allocations right now and kind of where we sit for the rest of 2021, what would be the advice there in terms of the best way to navigate this? Because you have some people saying, look, this looks like a lot like what could have happened earlier in the pandemic when the market misjudged maybe how well things were going to happen on the case front and hospitalizations front. Obviously, cases rising much quicker than hospitalizations here, but we're getting close to where we were before. I mean, how do you suggest investors navigate it now?
Well, our view has been to actually dial down risk over the last month or so. Broadly speaking, still have an optimistic outlook in terms of risk in general, equities in particular. I mean, we don't want to forget the fact that earnings are rising, and fundamentally, that's what equity markets care about. Again, if they rise quite as quickly as we had hoped is a somewhat different question, but they're rising. In terms of the timing, though, given the concerns certainly we have with Delta, the uncertainty around that, given the very strong run we've had in equities for a while now, we're a little bit more cautious at this point. So modestly overweight, but anticipating perhaps an opportunity to increase that overweight at a lower price.
In regards to kind of digging into the best opportunities there, though, I'm thinking back to kind of the strangeness. Some people watching the show might have been confused earlier on in the pandemic why some of these beaten down companies, cruise lines, levered to leisure and travel had actually fared pretty good because people were looking ahead to the recovery. Now seems like a very similar moment in time. So when you dig into those things on a sector by sector basis, how do you see that breakdown now?
Well, I think that's really the dilemma. If we look at when the market initially sold off last spring, and you were able to get those companies at very good valuations, they've rallied so much that's a bit less the case now. So within, say, the value and the recovery plays, we're kind of looking for those opportunities if the market becomes, again, very concerned around COVID and the prices fall, even given that we think ultimately there is going to be that recovery, that might be a good time to add up on those names. I think what we have to think about on the growth front, if we do get an increase in treasury yields that, frankly, most people have been expecting for quite a while and we haven't seen, but if that happens and if it is driven by an increase in real yields, which is also what we anticipate, then on the flip side, you've got to wonder how the growth stocks and particularly tech stocks are going to react to that environment. So I think it is very much kind of picking the right moments and trying to anticipate particularly where you're going to see the move in interest rates.
All right, BNP Paribas Asset Management Chief Market Strategist, Daniel Morris, appreciate you taking the time here to chat with us today. Be well. I want to shift over to the other headlines we're watching play out in Washington, D.C., of course, already keeping you abreast of the situation when it comes to those crypto amendments, kind of snagging the process to get the infrastructure bill across the finish line, but also the updates in terms of what Treasury Secretary Janet Yellen thinks about the debt ceiling and debt limits there, asking that to be passed through normal order. And Republicans and Democrats trying to get them to come together. For more on all those things out in D.C., I want to bring on Yahoo Finance's D.C. insider here with us, Jessica Smith, to bring us the latest on that front. Jess.
Yeah, Zach, this morning, Treasury Secretary Janet Yellen wrote members of Congress urging them to work together and either raise or suspend the debt limit in a bipartisan way. Right now, Republicans say Democrats should do that on their own. They should do that through the reconciliation process, they say, because Democrats want to add even more to the debt. But Treasury Secretary Janet Yellen said that they need to do this as they typically do, including 3 times during the Trump administration, and that is through a bipartisan way with Republican and Democratic votes. She notes that raising the debt limit does not enact new spending, but it allows the government to pay bills, pay expenses that Congress has already enacted. She went on to say the vast majority of debt subject to the debt limit was accrued prior to the administration taking office. This is a shared responsibility, and I urge Congress to come together on a bipartisan basis as it has in the past to protect the full faith and credit of the United States. She says failure to act will cause irreparable harm to the U.S. economy. And again, Republicans are wanting Democrats to do this via reconciliation. But this morning, we got to look at their $3.5 trillion budget plan, and the debt limit is not addressed there. So that is going to set up a fight in the fall as they try to get 10 Republicans to vote with them to act on this. As for what is in that budget plan, it does have universal pre-K, 2 years of free community college. It extends the child tax credit. It expands Medicare and the ACA, and it has measures to fight climate change. Democrats want to pay for it by raising corporate taxes, reforming the international tax code, tax increases for the wealthy, ramped up IRS enforcement, in several other ways there. But that really lays the groundwork for their reconciliation bill, the rest of President Biden's agenda that he's been trying to push, that human infrastructure. And Democrats say they're going to move on that as soon as they finish the bipartisan infrastructure bill. But again, it's very notable that the debt limit is not included in that plan. Zach.
Yeah, a lot to watch in D.C. this week. Still waiting, too. The infrastructure bill, bringing it deeper into those crypto amendments in the 12 noon hour here. But Jessica Smith keeping us updated there. Appreciate that. I'm going to take a quick break here on the show. But when we return, digging into the moves we're seeing play out in oil today, that sector clearly the biggest laggard, off by a factor of 4 to claim that so far in the session, as demand worries now rear their head once again as the Delta variant rises. Particularly China may be pulling back. We'll break that down with a guest who leads one of the largest private oil companies here in the U.S. So we'll break it down on the other side. Stay with us. Welcome back. I want to spotlight the moves we're seeing play out in oil prices today as we're seeing crude prices fall to nearly their lowest levels we've seen since May. Paired those losses a little bit here in the session, only off by about 2.5% there, but a lot of questions around Chinese demands, the world's largest oil importer here, in the wake of COVID cases rising around the globe. And for more on that, I want to bring on Dan Eberhard, the CEO of Canary, one of the largest private oil field services companies in the U.S., of course. And Dan, good to be chatting with you again. I mean, we talk about the supply and demand picture, always difficult to suss out given kind of the stop-start of this recovery. But how do you maybe look at that right now as we see prices under pressure?
Well, I think the danger to watch is the OPEC plus increase of 550,000 barrels a month. Is that going to keep coming on the market despite the increasing uncertainty surrounding the demand side as a result of the Delta variant? It's really got the market in a bit of flux. Last week was the worst week for oil since October, and I think we've got to watch that. But I think rising demand in Europe, rising demand in the U.S. is really going to more than counteract for that. But implicit in these numbers is a Chinese growth rate in the 6 to 8% range. So if that doesn't materialize, then we're going to see oil fall further.
Yeah, I mean, I remember talking about this, way earlier on in the pandemic when we were first seeing kind of demand bounce back. You kind of picked Chevron as one of the companies you liked in the space. Yeah. And you mentioned kind of the U.S.'s strong rebound here, and obviously the demand has still kept up. I mean, what's your assessment, too, about kind of how the U.S.'s role here, particularly when it comes to, the oil patch here in the U.S. catching up and maintaining its output as we've seen prices come up? What do you kind of see on that front in the way that it's all shaken out?
Sure. I think we're seeing continued demand tightening in the U.S. Look, the pre-pandemic February 2020 supply numbers in the U.S. were about 13.2 million barrels a day. That dipped to 9 million something and is now back to like 11.2, 11.4 million barrels a day. So we're still 2 million barrels a day below where we were February 2020. The rig count has recovered a little bit, but not much, and is still kind of hovering in the 450s. So the U.S. has not put all of the demand back, but the economy is back and more. So I think in the U.S. we're going to see continued tightening. I think the spread between Brent and WTI is going to close as we move throughout the year. And if I'm a U.S. producer, I think the market's looking pretty rosy for me right now.
What do you think about maybe shifting policies? I mean, we've talked a lot about what President Biden had planned when it came to energy, but when you think about the mix and the U.S.'s leadership there in terms of what we've been able to do in production back here at home, I mean, what do you think about maybe what you'd expect to see when it comes to the White House and their initiatives on the energy front, maybe changing a bit?
Well, look, I think the White House came out of the gate with the promises they've made to the progressives on the green energy movement. And I think a lot of what the White House says is aspirational, and it's where we want to grow as a country. We all want cleaner water. We all want cleaner air. But I think that when it comes to paying for it, and when you ask consumers if they're willing to pay double or triple for the price of energy to have an anti-fracking agenda or to have, marginally cleaner air, I think the answer is a bit more muted. So I think the White House may actually have to take a step back as energy prices rise and reassess some of this stuff and cool down their rhetoric, or let their rhetoric just kind of stand there as they pause a little bit and try to keep the costs going up, the energy costs for consumers from rising even further.
Well, I mean, that's kind of where it hurts the most when you think about American voters weighing in on all this. That's we're seeing the price at the pump here above $3 a gallon. That was the most that we've seen there in more than 6 years. And you talk about that, how it might play out in supply and demand picture here in the U.S. I mean, what does that maybe say about the abilities to get through the oil we're talking about here and what you expect to see at the pump?
Well, again, I think the U.S. hasn't put back about 15, 18% of the supply we haven't put back in the market, yet the economy is the same size, and we really haven't gotten that much more efficient in the last 15, 18 months at all. So I think you're going to continue to see a pressure point. I think there's kind of an oil boomlet going on. You're going to see oil exit the year 85 plus, I think, based on the fundamentals I see right now.
I mean, how does that change that? Because we always talk about the summer travel months being a hot time for travel. Maybe, not as hot traditionally as it's been in the past, given all the circumstances here. But how far much lower do you think price at the pump could come down later on as we move past that period of travel?
Well, they could fall a little bit, but I really don't think there's a lot of excess supply in the market. I think that the price at the pump could fall marginally in the 10 to 15% range. But I really think we're going to exit the year slightly higher than we are right now based on macro demand considerations in the U.S. Remember that the U.S. hasn't put all the supply back in the market. So I think that, there's really not a lot of slack in the system, and there's going to be a lot of pressure that's going to keep oil prices relatively buoyant as we move through the back half of the year into the fall and winter.
All right, Canary LLC CEO Dan Eberhard, appreciate you coming on. Always good to chat with you. Be well. Chat soon. Going to take a quick break here, but when we return, digging into the big push here at the NASDAQ to try and increase the diversity that companies have on their boards, similar to a step California took. We'll break down the impacts of that. And plus, before we go to break, I want to remind you to step up your investment strategy here with a 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. You can check that out today at yahoofinance.com/plus. Welcome back to Yahoo Finance Live. On Friday, the SEC approved a pretty big key initiative here to increase, or at least a bid to increase diversity for companies listed on the NASDAQ. And that is a rule that would ensure company boards at least try and make the best efforts to up their diversity requirements here, with the goal there for companies who don't at least have one woman director in addition to another board member of diversity background, which could include someone who self-identifies as a member of the racial minority or the LGBTQ community. If they don't do that, they have to file as to why they didn't and weren't able to do so. And for more on that, I want to bring on the CEO and co-founder of Charter, Kevin Delaney, joins us once again. And Kevin, I know you speak with a lot of leaders at companies out there, but this is a push, that's coming from an area of fact. A lot of these boards generally are not as diverse as some people want them to be. So talk to me about how big of a step this is.
I think it's a big step, and there are two reasons for it. The first one is that boards today are increasingly diverse, but they're still not super diverse. So if you look at the Fortune 500, 80% of board members of Fortune 500 companies are white, and 73% are men. And so that's a long way from actually reflecting the demographics of this company. The NASDAQ rule gets us, just sort of increases the pressure there. And we've seen in California where there's been there was a 2018 law, as you mentioned, that required woman representation on California companies' boards, that actually has made a significant difference. The second way in which this is important, just at a very basic level, it requires NASDAQ-listed companies to disclose the racial and diversity makeup of their board, which is actually something that there's not consistent disclosure of currently.
Yeah, I wonder too, when you talk about that in the California law that was able to kind of maybe start and spark some changes here, it came with penalties. There are six-figure penalties for companies that weren't able to do so. When you think about this, I wonder if maybe just the filing of why a company wasn't able to hit these diversity goals is going to be enough to really influence the change.
I think that's a good question, a fair question. In California, as you mentioned, the penalties range from $100,000 to $300,000 for if a company doesn't actually comply with with having a woman on their board. And the NASDAQ rule, as you say, only requires companies to provide a written explanation if they don't actually comply. The bet, I believe, is that shareholders this will increase pressure from shareholders and kind of publicly shame companies that aren't doing anything here. I think that we are seeing, increasing shareholder pressure, including institutional shareholders that are actually voting against companies for not having diverse boards. We've seen big companies like BlackRock and Vanguard actually starting to vote against directors when there are no diverse members of the board. And so it's hard to know exactly, but my guess is that just having this information and shining a light on it actually will bring some pressure for companies to try and avoid those scenarios.
Yeah, there's some pushback from some people on the other side of the issue. I'm thinking about Republican Senator Pat Toomey, who says it's too much for the SEC to be implementing something like this, approving it. But we'll see what happens. It's a very interesting push, now kind of mimicking what we saw in California. But Kevin Delaney, Charter co-founder, CEO, appreciate you coming on here to chat with us. I'm going to take another break here, but on the other side, breaking down the latest headlines we're seeing play out across the country and indeed the globe when it comes to COVID cases here in the U.S., back above that $100,000 level. What Dr. Fauci is saying the latest timeline is for booster shots and full FDA approval. On the other side, stay with us. Welcome back to Yahoo Finance Live. As we're watching COVID cases across the U.S. increasing on a daily basis, pretty shocking when you think about the numbers here. The first time since February, back above that 100,000 daily case count, more than double the tally we saw just 2 weeks ago. And given all that, more attention is being paid to the timeline that Dr. Fauci is laying out for not just booster shots, but also full approval when it comes to some of those vaccines. And for more on that, I want to bring on Yahoo Finance's Anjali Kamlani, who has the latest for us there. Anjali?
Thanks, Zach. Yeah, as you mentioned, really concerning case rises. And while we know that a majority of those, especially for the cases that are from vaccinated individuals, are low and not severe, we are watching those severe and concerning cases rise, especially in states like Florida and Texas, causing a lot of questions and concerns about what to do about these state level rules, almost like a repeat of last year. And Dr. Anthony Fauci did say over the weekend that he is hoping that the approval for the Pfizer shot specifically comes very soon. Listen to what he had to say. So he really did talk about the fact that there was that they are looking to the FDA approval, really in light of no vaccine approved just yet, and that will give the legal pathway for individuals and for companies that are looking to maybe mandate, especially school districts now in question. We know that in Florida, school districts are being threatened for defunding for any sort of strategies to employ either mask mandates or vaccines or et cetera. And so a lot of that is really going into play right now. So really concerning. Really hope, a lot of people are really hoping to hear some good news about this approval soon. And once Pfizer goes through, then Moderna will also follow through. So there'll be multiple shots, likely by the next quarter, that are approved here in the U.S. Back to you.
Yeah, Anjali, I wonder too, I mean, we heard so much about kind of that pushback in terms of whether or not the FDA approving the vaccines fully is going to impact anyone's decisions who may have been waiting to get it and maybe potentially even not change those decisions at all. I mean, where do you think that sits when you think about Dr. Fauci and kind of what he's trying to do to boost vaccination rates here in the U.S.?
Yeah, there's a lot of discussion actually about, so first of all, on just getting vaccinations out there, really, ground level stuff, ground level efforts, whether it's connecting with clinics or doctors. Now that the supply has gotten so relaxed, they're really looking at some of these efforts. And then on the booster comment, they're eyeing a little bit more. There's been some reports of more focus on immunocompromised or seniors to get those boosters first, so that not only do we balance the idea of the global supply and the needs there, but also ensuring that the most vulnerable are able to get access here at home. So a lot of discussion right now on that front, and no decision necessarily in the imminent future, but it's kind of a race once again between whether or not they will get that booster out there first, or whether or not the full approval will come through. So those are some of the things that they're looking on right now.
Yeah, and still, obviously, kids under the age of 12 still waiting for that approval as well. We're going to be digging into the issue around schools a bit later in the show. But for now, Anjali Kamlani bringing us the latest there. Appreciate that. I want to turn back to the broader market here, though, as we're seeing the Dow pare its losses as energy continues to lead to the downside. And for more on the moves we're seeing play out, I want to bring on Yahoo Finance's Ines Ferre, who's been watching it for us today. Ines?
And Zach, taking a look at oil right now, we are watching WTI and Brent crude under pressure. You can see on our Wi-Fi interactive board right now, you've got WTI down more than 2.5%. It was down more than 3.5% earlier, though, and Brent crude down 2.5%. You've got a couple of things going on here. One of them being the Delta variant, concerns about spiking cases. The other one being also data out of China with exports slowing in July and imports missing estimates. So there is a concern about a slowdown in demand. And if we just take a look at a 6-day chart for WTI, you can see it's down about 6% over the last 6 sessions. Taking a look at the broader markets, as you were mentioning, the Dow now down about 0.2%, down about 73 points. It was down more than 100 points earlier today. And if we look at the sector action, we're seeing that energy and real estate are under pressure. You've got financials healthcare that are in green territory. And then the NASDAQ, you're looking at a little bit of a mixed picture. On the NASDAQ, the Tesla up about 2%. This is on Jefferies upgrade, Moderna up 11%. Zach?
All right, Ines Ferre breaking down the latest moves for us. Appreciate that. Going to take another break here on the show, but when we return, digging into the challenge facing school superintendents, teachers, parents, as anxieties continue to rise around the Delta variant, as it's a bit of deja vu, trying to make classrooms as safe as possible. We'll chat with one superintendent facing that firsthand in Iowa, as masks are still not allowed to be required in schools in that state. He'll join us on the other side of the break. Stay with us. Another back-to-school season is upon us. It's a stressful time for administrators looking to reopen schools safely. And it's a bit of deja vu for officials who are trying to keep students safe. We've already done this before, but also might be burdened this time around by state laws that ban schools from requiring masks. We've seen those laws put in place in Florida, Texas, Iowa, and others. And for more on how that's impacting things this time around, happy to bring in Mark Lane, Superintendent of Decorah Community Schools in Iowa. As part of our series looking at the state of education as Americans get ready to head back to the classroom. Also have Yahoo Finance's education reporting Arti Swaminathan joining in on the conversation as well. And Mark, appreciate you coming on here. Just for background, you have a K through 12 district there, 1,700 students, and now with the tricky position of trying to make sure everyone's safe while masks can't be required. How is it going this time around to keep everyone safe?
I think it's going as well as it can, given just the nature of the virus. We know things can change quickly, and so it's been really key for us to just stay abreast of the best information at the time. I feel lucky that we've had a great partnership with our local public health, Winnebago County Public Health. The executive director of our county board of health is actually one of our school board members. And so having that connection between public health and our school district has been very beneficial in just understanding the current state of the virus in our county, and then how we can best go about making sure our learning environments are as safe as possible.
Mark, can you tell us a little bit about whether if you have a vaccine mandate for teachers, and how is the sentiment like? Are a lot of 12-year-olds getting vaccinated? And have you seen are you worried about cases increasing as you lead up to reopening on the 23rd?
We do not have an employee vaccination mandate at this time. We worked with Winnebago County Public Health back in February and March and offered an on-site vaccination clinic. We worked with two local private schools. St. Ben's Catholic School is a K-8 school, and then Crossroads Academy is a special needs private provider that's in our community, and we offered a vaccination clinic for staff of all three organizations in February and March, and we had between 80 and 85% of employees take advantage of the vaccine at that time. Winnebago County in Iowa, there are 99 counties in Iowa. We're one of the 7 or 8 most vaccinated counties right now, right at about 52% of eligible vaccine recipients have been fully vaccinated, either with 2 shots if needed, or the one of the Johnson & Johnson. And so I think, people are taking their opportunities to be vaccinated. And as we've approached school, I think more and more families are considering if their children are eligible, getting that vaccine.
Mark, what would be the situation in which you would have to shut down the school? Because we're seeing more and more school districts report hundreds of cases, especially with very young children. So what would be that red line that you would say, okay, let's just go back to online learning?
Yeah, I really, in Iowa, that is difficult to do at the time. We're required to provide some kind of a in-person option to families, and would need to go through an application process with the state in order to go fully remote. We started a year ago with back to school in-person learning. We started the year last year with a hybrid model where students were face-to-face half the time, and at home working remotely half the time. But most of the year we were full face-to-face learning. The instance when we did have to go fully remote for 1 week last year really was driven by a lack of adult supervision mostly. We just had staff quarantined because of exposures, and it was difficult to ensure that we had enough substitutes to ensure a safe learning environment and a productive learning environment. And that was the week after Thanksgiving, and we went to a full remote week that week. This year, I think a similar situation. I hope that doesn't happen where we're understaffed and just don't have the subs to do what we need to do. But I think that's the most common thing that has occurred in Iowa, is just when the adults are quarantined or isolated, that we just can't do business as usual.
Well, it seems like it's not just staffing you have to be concerned about, but also kind of resources across the board that have been cut in regards to kind of handling a potential outbreak as well this time around. I'm thinking particularly about the State Department of Health not offering to contact trace COVID cases this time around, leaving that up to individual districts. I'm not sure whether you guys have the staffing. It sounds like if you're already kind of struggling in the last peak around staffing for students, whether you would have the capabilities to kind of even add contact tracing to the plate as well. I mean, how hard is it without the resources there to really battle this?
We have 2 full-time school nurses, and really they were our frontline contact tracers last year. I think they did a phenomenal job. They did work closely with Winnebago County Public Health and the staff there. But for our students and for our staff, our nurses really were the primary contact tracers, and that was on top of an already busy work day for a school nurse. And so I believe we have the capacity, we have the knowledge of how we did that last year. I would hope that it's not as demanding with fewer cases that might need to be followed up on this year. But if necessary, our nurses will do what they need to do to make sure our students are safe at school.
Mark, how has it been like working with the teachers unions during this period of time, especially with, some subjects seeing a lot more staffing shortages than others? So how has it been like working with the unions?
We have a great relationship with our Teachers Association. The Decorah Education Association is committed to the same things we're committed to as a school board and as a district of high levels of learning, a safe learning environment. Our association, as we developed our original return to learn practices and plans, we had high staff engagement and high staff involvement in a number of committees. And so I think that engagement and that understanding of what we were doing, it invited people to have a seat at the table and feel like their voices were heard. Obviously, I think people were rattled in May when the law changed in Iowa, and all of a sudden we came to school one day and masks were no longer something that we could mandate as a district, and that was an emotional time. But given our experience, I think our association and our board are on the same page in working together to create a safe working environment, to create the safest learning environment we can. We want to make sure that people have the right information, that they have good information and timely information from the CDC, from the American Academy of Pediatrics, that we're putting that information out there, and then encouraging people to use that guidance and to help us create that safe environment.
Mark, just quickly, last question for you on what gives you optimism, because we're in a place where we don't know Delta variant, Lambda variant, all these different things, but what gives you the most optimism as you gear up towards reopening on the 23rd?
The thing that gives me optimism is students. I think about where we were at a year ago at this time, and some of the same apprehension, some of the same fear, some of the same uncertainty is there. Again this year, unfortunately. But then school started, and our students adapted. Our students were agile. Our students adjusted. Our students worked with us. And I know they will do the same thing again, right? We as adults, we could learn a lot from looking at the kids in our lives and looking at the children around us. They are incredibly resilient people. They are incredibly positive people. And so the thing that gives me optimism is knowing that we'll have 1,700 young people in our schools in 2 weeks, that they will work with us to create another great school year. We had a great year last year. Some of the circumstances are different this year, but I'm really positive that because of our students, because of our staff, we'll have another great year. It'll just have different challenges than last year did.
Well, good luck in that goal there. Mark Lane, Decorah Community School District Superintendent, bringing us the latest there on the front lines as we get back to school. Appreciate the time. And of course, our thanks to Yahoo Finance's R.T. Swaminathan as well. Later on in the show, we're going to be discussing a little bit more about the firsthand impacts. We're going to be hearing from the students themselves. But coming up, as earnings season rolls on, the latest update from the big daddy of them all, Berkshire Hathaway, reporting its latest quarter. We'll have the details on the other side of the break. Stay with us. Well, over the weekend, Warren Buffett's Berkshire Hathaway joined the ranks of companies that are able to show their businesses bounce back strongly in the second quarter. Berkshire reporting $28.1 billion in net earnings, up from $26.3 billion a year earlier. The conglomerate enjoyed a nice boost from its railroad, utilities, and energy businesses, which were particularly hit hard last year. And for more on the details there, I want to bring on Yahoo Finance's Julia LaRoche, who has those for us today. Julia.
Yeah, thanks, Zach. Certainly a recovery here for Warren Buffett's Berkshire Hathaway. And as you're just mentioning some of those results, we'll go through some of the other results that caught our attention. The top line revenue for the quarter coming in at $69.1 billion, ahead of this analyst forecast of $64.86 billion. And for the second quarter, Berkshire reported operating earnings of $6.69 billion, which was up 21% from the $5.51 billion reported just a year ago. And as you were mentioning, Zach, getting a boost from railroad, utilities, and energy, which saw those earnings rise 28% from a year ago to $2.26 billion. But insurance underwriting operating profit declining 53% in the quarter from a year ago to $376 million. And one of the things that's noteworthy when it comes to Berkshire Hathaway, it is a sprawling conglomerate with businesses across, retail, manufacturing, energy, services, you name it. Companies like Geico, See's Candies, Fruit of the Loom, Benjamin Moore Paints, BNSF Railway. I could go on. And then they have that famed equity portfolio with large multi-billion-dollar stakes in companies like Apple, Bank of America, Kraft Heinz, Coca-Cola. So it really kind of provides, Zach, a snapshot of the U.S. economy. And if you're looking at a one-year chart of Berkshire Hathaway, you can certainly see the recovery. Another area of note during the quarter, of course, are those Berkshire Hathaway share repurchases. Berkshire spent $6 billion on repurchases in the quarter, and in the first half of 2021, it's a total of $12.6 billion in share repurchases. I will note that pace has declined down from the $6.6 billion in the prior quarter and about $9 billion or so in each of the 2 quarters before that. This is something that Buffett often talks about in the annual letter, when they will make those share repurchases and when they feel Berkshire's stock prices trading below its intrinsic value, conservatively determined. So another area of note. And of course, what are they doing with that massive cash pile, which is still hovering just north of $140 billion? Zach?
Yeah, so many companies in that portfolio there. So much to run through, no small feat. Julia Roche doing it well for us today. Appreciate that, including my favorite too, the one that got me through the pandemic, Dairy Queen, also in that portfolio. Coming up, though, we're going to be discussing some less tasty things. The world of Bitcoin on edge as we continue to watch the back and forth in D.C. around the infrastructure bill, as 2 competing crypto amendments still are trying to get included in that battle. Some unlikely coalitions forming, and yet Bitcoin holding above that key $45,000 price level. We'll break down that on the other side. We're back in 2 minutes' time. Welcome in to Yahoo Finance Live as we cross the noon Eastern Time trading hour here in New York City. The Dow still under pressure a bit, though, paring its losses and now under 100 points. Just 64, as you can see there on the screen, the S&P in the red, but just slightly the NASDAQ, the lone index, in the green. And crypto prices holding up despite a lock-in talks, but potentially no longer, to fix part of the infrastructure bill that's set to hit the sector hard, or at least was. We'll highlight the latest there and how it's triggering an unlikely pairing across party lines. And self-driving truck company Plus forging ahead on its mission to deliver driverless trucks. Plus CEO David Liu will join us on its latest test in China that did not even have a human backup driver on board as the race to deliver autonomous trucking intensifies. But first, want to spotlight the moves we are seeing play out in Bitcoin, as we just got latest word there in DC that the two sides in competing battles there have now reached somewhat of an agreement here to kind of suss out the broker language that would have hit this crypto sector hard when it came to reporting requirements. You're seeing Bitcoin there catch a bit more of a boost here, close to that $46,000 price level. And for more on what we're seeing play out, I want to bring on our first guest in the hour, Chester Spatt, Carnegie Mellon University Tepper School of Business Finance professor, joins us right now. Professor, appreciate you coming on. I mean, I was just reading through kind of the update we got out of the Senate, and it's important considering the fact that we had one side here looking to really clarify the broker language to limit it to kind of centralized brokerages. The other side kind of introducing a bit more murky waters when it comes to what really is a broker. But it sounds like both sides have agreed to clarify that underlying text to ensure that those not acting as brokers aren't going to be sucked up into that definition. I mean, how important is this now as we move forward? And kind of how weird was it to see crypto snagging the overall infrastructure bill? Important to get this done now.
Well, I thought it was bizarre. I thought it was bizarre. I mean, crypto has almost nothing to do with roads, with roads and highways, and supposedly what the infrastructure bill was all about. Maybe it has a little bit to do with access in rural America to the internet, but even on that, I think not very much. But I think the broader point was that the politicians in Washington were looking for so-called pay-fors when those pay-fors weren't really there, as the Congressional Budget Office pointed out last week. The pay-fors were a little bit of a joke to create political cover for politicians. But it's sort of weird that they focused on crypto in the way Washington often legislates, which is that when there's a bill that's going to move, that's what everybody focuses on to jam whatever they want through that particular bill. And that's not because I have a particular view about how the crypto reporting ought to work, but it sure seems like a weird way to run our government.
No, I mean, I'd agree. It was a bit of a weird thing to include, especially given how complicated some of this stuff is, right? And we saw that basically in the way that two coalitions came together. On one side, you had Senator Lummis along with Ron Wyden and Pat Toomey. You had two Republicans and a key Democrat on one side. So it wasn't even really a political issue. These are people who understood how this works. At least Pat Toomey and Cynthia Lummis invested in the technology. On the other side, you had a key Republican along with two Democrats and the White House and the Treasury backing them up. So really kind of, I guess, revealing that some of this crypto stuff is not really Republicans versus Democrats here, but really technology versus maybe those who understand it. And this was compliance. To your point, you can put the pay-fors in there, but if someone can't actually comply with what you're requesting, as we saw, it's going to be impossible to make good on that additional revenue coming in here. So 1099s from brokers, that's kind of agreed upon here, and it looks like that's what we're going to get. So, I guess a win-win if you think about it.
Well, I think the concern previously was that the 1099s would have to be issued by developers to folks who are basically downstream from them, and that wasn't going to be a real feasible possibility, but was going to get in the way of important aspects of the development business.
Yeah, I mean, you used to work at the SEC too. We've talked a lot about maybe increasing regulations now. We know that the Treasury was kind of pushing for one side here to keep the definition of broker broad And I guess some of the skittishness in the crypto sector would have been that this was a big and clear push that they wanted to have a little bit more jurisdiction to kind of pursue some of this stuff. I mean, where you sit, given your background at the SEC, how intense do you think the specter of regulation is starting to get when it comes to maybe how they might reel in some of what they call, quote, quote, the Wild West?
Well, I think I think this is an important priority at the Treasury. But I think it is clearly an issue that's in the SEC's domain, and the SEC ought to approach it, in my view, in the traditional way it does rulemaking, through notice and comment and the like, which is an orderly process that provides opportunity for market participants to weigh in, rather than through some sort of artificial pay for at the back end of a must piece of legislation.
As you see it, though, too, I mean, just kind of speaking to the larger question of how Republicans, Democrats might start to fall, I mean, we're getting farther and farther along. Before it was kind of oversimplified discussions about is Bitcoin net good or bad, and now we're kind of starting to get into the technicalities of regulation. And I think it's pretty interesting to see how this coalition was kind of a mix. In your eyes, how are you starting to see maybe the key issues as Republicans and Democrats take sides here? What are you expecting to see as, I guess they have to, as it gets bigger and more people have money invested in this space?
Well, so I think it's healthy that Republicans and Democrats are agreeing, and in fact, here I would say agreeing to kind of disagree. That there are advocates for the various positions on both sides. But fundamentally, Congress is not in a very good position to understand technology. They're in a better position to understand what people whisper in their ears, and that's why my inclination would be to be somewhat more deferential to the notice and comment process of the SEC, which would be the traditional regulator in this space. But the Treasury in recent months certainly has been very aggressive in signaling that it's not happy with the current status of crypto.
Yeah, and the SEC clearly pushing for a little bit more power there too, and lobbying Congress as well. But to your point, we did see both sides here, all the companies in the crypto sector, including Coinbase, Square, and the like, really stepping up their lobbying efforts as they saw they were in the crosshairs this time around. But Chester Spat, appreciate you coming on here to chat with us today. Carnegie Mellon University Tepper School Business Finance professor. Thanks again for the time. We're going to take another quick break here on the show, but when we return, digging into the COVID case count that we see rise more than double over the last 2 weeks, what the concerns there are on the front lines. We'll chat with a doctor who is indeed doing his part on the front lines in 2 minutes' time. We're back right after this. Welcome back to Yahoo Finance Live. As we've been watching, COVID case count here in the U.S. in terms of daily cases continues to rise, now hitting above that 100,000 new case count a day. We haven't seen that since February. Total cases up by double from 2 weeks ago. And given all that, more attention being looked at in terms of the timeline that Dr. Fauci has laid out, not just for booster shots, but also full FDA approval when it comes to the vaccines already issued under emergency use authorization. And for more on that, I want to bring on Dr. Payal Patel, University of Michigan infectious diseases physician, joins us right now. And Dr. Patel, good to be chatting. Obviously, would wish it was under different circumstances here, but when we're talking about this rise in new case counts, I guess it'd be important to distinguish amongst those who are vaccinated and those who are not. And we've been discussing that hospitalizations among those who are vaccinated obviously continue to remain low. But talk to me about what you're seeing as maybe worrisome in this spike in cases.
Yeah, I think that unfortunately, a lot of hospitals kind of nationally are seeing more and more cases getting hospitalized. A lot of these folks, in fact, probably more than 90% of them have not been vaccinated. And as we get more and more full, you worry about, falling, breaking your arm, getting in a car accident. Those are all hospital beds that need to be there for people who don't have COVID. And so, it's really worrisome for the medical community to see this be happening again, especially when we have vaccines out there that can prevent hospitalization, can prevent death.
We've seen some reversals, too, including the one out of the governor of Arkansas, who said, over the weekend that his state law banning mask mandates was a mistake. We've seen those mask mandates in other states as well. I'm thinking about Florida and Texas. I mean, as you kind of look back at those decisions and where we're at now, how impactful do you think those were?
Yeah, I think, some of the conversation around that is, you have to be flexible as things change. And we've seen that the Delta variant has really kind of changed things for us. So I think in the science community, along with, the legislative community, it's really important to kind of be flexible as things change. Right now, masks are a temporary measure, right? So they're not going to cure the pandemic. It's really vaccines that are going to get us there. Masks are a temporary measure to help us control the spread, same as we've been talking about social distancing. When you're indoors trying to ventilate, trying to have a mask on if you're going to be around other people, that can prevent you from getting sick and unvaccinated people from getting really sick. But again, that's not going to be the final answer. That's going to be getting more people vaccinated.
When we talk about getting more people vaccinated, it is interesting to think about kind of the timeline that Dr. Fauci has laid out when it comes to full FDA approval there. Because if you do have a pandemic of the unvaccinated, it's kind of still overlooking those who have been vaccinated and might be getting breakthrough transmissions of the Delta variant. I'm curious to get your take on maybe how important or how helpful it would be to maybe get those who have been vaccinated booster shots, as we're talking about those, and how that would reduce the spread maybe from people who have been vaccinated to those who still have not.
Most of our research right now still shows that an unvaccinated person is probably much more likely to spread virus than a vaccinated person. And so as we think about boosters, that's really to stop even milder infections or perhaps someone who doesn't have as strong of an immune system from getting sick. So they're kind of two different things. So I think boosters are important to think about. People are doing the research, whether it's going to be perhaps people with transplants, immune compromised situations, elderly people who are going to need those booster shots first. That's being done. But we're really trying to focus on that N of people who haven't gotten a single shot. And I think some of the ways that the nation is trying to go forward there is, federal government trying to have the VA become vaccinated, other federal employees become vaccinated. That's going to really get at a lot of people who may be on the fence, not sure if they want to get the vaccine, and help reduce the spread.
Yeah, one thing too that we've been watching play out here is the back to school season. Obviously, top of mind for parents here as kids under 12 still not approved for vaccines. But when you think about maybe the masks not being used in school in some states and kind of where we're at with kids still being able to catch this disease and also, suffer some consequences here. I mean, how worried are you about the return to school given cases are moving in the wrong direction?
it's tough. We've had over a year to kind of learn about the spread of the virus, what can help to reduce that. And I'm really looking forward to those vaccines coming out for the younger population. That's going to, again, really be the final solution. But what I would say is if you're a parent and your child is starting, you want to see what is your school doing? Are they helping with ventilation? Are they talking about masks in the school? We know those things really do reduce spread. And until we get more kids vaccinated, we're going to have to rely on the things that we've known have worked in that last year.
Dr. Payal Patel, University of Michigan infectious diseases physician. Appreciate you coming on here to lend us your expertise on the matter. Thanks again. Of course, as we continue to profile the return to school, the back to school season, big question mark is safety in schools. And Yahoo Finance's Reggie Wade was able to catch up with a few students here to get their take on how they've been faring in this pandemic. And Reggie, the big question now as you kind of gear up to do this all again is how they're holding up.
Yes, Zach, I sat down with 6 students at White Plains High School in White Plains, New York, and we spoke candidly about what it was like to attend school during a pandemic. And despite the challenges and setbacks, the students are actually hopeful about the future.
I think COVID-19 will be a generation divide, much like we would never know how it felt to be alive during 9/11. They will never know how it would feel to be alive during this pandemic. And I think they'll always be like in disbelief at what we went through. And I think the only thing we can hope to instill in them is everything we've learned during this pandemic, what we've learned to value, human connection, being in school. Like, hopefully we can instill that in them so that they won't take anything for granted like we did.
So, are you guys hopeful for the future? Brian, how about we start with you?
In terms of dealing with this virus, I think, yes, eventually enough of the world will be vaccinated and there will be enough of an understanding that the world will improve and hopefully it'll be eradicated from the population.
Yep. Carter?
Yeah, of course. I mean, everyone should have hope, Right now, we're slowly, very slowly inching our way, getting back into stuff. But now with this this new one, I think it's going to be, we're going to still have to have hope just in case if this one does become as big as COVID. But yeah, I think hope is a really good thing to have all around whenever you need it.
Yeah, Rena?
I think that at least in the US, we will definitely be out of COVID. We won't be affected by it. And I think it's important to remember that while we might not still be in the midst of a pandemic, there's other places in the world that might be still affected by it. But I hope, and I think it's so important for everyone to hope and not just wish, but to also work towards making the world a better place after COVID.
Yes, Zach, they say the children are our future, and if that's so, I think we're in good hands. I was inspired by these students, and it's funny, if you want to feel old, go to a high school, but also if you want to feel young, go to a high school. And I left feeling very hopeful, and we just sat down with 6 extraordinary students.
Yeah, I mean, Reggie, it's nice to see, especially firsthand, right? We think so much about the safety, and we talk maybe about parents and administrators more so on the show, but it really is the kids that have been battling through this and dealing with kind of the emotional toll of maybe not having traditional schooling here and the isolation of doing remote learning as well. I mean, it's also time you can't get back, right? You're only in high school for 4 years, only in college for 4 years generally. I mean, when you kind of got the sense of how desperately they wanted to get back to normal life, and the flow of things. What did you find out there?
Well, yes, those were some of the things that they brought up. They talked about the seniors from last year having to miss prom and their graduation ceremonies. And they said, we hope the same thing doesn't happen to us. And, those are rites of passages that generations have come to cherish. And the fact that they might miss it is actually a concern.
Yeah, we saw that too. I mean, even the classes of 2021 who are hoping to finally get families back at graduation depended on the schools and the states they were in. We'll see what happens this time around. But Reggie Wade bringing us the latest there from a high school with students on the show on Yahoo Finance. At first, I think, in our hours, so very cool to see that. We're going to take another quick break here on the show, but when we return, the big studio push happening out in Hollywood there as the battle for studio space heats up. All the streamers trying to lock up some contracts. We'll discuss that with one of the leading companies focused on studio and sound stages on the other side of the break. Stay with us. Well, the battle to secure studio and sound space in Hollywood has gotten more intense as streamers, including the likes of Apple and Netflix, compete to return to spending money on production. That's been a big boost. The businesses for the likes of real estate investment trusts focus on that space, including the likes of Hudson Pacific Properties, a REIT with a portfolio of office and studio properties totaling nearly 20 million square feet. The company, along with Blackstone, recently announced plans to add to that a collection of spaces with a 240,000 square foot project, which boasts 7 film and TV ready sound stages. And for more on that, happy to welcome into the program the CEO of Hudson Pacific, Victor Coleman, here with us. And Victor, I mean, we've seen this push really kind of intensifying in the recovery here in the pandemic. I mean, talk to me about why building this out now and what you're expecting to see there.
Well, great to be here, Zach. Thank you. Listen, the push is really based on a content drive, and it was a show-to-show business for many, many years. And now it's, obviously credit-rated companies from the old guard studios all the way to the new streaming companies that all need access to space, both domestically here in the United States and other places around the world. And, obviously Hollywood is still the king of entertainment. And as a result, Los Angeles is a driver. We've not seen new studios built in a long time, and the demand is as high as it's ever been.
Yeah, and I mean, in regards to that, I assume it would make your guys' job easier if you do have, as you said, better rated companies coming in here and trying to use the spaces and how that all looks. But I mean, when it comes to the demand that you've seen increase as production has come on, give me a sense of how quickly it's bounced back and what you're expecting to see.
Well, as you well know, I mean, early on in the pandemic, content was zero in terms of the production. And then they ramped it up late last summer, almost a year ago now. It was August of last year that they started ramping it up. And so they basically have, almost a full year of backlog that they got to get out on the content side. And, we're talking almost $100 billion of content creation that is going to be coming out to the marketplace over a 12-month period. And that is up precipitously since the prior years. And then you've got, as I said, a backlog of 6 to 12 months of production at the same time. And so this is going to be going for the next few years at least. You're going to see a lot of dollars put out and a lot of production streaming through all different content players.
Yeah, I mentioned the expansion plans there in LA, but when you think about where else you could be expanding, you mentioned expansion plans in the UK, other areas of production. I mean, what are you seeing in terms of how much effort's going to be placed into those projects and I guess the early fruit?
So listen, I think that there's key markets that are very, very sticky in the production world. And those are, as we mentioned, Los Angeles, or New York, it's Vancouver, it's Toronto, it's the UK. And then there's second tier markets that are going to be driven based on tax incentives or aspects around that. And as a result, you're going to find people are going to gravitate to longer term leasing and longer term productions in those key markets. And then shorter term, which is more feature films or individual series, it's some of the second tier markets. But right now, I mean, the demand is so high, people are looking to anywhere they can get production, content, and the talent around that, which is key, because talent is everything, both in front and behind the camera.
Yeah, I'm glad you mentioned the tax benefits side too. We had, the state assemblyman behind the push here to kind of keep those tax advantages there in Hollywood. We've talked about, other places that have popped up for production, including Georgia and other states as well. I mean, how do you guys follow those things in terms of where you should be building some of these projects, and how do you see that shaping up as the competition there, not just on the studio side of companies trying to find the best places to film and the best talent as you're talking about, but also best tax incentives on the likes of where you should be building these projects?
Well, we're looking for purpose-built facilities. So this is going to be a long-term facility for us, both in California and the UK and the other ones that we're building around in our core markets. So tax incentives are great on the construction side, which California just put into place, which was that new bill that you just referred to, on both the construction and then also on the production side. But, you're looking at when I call purpose-built, this is quality real estate for long-term, production facilities. This is not conversion of industrial short-term. And I think, the tax boom is going to be part and parcel of the content companies looking for reasons to sort of stay close to home or close to the markets that they know are the sticky markets to continue to grow in.
Also, bringing Blackstone on board with this particular project, I assume a lot of people might be wondering if more is expected there and what kind of benefits that partnership might bring to the table. I mean, what does that maybe change about the way that your company looks at maybe building some of this stuff out, and how big of a boost it could be for future projects?
Yeah, Blackstone's been a fantastic partner of mine for many, many years, and this is just another sort of continual relationship driver for us to move forward in this specific area. Their desire in the studio business on the construction side, on the existing facilities, and the overall media growth is really where that driver is. Our intent is to grow our portfolio collectively with them, our brand, which is our Sunset Studios brand, with them, and continually look for unique alternatives that are going to fit perfectly within our mutual desires to build that brand and build our portfolio out.
All right, Hudson Pacific Properties CEO Victor Coleman, appreciate you coming on here to chat with us about the demand there out in Hollywood. Enjoy the sunshine, man. Be well. We'll chat again soon. Going to take another quick break here on the show, but when we return, shifting from movies to something that is very real but looks like something out of a tech movie. The startup behind this self-driving truck and the technology boom there. We'll chat with the co-founder and CEO of Plus on the other side of the break for the key new push they just accomplished out there in China. We're back in 2 minutes' time. Well, autonomous trucking company Plus accomplished a major milestone on its road to powering the future of driverless trucks. The company completed another level 4 autonomous drive, this time on a stretch of highway in China, without any human interaction whatsoever. Not even a backup safety driver was on board, as we've seen in other level 4 tests. And for more on what it means as the race to automate shipping heats up, happy to welcome the CEO of Plus, David Liu, joins us on the show today. And David, appreciate you taking the time. I mean, it's fascinating to watch. I kind of just watched that clip on repeat here in terms of the footage from this trip. But how big of a step was it for you all in what you've planned in terms of rolling this technology out?
Thank you for inviting me onto the show, Zach. I'm extremely excited about talking about the demo we have just done on a public highway in China. I mean, this is a key milestone for us. It shows a glimpse of the future of what trucking could look like. How do we achieve a safer, a more efficient, and greener future for our society and for the transportation industry?
Yeah, and there's other companies, of course, out there. We've talked to a few of them: Too Simple, Embark, Alphabet's Waymo, even who may have accomplished level 4 tests like this. May have had safety drivers on board, but clearly a lot of companies chasing this opportunity in self-driving trucks. Some of them going about it different ways in terms of maybe doing the long haul routes all autonomous, but then still having some drivers take the shipper or the shorter shipping routes there. How do you look to tackle the problem there at Plus? What's the way that you guys are trying to solve it?
Yeah, so we take a very differentiated technology approach to get to that driverless future. So what this demo have shown is a significant step forward in the industry. For us to take the driver out of this particular truck, there is no teleoperators, there is no human drivers in the cabin, right? So to be able to do this, we're extremely confident about the reliability and redundancy of the truck that we demonstrate on this highway. Certainly this is just one of the first highway demo that we have shown. We're still quite a ways away from being able to deploy this technology scalably onto our public highways. So to achieve that, we require a lot of more testing miles and be able to put our technology under a much wider range of scenarios so that we can develop that level of confidence that a technology-driven truck can be safer than a human driver. So to achieve that, what we have been doing is applying our technology onto trucks with drivers in them and to put them under real-world tests scalably. And we're looking at deploying this technology onto hundreds and thousands and tens of thousands of trucks in the next few years. And on the way accumulating billions of miles of testing experience. And by the time in a few years, we have sufficient miles to prove out that our technology is safer than what an average human driver can achieve. Yeah, and I believe that will be the point where we can deploy this technology scalably.
Yeah, obviously it's going to come down to, I guess, regulations as well, different in different jurisdictions, but also kind of a piece that might be overlooked a little bit here is national security as we talk about self-driving technology and that piece. I mean, the footage that we're showing was in China. I think about your competitor here in Embark adding some key people to their board, Elaine Chao, the former U.S. Transportation Secretary, on board there. I mean, when people think about the risks associated with this company, you guys are going through a SPAC, which I can ask about in a second. But when you think about how you guys are positioned on the regulation and national security front, what should they know about the way that you plan to tackle this problem, both here in the U.S., but also in China, and how there might be, potential problem there?
Yeah, security and safety are the number one concerns for our company. We have deployed a lot of technology to make sure that our technology is secure and safe. Now China and the U.S. are the two of the largest market in the world in terms of what transportation is concerned. So we have taken an approach where we deploy our technology to markets where there is demand, there's need, right? So, our company is, based in, headquartered in Cupertino, California, in the center of Silicon Valley. like some of the other auto tech companies are. And we look at applying and deploying our technology all over the world globally, in China, in Europe as well. And for any of these geographies, safety and security are top of the concern for the society as well as the regulators there.
As I mentioned, SPAC deal here looking like Q3 in terms of when it's expected to close. With Hennessy Capital Investment Trust account there, going to be a $3.3 billion valuation attached to the deal. When we talk about it, I guess, well, capitalizing you guys with $3.3 billion. When we talk about how much that helps build out what you're working on, I mean, what's the runway to kind of use some of that cash to really expedite this? As I said, a lot of companies are chasing the opportunity. How do you look to build out the operations?
While I cannot speculate on how the market reacts to it, and how we've made a lot of disclosure in our filings, so I'm not going to speculate on any of the specifics of the deal. But what I can tell you is that we're extremely excited about going public, and very excited about our investors and markets extremely enthusiastic and positive reaction to our company and to the technology and the business momentum we have gathered. So we're looking forward to further develop our technology and deploy our technology for our customers.
Well, pretty fascinating to watch that clip, regardless of where things go from here. Already some pretty serious accomplishments made on that front. The co-founder and CEO of Plus, David Liu, appreciate you coming on here to chat with us today. Be well. I'm going to take another quick break here on the show. When we return, digging into some changes potentially coming to Panera as the parent company behind the brand looks to shift things around. Some key efficiencies, what the CEO said there about how it could be signaling an impact to tap public markets once again. We're back in 2 minutes' time. Well, the parent company of Panera, JAB Holding, is looking to move some of its breakfast brands a bit closer together. The company plans to tie sister companies Einstein Bros Bagels and Caribou Coffee to the Panera umbrella while keeping the brands distinct. The arms will share menu innovation ideas and supplier data as well. And Yahoo Finance caught up with the CEO of Panera earlier today for the latest on the state of the business there. Take a listen.
Well, the trajectory has been very strong. And as you mentioned, I think as a result of the macroeconomic conditions like stimulus payments, vaccinations, and a general desire for consumers to get back to the life as they once knew it, coupled with some of the pivots we made as brands through the pandemic, more off-premise, more digitally focused, and rapid-fire innovation, we are seeing a tremendous recovery across all three brands this year. And in fact, the momentum is building week on week. So we're feeling very good about where we are and how things look going forward.
Take us through why you're bringing all these brands together under one roof. Are they going to share rewards programs? Are they pulling from the same food suppliers? How are you thinking about it?
Yeah, I think so. It's a very exciting development. If you think about it, this creates one of the world's largest fast casual restaurant brands with 4,000 stores across 10 countries, 115,000 employees. So, much larger in scale. And I believe we can be stronger together and we can grow faster. So the real reason to do this is to leverage the competencies that we have, such as our digital ecosystem, our omni-channel network, our supply chain, as you mentioned, our innovation strength, and also the capability of franchisees that we have at Panera Bread, and that we can leverage these assets across all three brands to grow much faster. That really is the intent.
It's also a pretty easy way to tell Wall Street a story. Do you have any timeline on when you might become a public company again?
Well, as you can imagine, we are always thinking about various options all the time. But at this point in time, we have not really made a specific decision on when exactly that might happen or if it's going to happen.
It's Julie here. I have a little bit further questions on bringing the three brands together. Do you expect to have cross-selling? Are you going to have Caribou Coffee in Panera Bread, for example? Are you going to sell Einstein Bagels in a Panera, for example, or in a Caribou? How is that all going to work?
So I think the way to think about this is that we believe that these are three iconic brands with the unique roles in the lives of our customers. So we're going to be very focused and dedicated at ensuring the independence of these brands and make them the best version of themselves, respectively for our consumers, whilst leveraging the back end to really turbocharge growth across all three brands. But so I don't really see any cross-selling, et cetera, happening. We just want to delight our customers who are looking for those specific value propositions across each one of those individual brands. I think the good thing is that these three brands are very complementary. So Panera leads on lunch, Caribou Coffee leads on coffee, and Einstein Bagels leads on breakfast. So they're very complementary, synergistic, and we plan to grow them faster by leveraging our unique competencies at the back end.
Yeah, Naren, I was thinking about the different day parts, as you guys will call them, that they fit into, and it seemed to me as a portfolio of, if anything, maybe skewed slightly more towards the morning hours with the coffee and the bagels together. And I'm curious how you guys have seen that part of the business. We hear from a lot of competitors in the fast casual space that they're all very interested in breakfast. They want to make more breakfast investments, but certainly with these three already have a strong foothold there. How have you seen that specific day part as a growth area?
So I think the pandemic has been transformational in the way in which consumers are accessing brands, as you can imagine. And interestingly, lunch has had headwinds. Even breakfast has not been that strong as it was before. The day part that has really exploded has been the dinner evening day part for families at home, working from home, and the weekend day part, interestingly. So therefore, over the last year or so, we have not only protected and strengthened our breakfast and lunch day parts, we have gone very aggressively for evening, end of the day family meal solutions. At Panera Bread, we launched the flatbread pizza, and we launched warm bowls as a meal solution for families for the evening day part or for the weekend. And we partnered very quickly with third-party aggregators so our consumers could access our offerings for that additional day part is the evening day part. So I would think that probably Panera Brands is a unique combination of brands that have relevance across all three day parts, not only breakfast and lunch, as you mentioned, but we are seeing tremendous tailwind and growth in the evening day part as well.
There you go. Panera officially on spin-off watch there as we see what JAB Holding wants to do with that particular brand, including a few of its sister brands now included as well. We'll keep a close eye. Going to take another quick break here on the show. In turn, we'll be getting technical here with some big moves in Bitcoin to spotlight. Jared Blickery's going to carry us through that with a special guest on the other side of the break. Stay with us. Well, as we move farther and farther along here in terms of August trading, it might be worth taking a look back at historical action we see in the late summer months. And for more on that, I want to bring on Yahoo Finance's Jared Blickery with a special guest in this week's Getting Technical segment. Jared?
That's right, and our special guest is JC Peretz, founder of All-Star Charts. And I want to bring you in here and start with the overall market, because as you've been noting in your newsletter and your tweets, August is usually a volatile month, and we've seen a lot of downturns, a lot of VIX spikes. It's also low liquidity. We have a lot of people out, well, not for lunch, for vacation, coming back after Labor Day. As you've been noting, we got biotech, small caps, a bunch of major markets and downtrends. So how are you playing the market right now?
It's funny you mentioned out to lunch. Maybe it was a Freudian slip, because it's funny because this is kind of how the market acts during the day, right? You know, you get the volume and new action coming in the morning, and it kind of slows down after 11:30 through like 1:30, and then picks up into the end of the day. That's just normal intraday seasonality. Like you mentioned, everyone's out to lunch. Sort of on an annualized basis, it's kind of the same thing, right? You know, the summer doldrums, if you will, is kind of like that lunch period. And then it picks up in the fall into the fourth quarter. So, you know, it really is that. But this year, it's special because we came into the summer doldrums already in a messy market environment, right? You know, the IPO index peaked in February, emerging markets peaked in February, small caps stopped going up in February, biotechs, you know, that was when the list of new highs on the NASDAQ peaked back in February. So a lot changed since then, where it's been harder and harder to make money, right? This year is not last year, right? You can talk to any trader, They'll tell you their P&L is different. The types of trades that are working this year are much different than what was working last year. Last year in a trending environment, it was easy to just buy stocks, buy dips. We were in a strong bull market. Now, year 2 of that cycle historically tends to be a lot messier, and that's precisely what we've seen this year.
Well, I want to shift gears a second to Bitcoin. That's really gotten my attention over the weekend. Got all the way up to 46,000, and there's been a lot of talk about regulation and the crackdown in China and this and that. But I want to know what you're seeing in the technicals here.
Right. See, the one thing that we know about the crypto markets is that there's always some story, some conspiracy theory as to why, it went up or down that day or week or month. Like there's always some story. Sometimes they're true, sometimes they're not. So we just stay out of that gossip, right? And we focus on the only thing that pays, and that's price. And when you look at the chart of Bitcoin holding that 30,000, it's like that scene in Back to the Future where Biff is like, this seems awfully familiar. There's something real familiar about this, right? And it reminds me a lot of the S&P 500 in the summer of 2010, where you kind of had that monster thrust and you had a consolidation that appeared to be a head and shoulders top, where like members of the media are calling it out and, all of a sudden they're technicians. We saw the exact same thing. A lot of journalists and members of the media calling out a head and shoulders top in Bitcoin. Man, eerily similar to that 2010 period in S&Ps. Really looks a lot like it. And the squeeze is on that 30,000 level. So obviously we're up 50% in Bitcoin from those levels. But when you go across the board, when you go down the cap scale and you look at other names like Cardano and Polkadot and even the Ripple, I mean, there's just so much going on in the crypto space. It's not just Bitcoin, but it definitely started there.
Yeah, and let's take a look at some crypto stocks here. Specifically, I know you're taking a look at Silvergate Capital. This appears to be breaking through some through some resistance here. It is breaking to the upside, a couple closes perhaps today. So what do you like about Silvergate here?
It's interesting. It's a mid-cap stock, right? And if regional banks start getting that bid again, if the U.S. 10-year yield can get above 1.4%, there's going to be a lot of buying pressure coming in regional banks. This one in particular, Silvergate, is really interesting because it gets grouped with the crypto stuff because they're doing a lot of fintech and crypto work, even though it's a San Diego-based regional bank. I think it's got a market cap of $4 billion. So right in that mid-cap sweet spot. And most importantly, the risk reward makes sense. If we're above 115, I like it long. I think it's got at least 50% of upside. And then realistically, if we break out again, I mean, this could be a $300-400 stock. And it's really not that big of a company. That's one of the things I like a lot about mid caps is that, the stocks could double, they could double again, they could double again after that, and they're still not that big. So that's, that and the crypto exposure. If you're gonna buy a regional bank stock, I'd take a look at this one. It's interesting.
Well, and then let me just get your thoughts on gold. We had a flash crash overnight, and that's after a huge loss Friday after the jobs number. What are you seeing in the gold market right now?
Nobody wants your rocks, right? I mean, that's the theme. Nobody wants your rocks. Like, inflation, deflation, disinflation, Trump, Biden, the gold bugs have come up with every story under the sun as to why gold should go up, and it doesn't. In fact, over the last year, you'd be hard pressed to find a worse investment over the last year in gold. I mean, literally, you could have bought anything and it would have made money, but not gold. So it just really is the worst of the bunch. And even in commodities, literally every commodity in the world is going up except for gold. Silver's making new lows. Just nobody wants those rocks. It's really a supply and demand game. You can, some people like to have like conspiracy theories about like gold and, inflation hedge and like, it's just stories. Mm-hmm. It's just, stories. And so you could listen to those stories, or you could focus on the only thing that's actually ever going to pay anyone, and that's the price of gold. And it's just obvious that there's an overwhelming amount of supply of gold relative to demand for it. And until that changes, we're going to keep leaving it alone. Ultimately, Jared, I do think, my suspicion is we finally break out above those 2011 highs, which were the highs from a year ago last summer. I think ultimately we do. We've been in the camp that ultimately I believe we do. The problem is that I don't know how long it's going to take. I don't think it's going to happen tomorrow or next month, probably not even this year. Maybe next year, maybe the year after that. The way I see it, what's the rush? Just wait for the breakout. Why do we have to be in such a rush?
Only price pays. Love it. JC Peretz of All Star Charts, thank you for joining us. Sending it back to you, Zach.
All right, guys, appreciate that. Just one last check of the markets here as we wrap up. You see the Dow here off still by about 1/5 of 1%. The NASDAQ, the lone index, just as we started the show, still here in the green. The Dow, though, paring back those losses. And, of course, as you guys were talking about there, a lot to watch on the Bitcoin front as we continue to see the infrastructure compromise work through there. As, again, Bitcoin holds above that $45,000 price level. The rest of the coverage here coming up after the break to carry you through the session. We're back in 2 minutes' time on Yahoo Finance Live.
Welcome into Yahoo Finance Live. I'm Kristen Myers here in studio and joined for the week by my co-host, Brian Chung. Brian, great to have you here with us. And here's a look at what is happening today. Now, job openings for the month of June hit a record high. That's according to the Labor Department's monthly JOLT survey. The top line figure surpassed 10 million and comes just days after a strong July jobs report on Friday. And children are headed back to school in a matter of weeks as doctors are sounding the alarm of children potentially causing spikes of coronavirus, particularly in unvaccinated families. We'll be chatting with a doctor about that later on in the hour. And supply chain issues are going to persist. That's according to the latest trucking outlook forecast from trucking companies U.S. Express. We're going to be chatting with the CEO, Eric Fuller, on the outlook for trucking shortly in this hour. All right, but first, let's take a look at the market action right now, where we have a bit of a mixed bag right now. We do have the NASDAQ in the green, up, as you can see there, about 0.2 percentage point, Brian.
Yeah, and we can see not too much movement on this Monday so far. As you mentioned, the Dow really not much change from where it ended the day at the end of last week. The NASDAQ up a little bit, about 0.2%. But let's also take a look at what's going on in bond markets right now. If you take a look at the 10-year and also the 30-year bonds, it looks like a kind of similar story. Not too much movement, about 3 basis points in the 10-year yield up to 132 basis points, 196 basis points on the 30-year. And then lastly, taking a look at what's going on in the U.S. dollar. It looks like the U.S. dollar getting a little bit of movement there. It is currently gaining some steam at about 15 basis points right now at a 92.95 handle. But let's get a little bit of a deeper dive into what's going on in markets with Yahoo Finance's Jared Blickery. Jared, what are you watching right now?
I'm watching you guys. It's so nice to have the family back. I was getting lonesome in the 1 to 3 p.m. Good to have you guys here. So as you said, kind of a mixed board, but not a lot going on either to the upside or the downside. And Brian, I do think the action has been in the bond market. This is a year-to-date chart of the 10-year T-note yield, and you can see we are breaking to the upside here. We had a big update on Friday, and we're continuing it today. And this is giving strength to the financials, and we're going to take a look at that in a second. But I want to take a look at the NASDAQ 100 here. The standouts are interesting because we have a combination of vaccine stocks, and biotech is doing pretty well today, and also Chinese stocks. We know Chinese stocks have been under pressure, but today I'm calling this a dead cat bounce. We're seeing Pinduoduo, NetEase, JD.com. Those are some of the leaders here. Moderna, that's up 15%. That is up the most. And let's just take a quick look at our pharmaceutical screen. Lots of green here, but as we saw last week as well, the winners, wow, look at that. Moderna, BioNTech, Novavax, Vaxart, those are each up nice percentages over the last 5 days. Even more impressive. We see two names up over 30% here, so we're going to be watching that. Also, I promised the banking screen. Let's take a look at that. This is over the last 5 days. We're going to look at an intraday here, and we can see Goldman Sachs is a standout, racing towards its record highs. Once again, up 1.5%. Citigroup up over 1% as well. We're seeing the yield curve expand, so all is making sense in the world. Got to check on Bitcoin because Bitcoin is holding above 45,000. That is one of those key levels that we have been watching, 45,800. Good news on that front. And hey, more good news if you are a meme stock holder because we got a lot of green on this screen. We're going to be bringing you AMC earnings after the bell. You can see that stock is up about 3% right now.
All right. Thanks so much, Jared. We'll see you a little bit later on in the next hour. I want to continue our market conversation now. We're joined by Sam Stovall, CFRA's Chief Investment Strategist. Sam, great to have you here with us. So I want to start with what we've been seeing in the job market, in the labor market. We had a lot of strength come out of that jobs report on Friday. Of course, now we have this JOLTS number, the top line figure surpassing 10 million. I'm curious to know if you think right now that markets are going to perhaps get a little bit jittery as we see some strength in the labor market, because that might mean some moves from the Fed.
Well, I think that what we're looking at is an imbalance between supply and demand. With so many companies reopening, especially in the hospitality and leisure area, they're not able to keep up with the openings by having those facilities be fully staffed. I think certainly they want to go through the interview process before they just have anybody represent the company. So I think it's going to take a little while before the supply-demand curve comes to equilibrium. But we don't really think it's going to translate into, a very large jolt, if you will, in employment data, or I should say in prices. So, our expectation is that the CPI number that we'll get Thursday of this week will show that the June data point was the peak for this inflation cycle.
Hey, Sam, Brian Chung here. Now, let's talk about the inflation side of things. We are expected to get a consumer price index print on Wednesday. But what's been interesting is that I've been looking at everything within the context of what's been going on in bond yields. And it's been a bit noisy and difficult to tell if the movement that we've seen in bond yields coming down since the spring has been the result of a changing narrative over inflation. So what do you expect to see on Wednesday? And how do you think that even just the rise up about 3 basis points today on the 10-year is maybe affecting how markets are pricing that inflation risk in?
Sure, Brian. Well, when we saw the 10-year yield drop below 1.2% and approach 1.1, I think investors got very nervous, wondering whether the bond market was a canary in the coal mine and that the Delta variant was going to shut down global economic expansion once again. But I think that fear really has subsided, and so the 10-year yield has started to creep a little bit higher as we move forward. Our expectation is we'll see it at about 125 on average for this month, and then rise up to about 145 to 150 by the end of the year. So interest rates are likely to just creep higher as we move into the increased likelihood of tapering to start in the fourth quarter of this year. But I think when it comes to CPI, whether you look to headline numbers, 5.1% is our expectation for Thursday versus the 5.4% that we saw last month. We're also likely to see the core rate have peaked in June. So overall, I think that PPI will give us a preliminary view and then confirmation on Thursday with the CPI.
You know, Sam, mentioning that Delta variant, we have seen markets really be a little bit volatile. We've seen some record highs. Right now, the markets are retreating from the record highs that we had seen on Friday. So not too long ago that we were talking about record highs in the markets. But again, the Delta variant continuing to weigh and cause pressure right now on equities. Two-part question for you here. One, how much do you think the Delta variant is going to present that really kind of headwind for the markets going forward, particularly as we go through into the back to school season, which some folks are highlighting as a potential cause of even more spikes of the virus around the country? And two, what should the defensive plays be to protect against that downside risk?
Sure. Well, I think that the explosion in new cases, 100,000 a day, we're seeing just recently because of the Delta variant is something that is causing concern, because I believe that a lot of people feel that once we get back into the back to school season, once parents can then go and re-enter the workforce, that was going to be a positive. But, if we find that schools are going to go back to being at least partially remote, then that could be a big problem for getting that job supply demand balance once again. So I think that it's one of those things where we just have to keep an eye on. Wall Street does like to climb a wall of worry, and just because we're down today by a fraction, I would tend to say versus the new high that we saw on Friday, it's not that big of a concern right now.
Hey, Sam, in that wall of worry, how much does the Federal Reserve factor into that? Because it seems like they've been trying to give markets as much heads up as they possibly can on the taper process, which looks like it's likely to begin later this year. We heard from the Atlanta Fed president saying he would like to see something begin sometime in the October to December range. Do you think that that's already priced in those expectations, or is there still the hawkish risk as the Fed heads into its Jackson Hole meeting at the end of this month and then maybe into their September meeting?
I think we won't really hear anything about tapering at the end of the Jackson Hole meeting. I think that the Fed will keep that for the September meeting, and that we probably will start to see tapering take place in Q4. I think a lot of the Fed presidents who have been coming out talking about tapering really is a trial balloon to, in a sense, let the public be more and more aware of what is likely to happen. I don't think the Fed wants to be behind the curve. Some people say they already are, but I think that by taking a longer period in which to taper would actually be good, because it won't be a very sharp and sudden rip that could happen if they did wait further. Our belief still is that they're not going to raise rates until at least the fourth quarter of next year, and possibly still wait until first quarter of 2023.
So, Sam, we have time for just one more here with you. Curious to know where you think opportunity lies right now. What are you looking at? What plays are attractive to you right now?
Well, I like to go back in time, look and see how history performs. And August is one of those months where it's the third worst month of the year, not only in terms of price change, but also in terms of volatility. Usually the defensive areas tend to do relatively well. Like today, what we're seeing, healthcare doing fairly well, along with consumer staples. Believe it or not, technology tends to do relatively well. My concern is that we are now the 10th longest stretch, meaning 10th longest period between declines of 5% or more since World War II. And so it's simply a matter of time before we have some sort of digestion of gains. And history also says that if you have 6 new highs or more in July, we tend to digest those gains in the following August. So I wouldn't be surprised if we see a pickup in volatility, but I would use that for a buying opportunity as we move later into the fall, because then I would tend to say we'll probably end up seeing an improvement in the cyclical and value stocks all over.
All right, we'll leave that there. Sam Stovall, CFRA's Chief Investment Strategist, thanks so much for joining us. And coming up next, we'll be talking with the CEO of the shipping company U.S. Express. Eric Fuller joins us right after the break.
Welcome back to Yahoo Finance. Well, we've talked about inflation in a number of different categories, but one of the biggest price pressures comes from the cost of transportation. And like many other industries, the spot rates to move goods by truck have risen over the past few months. Eric Fuller is the CEO of U.S. Express, one of the nation's largest truckload carriers. And Eric, it's great to have you here. I want to kind of kick off this conversation by talking about this new quarterly report that your team has. It noted that what goes up must come down on the cost of shipping right now. But I guess my question naturally is, when do you see those inflationary pressures on your business abating?
Yeah, typical in our business, typically these things last about 6 quarters. So we're very cyclical, and there's kind of up cycles and down cycles, and they typically last 6 quarters. We are currently in, say, quarter 4, quarter 5, depending on how you were to measure it. I don't see this being a typical 6-quarter type cycle. And I think there's a couple of reasons. One is structural. What you have going on in the market from a demand perspective, the demand is incredibly strong. I don't see that changing anytime soon at this point, probably well into 22. And also driven by demand is some of the things around supply chain and also inventory levels. On the supply side, you've got driver constraints, which are continuing to plague the industry. And we've seen the driver situation probably about as bad as I've ever seen it in my career. So very hard, difficult to find truck drivers, not only from a competitive standpoint, but from a standpoint that I think structurally things have changed in the driver population as it relates to the job and wanting to be home with their family and things through COVID that I think have changed things, that maybe have changed things permanently. The other issue as we move into 22 is we've got this infrastructure bill, which we believe will create further demand and also further constrain supply. So I think that we're probably looking at a much more prolonged cycle than what we typically see with these 6-quarter cycles.
You know, Eric, I want to focus in on that driver scarcity that your report essentially highlights. And now this is nothing new. We've heard of so many CEOs and corporate executives talk about labor shortages right now, just the absolute difficulties in trying to find workers. We have some unemployment benefits that are going to be drying up in about a month now. Do you think that that's going to force perhaps more drivers back to the trucks? Or do you think that this perhaps is a salary issue and that a company like yours and others are going to have to start paying premiums to get drivers back into the trucks and back to work?
So it's a combination of a few things. One, we do see an impact with the unemployment benefit. So when certain states had in June, when certain states went away from unemployment benefits, we did see further drivers come back into the market. So I do think that is having a factor. I think that pay is a big component of this. Now, we and most of the industry have given significant pay raises over the last 12 months. We've given about a 30 to 35% pay raise just in a 12-month cycle, and that was through a couple of different pay raises. But we believe that in order to really get into where we can compete against manufacturing and construction and even driving jobs where drivers are home on a more consistent basis, we think we probably need to have probably another 20 to 30% premiums to the pay raises that exist today. Now, that's not something, unfortunately, we can do just in a vacuum. We're in such a cyclical industry and it's heavily commoditized in a lot of ways that there is a component that has to happen with the customers, the end users as well. And so we're going to have to work together if we're really going to solve this structural driver problem.
Eric, I want to ask about another supply chain issue that maybe you're experiencing, which is on the trucks. So what's been interesting is that the orders for trucks, based on your report, appeared to be pretty robust, but the actual production is another story, probably for the same reason that many other manufacturers are facing, because it's just hard to source parts right now. There's backlogs all over the place. So do you feel like that's an issue right now, that it's also just the amount of trucks that you can put out on the road, or is it really the labor shortage that's the bigger issue here?
I think it's both. I mean, for a company like ourselves, we, regardless of cycle, we are constantly trading in tractors and trailers. So we order about 1,500 trailers a year, or tractors a year, and probably about 3,000 to 4,000 trailers a year. We're running about 9 months behind on tractors and being able to get tractors delivered. And at this point, we're probably running closer to 18 months behind on trailers. And the trailers could be another 18 months or so before we can really get the amount of trailers that we need for our fleet. On the tractor side, it's getting worked out. I think that we'll probably start to see tractor deliveries happen over the next month or so. But again, we're still, a solid 9 months behind where we'd like to be.
Eric, right now, are some of these rising costs being passed along to some of the shippers?
Oh, for sure. So on the spot rate side, we're seeing spot rates run a premium of nearly 50%. And that's the volatile part of our market that's constantly moving up and down based on supply and demand. And 50% premium is about as high as I've ever seen it. And it's been staying there probably for about 7-8 months now, and I don't see that changing anytime soon. So that's getting passed along. Plus, on the contract side, which are more long-term rates, we're seeing rates up anywhere from 10 to 15% on an annual basis, and in some cases, on more difficult freight, as I would phrase it, even up to 20%. So rates and prices are definitely being passed along to the shipper.
And Eric, just for the viewers that maybe don't understand how this industry works, these spot rates, I imagine, are contractually agreed to. So is there any sort of lead or lag time element to these contracts that would tell us that we can actually get a good picture of what people will be paying, let's say, X amount of months from now, based on what types of things people are signing right now?
So contract rates are usually a 1-year contract, and those are getting locked in at about a 10 to 15, and in some cases, like I said, 20% premium. So we're going to probably see that at least through the rest of this year and into next year. Bid season for us starts kind of in that February timeframe and runs through mid-summer. So next year, those rates will get reset. If the market continues to be strong and robust, then they'll probably get reset at a premium. Spot rates are real time, meaning that they get priced out on a daily basis based off of the supply demand metrics in the market. But right now, there's so much more demand than supply that I don't see that changing anytime soon. So those premiums are going to continue to run.
All right. Well, Eric, we'll have to have you back on to give us an update in another quarter or so. But Eric Fuller, U.S. Express CEO, thanks again for stopping by. And coming up is the White House's push for electric vehicles, giving the infrastructure for charging stations a boost. We'll chat with the CEO of Volta on the other side of this break. Keep it tuned in. Welcome back. Last week, President Biden signed a new executive order calling for up to half of new vehicle sales by 2030 to be comprised of electric vehicles. So let's talk about the future of EV. We're joined now by Scott Mercer, founder and CEO of the EV charging station company Volta. Great to have you here with us. So one of the biggest hurdles that has really been highlighted as essentially to President Biden's plan has been building up this network, this infrastructure of charging stations for these electric vehicles. How much money do you think we would need? What do you think it's going to take to really build up this infrastructure of electric charging stations so that folks don't have to get anxiety of their car running out of juice on the way to their destination?
Absolutely. Thank you for having me. I think it's really at this point about acceleration. You know, electric cars are becoming less expensive to manufacture than gas cars over this decade. Electricity is already cheaper than gas as fuel. And with these mandates, now the question is really how quickly can you build critical fueling infrastructure in the electrification system to replace gasoline?
Now, Scott, I guess I just want to ask you about the plug then right now that you need to fill there, because obviously the aspiration to get to a certain amount of electric vehicles by X year implies that you also need to have X amount of charging stations at that point as well. And I believe that the statistics, at least on your side of the business, you've got about 1,700 EV chargers right now. You hope to have 3,000 by the end of 2021. Is that going to be enough to service, or is that going to be on the road to getting enough in place by the time the White House hopes to have X amount of vehicles on the road by then?
Oh, there's a massive acceleration in the number of ports needed as we start to move towards scale adoption of EVs. But the key for Volta is we focus not on the number, the quantity of ports or the speed of the chargers. We focus on the energy we can deliver per dollar of capital we deploy, and on the return that we can get from each dollar of capital we deploy, both for Volta and for our partners. So that energy delivery is key. How many gasoline-fueled miles can you replace with electrically powered miles as efficiently as possible when building the infrastructure?
Scott, how do you think that we can get consumer acceptance of a plan like this, you know, and to get folks really on board with purchasing electric vehicles and not worried so much about their ability to charge?
Yeah, I think that the vehicles need, from a consumer standpoint, to be three things. They need to be exciting or cool or something that people really are happy about. And we're seeing a massive sort of breadth of electric vehicle options out there. They need to be inexpensive, and we're watching the price of the vehicles fall over the next several years. And they need to be dependable. And that's really where building that public EV charging grid comes in. How do you put EV charging stations at locations that people can depend on? How do you put them at locations that people find convenient? So for us, really getting that infrastructure out now is the critical piece of that puzzle to focus on.
Scott, where are the areas of focus in terms of developing the infrastructure in places where it's not as developed? And I mean specifically geographically. Is it in certain rural areas? Is it in certain cities where it might be hard to find parking lots to even put these chargers? Where do you see the specific geographic areas where there really is opportunity to build it up here?
Our focus is really on locations in which we see demand from electrification over time. And the fun thing for me has been to see that shift from being a coastal strategy to being something that is national and something that is really truly about sophistication of the revenue streams you can get from charging and of scale. So for us, we think of that over the next several years, as you see EVs fall below the cost of gas cars, electric vehicles drivers will be like cell phone owners or like people who use the internet. It will be truly ubiquitous, and it will happen faster than you think.
Well, can I just drill down on that, I guess, because what's been interesting, I see that you're, focused on maybe looking at Whole Foods or Macy's, Kohl's, places where people might be shopping and can leave their car for a little while. Is that a better strategy in, let's say, more suburban areas than they would be in more urban areas? Do you feel like there's actually a tailored approach that you could have to targeting, okay, if this is an area that needs more chargers, we should target these types of businesses or locations as opposed to those?
Yeah, I think for Volta, our strategy is matching charging locations to visit behavior. So not necessarily providing the fastest charging, but putting charging out that matches how long someone is going to stay at the property. And then on creating revenue streams from that charging infrastructure that are more diverse and more sustainable than just the energy side alone. So we're looking at where people will go and what they'll do while they charge their car. We don't think you should sit in your car and charge. We think charging should really be a 5-second activity, plugging in right before you go into a restaurant, into a grocery store, into a drugstore. Could be anywhere from a 20-minute session or a 10-minute session, all the way up to a 2-hour session if you're at the movie theater. We just don't think it should interrupt your daily life.
And Scott, Volta is set to go public. Can you give us any insights as to what we can expect when that happens?
Yeah, we're very excited. We're going public. The ticker for the business combination right now is SNPR. For us, the focus going forward is really on that national footprint, building out the infrastructure, and on creating a sustainable revenue base. I mean, Volta is, I think, on par or a little larger than the revenue of our two next largest charging network owner operators combined. So it is about building a sustainable business quickly.
All right, Scott Mercer, founder and CEO of Volta. Thanks so much for joining us. And coming up next, we'll be talking to Dr. Leanna Wen about the pandemic, sending children back to school, and what she learned working in public health. That's next.
Welcome back to Yahoo Finance. COVID cases are continuing to rise, raising questions about how it will weigh on the return to school. As students across the country wrap up the summer break, Dr. Leanna Wen joins us as part of our series looking at the state of education as Americans get ready to head back to the classroom. She's also the author of Lifelines, A Doctor's Journey in the Fight for Public Health. Yahoo Finance's Anjali Kemlani also joins us for this conversation. And Dr. Wen, just so many questions to begin with here, but obviously a lot of these parents worrying about how the spread of the Delta variant may be affecting their kids as they get their backpacks ready for school. I guess just a baseline here. What is the risk as schools reopen and these kids who may not be vaccinated in most cases are possibly at risk of spreading it?
Well, first of all, great to join you today. I think it's important for us to level set and say that two things can be true at the same time. One is that it's really critical for us to get our kids back for in-person learning full time. And the second is that there is a way for us to do that safely. That said, there are also ways for us to do this unsafely, as in we know that the Delta variant is so contagious, it spreads so easily from person to person, especially among the unvaccinated. And there is definitely a risk if you have a lot of people who are unvaccinated together in an enclosed classroom for many hours a day, of course, you're going to have the risk of spread. But there are ways to prevent that from happening and to substantially reduce that risk. By this point, we know what works, and that's a combination of indoor mask wearing. It's a combination of having as many people as can be vaccinated to do so, improving ventilation, regular testing. All these are things that can and should be done. And the CDC guidance actually here is really important and very clear that it is important and we can get our kids back for in-person learning safely, but as long as we follow these mitigation measures.
Dr. Wen, Anjali here. Really great to have you back. I know that a lot of discussion has been happening about, what the CDC has been saying, the guidelines that have been coming out, and the state level differences. Looking at a map, you can see just how differently this strain of the virus is affecting different states. So is there something to be said about, with your experience as a public health commissioner, something that the CDC could be doing differently in order to help, make the messaging maybe more straightforward, while also balancing the various needs of different areas?
I think it's very challenging. And you mentioned earlier my book, Lifelines. I was the health commissioner for the city of Baltimore. I oversaw school health in Baltimore for every one of our 180 or so public schools. It is really hard. Look, I think we need to start talking about COVID-19 and the vaccine the same way that we talk about other routine childhood immunizations. At the start of school in Baltimore, every single year, there are hundreds, if not thousands of families that have not met all the vaccination requirements. They're not anti-vaxxers. They're just families that, for example, have had other priorities. They didn't get around to this. There were other things that were really important. They're not anti-vaccine, but they needed that additional push in order to get vaccinated. This is where I think mandates are really helpful. Now, I'm not saying that we need school mandates for vaccines for kids at this point, especially since kids 12 and older or 12 and younger are not yet eligible to get the vaccine, or 12 and older, you're eligible, but 11 and younger, you're not. But I do think that there are requirements that are needed at this point. And it really is unconscionable when we have governors at this point who are saying that they're not even allowing parents to have the tools necessary to protect their own children.
That's right, Doctor. And you're particularly talking about Florida and Texas, especially come to mind right now. Florida saying that they're not going to require students to wear a mask. Texas saying that they're not required, schools not required to do any contact tracing. And if you are in close contact with someone who's tested positive for coronavirus, you can still send your child to school. So I want to ask you about that vaccine mandate. Where does that bar really lie for you then, when we should start saying, you know what, schools actually do need to start mandating that their children be vaccinated against coronavirus? I mean, parents are not new to having these vaccine mandates for other diseases and for other things. And especially once that vaccine is available for children 12 and under, do we need to really start thinking about mandating vaccines for all children that are going to schools?
Yeah, it's a great question. I think we need to start with vaccine requirements for healthcare workers, for individuals working in nursing homes. And we are now seeing more and more companies implement vaccine requirements because that's in the best interest of their workers and their families and their customers as well. I think we need to normalize this for adults, and where we have now been giving these vaccines to hundreds of millions of people around the world. We know that they are safe and effective. And then I think also that in schools, we should start at least implementing a testing requirement. For example, we can say that everyone needs to be tested at least once a week. But if you are vaccinated, if you're a teacher or a student that's vaccinated, you can opt out of that testing requirement. That's another very important push so that we are making vaccination the easy and convenient choice. And in the meantime, testing is also a layer of protection that's really important to help to keep these schools safe too.
Dr. Wen, in your book, you talk about basically your origin story and, coming from an immigrant family and your experience with public health and with public assistance. I want to ask you, just looking back so far, what we've done and how the U.S. has dealt with the pandemic, what would you say is maybe a missed step or something that we still haven't yet hit on when it comes to looking at the most vulnerable of our population?
I'm glad you mentioned the most vulnerable, because COVID-19 has certainly unmasked underlying health disparities. We've seen that it's not the virus that's discriminating, as in when we see unequal outcomes among Black Americans, Latino Americans, Native Americans compared to whites, when we see that people with low income are disproportionately affected by COVID. It's not that the virus is specifically targeting these groups. It's that our systems are unequal. We've also seen that unless we specifically address disparities, they're going to worsen. And so going forward, we need to do even more when it comes to vaccinations, testing, making sure that we're protecting those who are the most vulnerable. And I think another lesson coming out of all of this is how much it hurts our overall response when something that's as basic as mask wearing or vaccines become politicized. And I really worry about public health moving forward, because we've seen now some state legislatures even limit the ability of health departments to respond in the future, as as in if there are tuberculosis outbreaks or measles outbreaks, the public health powers of local health departments and state health departments are even more limited than before. So I really worry about the politicizing of public health and what this means for the ability of health departments to protect the people that they serve.
All right, Dr. Lena Nguyen, the public health professor at George Washington University and also the author of Lifelines, A Doctor's Journey in the Fight for Public Health. Thanks again for stopping by. Also, thank you to Yahoo Finance Anjali Kamani for stopping by as well. Coming up on the other side of this break here on Yahoo Finance, how is the NCAA's new rule allowing college athletes to make some side money affecting the world of sports? We'll have one bucket getter from Syracuse here to chat about an endorsement he's already inked ahead of the college hoop season.
Welcome back. Now that the NCAA has allowed student athletes to profit on their name, image, and likeness, or what's known as their NIL, athletes are cashing in, including our next guest, who will be the first student athlete to participate in a traditional ad campaign endorsing Three Wishes cereal. We're joined now by Syracuse basketball player Buddy Boeheim and Ian Wishengrad, co-founder of Three Wishes Foods and host of Adweek's I'm With the Brand. Ian, great to have you here with us. Buddy, great to join us today. So I want to start with you, Buddy. Why Three Wishes cereal? And as you're navigating now being able to make money as a student athlete, how are you deciding, what companies to endorse and really what investments to make going forward?
Yeah, first of all, just always making sure I'm making the right decision, someone that I want to do it with. And really, my mom came about it with me. Her and Ian had an instant connection. Ian being a Syracuse grad, doing stuff with Syracuse stuff in the past, shirts and fun things like that. So she thought it would be a really fun idea, and it was a lot of fun. I had a blast doing it, and Ian's a great guy, so we had a lot of fun doing it.
And there you are right there on screen with that ad right there. And, I guess I just want to direct this question to you. I mean, again, this is a brand new kind of frontier with athletes now able to use their name, image, and likeness. Obviously, beyond the fact that you're a Syracuse grad, which I am as well, by the way, so go Orange. But why did you decide to go this way as opposed to many other marketing avenues I'm sure you could have gone when it came to promoting your cereal?
Sure. Yeah, I did. Yeah. Oh, sorry. That's all you.
Well, this is not the only avenue we did, but basically when you always heard rumors that this was going to happen, but once I heard it happen, it was like, okay, we got to go do something. There's something going to be cool and newsworthy to be the first. And so naturally, having gone to Syracuse, having done stuff with the team in the past, was like, oh my God, what could we do? We're like, oh my God, Buddy Boeheim, he shoots threes, recalled threes. I knew something, like there was some potential there for humor. So, worked some connections, got to Julie, pitched her the idea, and she liked it.
And I guess I want to direct this question back to you then, Buddy. Now, you said that your mom was kind of impactful in helping to ink this deal here, so maybe she's your agent. But I guess when it comes to the broad landscape of other sponsorship deals, are there other things that you're looking at? And how do you think this changes the broad landscape? Are you talking with other teammates as well, maybe even your brother on the team, about other types of endorsements? Do you think that this could really change the way that people are approaching the way that they have these side gigs, as they also have to maybe focus on what is the primary purpose of trying to get dubs in the season?
Yeah, definitely. I think with this, it was so good, too, because it only took an hour and a half to do. And I think this was a great opportunity for me going forward to have an experience like this. I think I encourage other athletes and teammates to do things that you're not familiar with, that you don't know, but you trust the people you're working with. And that's what it was with Ian. I trusted that.
I think we might have lost Buddy there. He's at least frozen for us. I don't know how I feel, Brian, about being surrounded by a lot of Syracuse grads right now. I did not go.
She's just jealous.
Ian, I'm gonna bring this question over to you. One of the major concerns that we've had and that we've heard about, at least when it comes to this NIL, is that we might see inequities going forward, like we do already in the corporate world. As we see women getting paid less than their male counterparts, as we see minorities getting paid less than their white counterparts in the office. Some folks saying that these issues of inequity might also exist for some of these student athletes. Do you agree with some of those concerns? And for anyone out there that wants to use a student athlete essentially to promote their business, how can we make sure that some of those inequities don't exist and that there is some kind of fairness, at least, in some of these promotional deals?
Sure. I mean, I think that's a fair concern across the board. Any brands, whether you're working with college athletes or professional athletes or anyone who does an endorsement deal. I think for us was what I always tried to figure out is who matches really well with us. And I felt most ideas go through the lens of, is it cool and is there going to be some buzz? And so the fact that Buddy isn't just great, but also the son of our Hall of Fame coach, I thought there was a lot of PR fun value there. But really anyone that fits any brand parameters I think would work for any brand. I don't know if it's on the responsibility of an individual brand to figure that out. I think we have to look back as a whole and say, is there some inequity? But we had to do, I felt like, what made sense for our brand. We also did this within 2 weeks, so it wasn't, I didn't put it through that many lenses. It was like, this seems fun. I went there. He shoots threes. That's kind of how we kind of made the decision. I didn't look through that more of a lens than that.
Can you give us, I guess, a feel for whether or not there are certain types of, yellow tape, as I'm sure is often the case with the NCAA, and doing something like this? Do you have to clear this with any committee over there? Do you have to make sure that the payments are completely transparent? I guess, this is a whole new type of business line, right? So, how does the NCAA get involved? Was there any sort of communication when you were doing this?
You know who gets involved is the school. The minute this went out, I got LinkedIn from every version of some sort of lawyer or someone who deals with sponsorships at Syracuse University, making sure that if we're doing anything with the Syracuse name and likeness in there, that they make sure they get their pound of flesh as well. So we have to do a separate negotiation with the collegiate licensing company to be able to use the Syracuse jersey on Buddy when it's going to be on the box when we make the Buddy box and release it later this season at Wegmans.
Got it. So I guess, so is there a share, though, that's standardized there, or that's kind of up to you and the school and also Buddy to decide where, kind of how the pie gets cut up?
So I think there's two parts. One is the individual athlete. They have their own agent, team, mother, however you want to do it. They cut a deal that's fair and we negotiate like any other deal. And then there's a separate there's a separate parameter usually with the collegiate licensing company, which is the third party that Syracuse gives the rights to manage all of the licensing on their behalf. And so everything's kind of negotiable, especially early days here. We're in uncharted territories, as you see with government, like the technology gets out ahead and 10 years later, the government tries to figure out how to regulate it. I think we're in somewhat uncharted territories. So it was move fast, do cool stuff. It wasn't ask for permission, but it was beg for forgiveness, if anything.
Now, Ian, marketing and brands is really your bread and butter. That's what you were doing before you were making cereal. So I want to actually ask why the traditional ad campaign? You're using Gen Zer, Buddy Boeheim. Why not perhaps a TikTok campaign? Or is that coming? I want to know.
Okay, so a few things. One, as I said, I always look through the lens of a few things. One of the lenses was athletes, no matter how big TikTok and every other social media platform gets, people love traditional media. They love a proper shoot and a proper 30. And we plan to run it on local TV during the games up there. So I think it will be quite effective, or pre-roll on YouTube. But there's something to the production value looking real, like a real commercial, just like you saw Michael Jordan and Nike's or McDonald's. Like there's something to it being real, where the minute the NIL kind of enabled it, you knew that every athlete was going to become some influencer and use their social media and just promote stuff. But there's something when it really looks professional and done to that level, it's kind of worth more in a sense.
All right, we're going to leave that there. Thank you to Syracuse basketball player Buddy Boeheim, Ian Wishengrad, co-founder of Three Wishes Foods. Thank you both for joining us today. And coming up, we've got one last look at the market action. That's next.
Welcome back to Yahoo Finance. Let's take a look at some stocks on the move. I'm keeping an eye on Moderna right now. The vaccine maker says Australia gave its COVID-19 shot provisional registration for adults aged 18 and older. A company statement saying delivery of the vaccine to the land down under will begin in the second half of September. What's been really interesting is this has been a stock on the rise in addition to the 15% that it's up just today. Over the last 3 months, over 190%. Over just the last 1 month, up almost 100%. Still right now, looking at the S&P 500, not too much change, down about 3 points, whereas the NASDAQ just barely in the green. But again, not too much change from where these major indexes ended the day on Friday. So we'll be continuing to watch that as we head into the next 2 hours of trading. Also taking a look at bond yields right now. It's looking like the 10-year at least now up about 3 basis points, which is kind of still the same steam that we saw in those longer-term treasury yields at the beginning of the hour. So we'll keep an eye on that as we head into the 2 p.m. hour as well. And then obviously all eyes on crude oil as we head into the market close. Looks like crude oil also on the move after that big news from China that they'd be locking down in some measures. That's a big deal for the world's largest oil importer. But we'll have more market coverage of everything going on right here on Yahoo Finance on the other side of this break.
Welcome into the 2 p.m. hour here on Yahoo Finance Live. I'm Kristen Myers here with my co-host, as always, well, at least for the week, Brian Chung. Here's a look at what is happening today. Now, job openings for the month of June hit a record high. That's according to the Labor Department's monthly JOLTS survey. The top line figure surpassed 10 million and comes just days after a strong July jobs report on Friday. And if you are a cryptocurrency investor, you're going to want to tune into the conversation that we're going to have this hour on the regulations that are coming as Congress drafts rules on reporting cryptocurrency and looks to tax the digital asset. And current vaccine requirements may hinge on a court case from more than 100 years ago. We're going to be diving into Jacobson v. Massachusetts and what it could mean for requirements to be vaccinated against coronavirus. But first, a quick look at the market action right now. We continue to see a mixed bag as the NASDAQ is the lone index right now in the green. The Dow down about 86 points, S&P 500 down about 0.07 of a point right now. On a sector basis, right now, we are seeing a lot of sectors in the red, but financials and consumer staples are doing well. Financials up about 0.7 of a percentage point, while energy continues to slide as we see lockdowns being reintroduced in China as the Delta variant continues to worry. Real estate also in the red, down about 0.5 of a percentage point. And we also have tech, surprisingly, with the NASDAQ in the green, tech down right now about 0.3 of a percentage point. I want to head on over to the interactive board, just a couple of feet away, where we have Yahoo Finance's Jared Blickery standing by in studio for a look at today's trending tickers. Jared, let's start with some of the vaccine stocks that are rallying.
Moderna, guess what? We might get a booster, and that means potentially more revenue for them down the road. This is a stock that's been on fire, along with the other vaccine stocks. Going back to last week, they reported earnings. Nice things to say there. They got a new order from the EU for 200 million doses, up to 200 million doses. You can see it's up 38% over 5 days. It's not the only one. I'm going to change this heat map to a 5-day view, sort by performance, and you can see Moderna is still number one, almost 40%. BioNTech up 31%, Vaxart 22%, Novavax 15%. So biotech, these stocks have been fueling biotech a little bit, but we've also seen a rotation into healthcare recently, a little bit of a defensive mood. So all of this is contributing to these leaders standing out, and definitely among the leaders in our top 10 trending tickers today, guys.
And Jared, I want to ask you about this $1.5 billion deal. That's DraftKings buying the Golden Nugget online gaming. What are you watching in that space? Is the stock on the move?
Well, DraftKings is up, and that's impressive because this is dilutive. It's an all-stock transaction for about $1.5 billion. DraftKings hasn't done, as a stock, a whole lot this year. You can see it's up there, down about 4% over the last 2 months. Here's what it's done this year. Here's what it's done over the last year, and eventually we're going to get to a pattern here that we can potentially trade off of. I think the price action here is telling that we need to clear this resistance point here. We're going to call that, let's say, 55 and change. To the downside, we got pretty strong support at 40, so as long as we're in this trading range, not going anywhere, but check out Golden Nugget Online Gaming. Now, let's take a look at a line chart so you can really see the move today. This is over the last 2 years, really just going through into some technical resistance here. Point that we reached in 2020. So a lot of times when a stock moves very quickly, it will just stop at a resistance point, consolidate, then you have to see where it's going to go next. I want to show you one more thing. This is Rush Street Interactive. This stock is up 15%, just kind of showing you how the whole industry, some of its peers benefiting from this. And if I go back up to DraftKings, I do have some analyst commentary. Let's go to 13-day view and punch this up. Needham is talking about it, and they like the prospects of this deal. They are saying DraftKings deal to buy Golden Nuggets for about $1.5 billion is a move that will positively fuel their data science engine. There you go. Key assets that it acquires is, for DraftKings, the customer database of 5 million users. That's for Golden Nuggets. This is going to allow the company to leverage daily fantasy users to target likely online sports betting players. And all in all, this is looking pretty decent for the industry, especially with the state and local gaming rules in flux right now.
All right, Jared, let's talk about cryptocurrency, particularly Bitcoin right now, because it is up over 40,000, actually right now at 45,000 roughly.
I'll tell you what, I used to dread the weekends for Bitcoin, but now I'm kind of liking them. Bitcoin moves on the weekends. So let's take a look at the 2-month price action here on a candlestick basis. This is going to be instructive. We got to 40,000 last week, and now we're punching above it, holding above 45,000. This is a key level. If we go to a year-to-date chart, kind of been looking at this level for a very long time. In fact, since it broke down from this level in that head and shoulders top that a lot of people were noting, 45,000, a big level here. If we can hold above it, I see no reason why we can't launch and retest those $62,000, $63,000 highs that we saw there. All in all, looking pretty good for Bitcoin, but we do need to hold 45 for at least 24 hours, I would say.
And Jared, lastly, Yahoo Finance Plus. You've had all weekend to cook this one up, so it better be good. What are you watching from that?
Well, Argus Research has done the legwork for me on this one. Going to go to Yahoo Finance Plus, and we can see we got a nice call on Lyft. They did report earnings last week, and this is a stock that itself has been in a trading range for some time. We'll take a look at the last 1 year. We did get a boost last November with the reopening trade, but I'll tell you what, for going sideways, this is fairly constructive action. And I'll tell you also what Argus is saying about the stock today. They have a long-term target of 72, and they're saying on August 3rd, they reported an adjusted second quarter loss from continuing operations of $18 million or 5 cents per share, beat the street. But I'll tell you what is really interesting about the company. A lot of people focusing on getting to adjusted EBITDA profitability 2 quarters ahead of its forecast. That's another thing that's in focus here. And so bottom line, Argus is boosting its 2022 EPS estimate to 54 cents from 50 cents. That is based on their expectations for a return to normal business conditions next year. And I think we're all hoping for that as well, guys.
All right, thanks so much, Jared. We'll see you in about 30 minutes to look at what's happening in the oil markets. I want to bring in David Nelson now. He's a chief strategist at Bell Point Asset Management for this market conversation. David, always great to have you here with us. I want to start with the first thing that you have in your note, which is 9 months later and then a scary look at the coronavirus, essentially. We have seen a lot of volatility in the markets. We've seen a lot of down days, sell-offs as the Delta variant continues to concern investors. What kind of headwind do you think that the Delta variant is going to play moving forward, especially as we've seen some lockdowns in China being reintroduced because of those cases that are happening there? Of course, those oil markets being spooked by that.
Well, obviously, if you turn to shutdowns, then obviously the markets are going to pay for that. But to your point, it's exactly 9 months ago that Pfizer introduced the vaccine, and we've had kind of this steady run higher in the S&P 500. And actually, in the broad indices, it was kind of a narrow channel all the way up. But as we know, as market observers, underneath the surface, it was a ferocious battlefield. Take your pick, big versus small, growth versus value, secular versus cyclical. Just about every asset class weighed in on this, dependent on the economic recovery. And the one data point that we've looked to as kind of a guiding light as to what the market was going to do on any given day was 10-year yields. Earlier in the yield, they rose. The reflation trade worked out. Financials screamed. And then they started to stall because we started to get concerned about peak growth. We're going to have a 60% coming into this quarter. We're going to look like we're going to print 90% is what the growth is going to be for this quarter. Obviously, that's peak. Each successive quarter from here is going to have to be lower. So we're going to have to digest that and see where we are in the next couple of months.
All right, well, David, you used a lot of those buzzwords there about reflation and then peak growth. So what would you call the next chapter, right? I mean, we're seeing 10-year yields kind of settle as of the last few days. I mean, it's up about 3 basis points just today, but, somewhere around, let's say, the 120 to 130 range. So what is the story going to be in the future? Is it the Fed tightening? Is it going to be just Delta shutting certain corners of the world down that might, actually provide more inflationary pressures? What do you think is the big story?
Obviously, the Fed is always a big story because we key off that. In a vacuum, the lower yields would be a concern for me. But, it was pointed out to me on my desk that if you look outside the United States, we're the best house on the block. In Germany, the entire yield curve is underwater. In Japan, you've got to go out beyond 10 years just to get a positive rate of return. So in that backdrop, it's not surprising so much capital has literally poured into this country, into our fixed income markets, and eventually that finds its way into other asset classes like stocks. So relatively speaking, I'm not as concerned as I was earlier in the year when I started to see yields falter there.
Now, David, just a moment ago, you were really describing, essentially, if you pull back the curtain on that market action, that there's a battlefield. There's an entire war that is happening really behind the scenes. So then I have to ask, essentially, do you think that battle is going to be continuing over the next couple of months? And who are the winners going to be?
Well, I can tell you where not to go. I think everybody can win. I think the United States is still the better place to be. My concern is that as we push the edge of the envelope on valuation, we can make that case that a lot of investors will start to look to emerging markets because of the valuation differential. And I call that, actually, that's the emerging market lie. people underestimate how important the rule of law is. And we've seen that play out with China, not just in Hong Kong, but here in the United States with a clampdown on a lot of securities here. Now there are other very risky structures out there in the emerging markets, like these variable interest entities. And just about everybody owns them. If you own Alibaba, Baidu, and a lot of these US listed firms, emerging markets are problematic. So stay here in the United States. It's a safer place to be.
Now, David, something that's interesting is just what's been going on with the Chinese listed shares domestically here in the United States. And obviously, people who have been watching, Baidu or specifically DD stock is fully aware of that situation. But there might be some investors, maybe even the Robinhooders, who are looking at that and saying, well, is it possible that these huge tech companies can go back up? What do you think about Chinese listed companies that have become a bigger story when it comes to investing here stateside?
I have no problem with the common shares, but people need to understand what they own. If you own Alibaba, you probably think that you tapped into the Chinese economy and the growth of these very, very exciting companies. In fact, you own almost nothing. You've invested in a Cayman Islands entity that has a contract with these companies for some of the economic interests. China could change the rules on that at any point in time. What would make these go up is if there was some kind of meeting of the minds between President Biden and President Xi, and we came out with some kind of kumbaya moment. But the downside is unmeasurable in these securities. Think long and hard before you add these to your portfolio. They could go up 40% overnight, but they could also go to zero.
All right, David, I want to ask about the labor market. You know, we got those JOLTS figures out, hit that record high, 10.1 million. Of course, on Friday, we got really large headline print for the jobs report for July. Now, we've been talking with folks, Octavio Morenzi, last week, pretty much saying that if the markets see a lot of strength in the labor market, that they're going to get a little bit spooked, because that essentially is what the Fed has been looking at least when it comes to their conversations around tapering and pulling some of that easy money off of the table. Are you sharing some of those same fears that strength in the labor market, while we might see some pops, and we did see some rallies, record highs in the markets on Friday, that this could essentially cause the markets to do a bit of an about face moving forward?
You know, good news suddenly becomes bad news, and that's what investors deal with all the time. And everybody wants a good thing; they just don't want too much of it because they think the Fed is going to take away the punch bowl. I think Jay Powell's made it pretty clear at this point that they want to push this as long as they possibly can. But I actually got a note from a client this morning about some of the pricing that they're seeing. They're a shipping broker, and they're telling me that containers in Shanghai, going outside of Shanghai, from December, $5,500 per container, that's now over $22,000. So to say that inflation right now is transitory, that's going to be a tough sell 6-7 months from now.
All right, David, lastly, what's your prediction for the consumer price index print that we will get on Wednesday? Do you think that it could have an upside surprise? And if so, do you think markets will blink?
We seem to take everything in stride, no matter how hot the number is or how cold the number is. We seem to translate it, well, it's bullish in here. And I guess it's because equities are really the only asset class in town right now. We don't want to go outside the United States. We're still the better place to be, despite our valuation differential. And bonds, we probably overshot on bonds on the downside in terms of yields. I have to believe the next leg has to be higher in fixed income. And that becomes problematic once we get above 2%. So we'll see what happens on Wednesday when we get that number. My guess is we'll probably turn it into a positive story somehow.
We'll have to chat with you after that happens. David Nelson, Chief Strategist, Bell Point Asset Management. Always great to have you here, David. And you can step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. You can get expert research reports, actionable investment ideas, and advanced portfolio tools, and much more in a sleek ad-light experience. You can check it out today at yahoofinance.com/plus. And coming up, get ready, crypto investors. Congress has drafted rules on cryptocurrency reporting and taxation. We'll be discussing that right after the break.
trillion-dollar infrastructure bill in D.C. may be held up by, among all things, a debate over cryptocurrency. But a bipartisan agreement was just struck about 2 hours ago that may get lawmakers past the speed bump, a readout from the bipartisan group saying that they've agreed with the Treasury Department to clarify the underlying text regarding how certain cryptocurrency holdings are taxed by the IRS. So let's dive a little bit deeper into this with Hugo McDonough. He's a co-founder at Cryptograph. And I guess I just want to start things off by asking about this news, Hugo. How do you think the crypto argument has played into these discussions, and have you been encouraged by some of the clarifications that this bipartisan group of senators is hoping to propose?
Yeah, I mean, it's super important when we're looking at general regulation of this space as it emerges, and the USA is a key driver of that. And so the initial part of this process, as I've been following it quite closely, I was quite worried by the initial wording and what they were looking at in terms of the amendment, because there seemed to be a very large knowledge gap between, the realities of how this industry works and the fundamentals of decentralization, and sort of trying to apply a reporting standard or, a regulatory tax standard, et cetera, to this space. And so, when they were talking about brokers almost encompassing, anything in this space, we could look a broker almost being a smart contract. That's an impossible thing to implement. And smart contracts are autonomous. And so for people to be able to collect reporting information for authorities, et cetera, on that, it would never have been possible. So I've been happy to see these amendments happen and the crypto industry within the US reply back to what was being put into this bill. And I think it's positive in as far as that they're moving through trying to understand the difference between proof of work systems, proof of stake systems, validators, miners, people who are developers and contribute to open source code, and all of these different parts of the industry. And they're beginning to articulate and understand how they work with each other, and where reporting standards or tax regulation is viable and where it wouldn't be viable. And so it's positive to see the movement towards that, and the movement towards understanding it in more detail. And I think that that will help reducing the uncertainty that's been around for, I think, the last few days in this space, given the discussions that have been happening in the Senate.
But Hugo, I don't know how lawmakers are, across the pond, but at least here in the United States, we've seen some not even fully understand how Facebook works and how Facebook, really earns money. And so you talk about this knowledge gap. It almost seems that if regulation can only come after lawmakers have a full and complete understanding on some of these things, we would never get regulation, not just for cryptocurrency, but for tech, or frankly, in a lot of industries. And regulation can't just not exist at all. I mean, is that really the solution here, that we need to wait for Congress to fully understand cryptocurrency in order to start some regulation on it? And is regulation going to be, do you think, a long-term headache, but really instead of just perhaps a short-term speed bump?
So I think that regulation is probably more of a short-term speed bump in my book. I think that long-term regulation for the space is sensible. I think it's a very, very, very fast-growing space, and there's a huge amount happening and changing. And what we do in my company is at the forefront of a lot of that, particularly within the NFT sector. And I think that it's very important that to do it well, you really do take a step back and you understand the intricacies here, because the crypto world and things done on blockchain in a decentralized fashion is very different to how we understand what I would sort of call the legacy system today. And so I do think that they should spend a lot of time thinking about how to apply frameworks to this industry, and not just trying to sort of hit a one size fits all into it and put something last minute into a must pass bill and try and increase, oversight or some regulatory system in that way. I think that's the wrong way to go about doing it. And so you're right that, if we had to rely on the speed of the lawmakers, things may never get regulated. But I think in the case here, it's important to take it step by step and really understand the fundamentals. And yeah, I think regulation is going to be good for the industry as a whole, and will allow for more of the early majority of people to enter this space. But it's got to be done well, and it's got to be done properly.
Hugo, I think what's interesting is that the current debate that's going on right now about infrastructure is not necessarily about the broad regulation of cryptocurrency as an entire asset class. It's really kind of zoned in on the definition of what is a broker, right? And whether or not that, by extension, that creates a government definition for proof of work versus proof of stake. But I guess without getting into the nitty-gritty of that, this brings up the question of intermediaries when it comes to people that own cryptocurrency and those that are miners, which I'm sure is transferable to a number of other crypto assets like NFTs as well. So do you feel like right now that this is an evolving space where it is still difficult to define that? Or do you think that it should be fairly clear to lawmakers, this is what a broker is, this is what a broker isn't?
I think that it's a very good question. I think that it is still fairly opaque because a lot of intermediaries and systems that we understand today, right? You know, there's a centralized party that we can go to that is the broker of this deal, whether it's a Forex platform or, you know, an OTC or whatever it might be, right? And in the case of the world and things like Ethereum, smart contracts can act as intermediaries. They can act as people or systems that take resource or value from one place, redistribute it, or do some kind of logic mechanism and redistribute it somewhere else. And so it looks like a broker, but it's actually a piece of autonomous code that, you know, can't be hacked, is not manipulatable, sits immutably within the Ethereum blockchain. And so, you know, for decentralized protocols that use those smart contracts, just saying that those are brokers is not going to work because they're not. They're something new. Where you have things like exchanges that are centralized authorities that pool, you know, buy and sell orders and have the currencies, you know, in hot wallets and managing those inflows and outflows, they are clearly providers that you can look towards and you can ask to do reporting and will have to come under various regulation. And the same can be said for other, you know, centralized companies that are building on top of these protocols and these layers that are offering services like that. But yeah, I think the definition of broker at one point was almost looked like they were trying to include smart contracts. In fact, or the definition could have gone towards that, and that would have been an impossible thing to even sort of countenance, really. Yeah. Because yeah, they're very different.
Absolutely. A very difficult thing when the asset class itself is always evolving seemingly by the day. But Hugo McDonough, again, co-founder of Cryptograph, thank you so much for stopping by Yahoo Finance today. Coming up, Panera Bread making a play to scale up in the fast casual restaurant space. The company's CEO joins Yahoo Finance to share how coffee and bagels factor into that strategy. We'll be right back after a quick break here on Yahoo Finance.
Panera Bread, Caribou Coffee, and Einstein Brothers Bagels have announced the formation of Panera Brands, a new merger they are calling a powerhouse platform in fast casual. Panera CEO Naren Chaudhary joined Yahoo Finance to discuss the partnership. Take a listen.
The trajectory has been very strong. And as you mentioned, I think as a result of the macroeconomic conditions like stimulus payments, vaccinations, and a general desire for consumers to get back to the life as they once knew it, coupled with some of the pivots we made as brands through the pandemic, more off-premise, more digitally focused, and rapid-fire innovation, we are seeing a tremendous recovery across all three brands this year. And in fact, the momentum is building week on week. So we're feeling very good about where we are and how things look going forward.
Take us through why you're bringing all these brands together under one roof. Are they going to share rewards programs? Are they pulling from the same food suppliers? How are you thinking about it?
Yeah, I think so. It's a very exciting development. If you think about it, this creates one of the world's largest fast casual restaurant brands with 4,000 stores across 10 countries, 115,000 employees. So, much larger in scale. And I believe we can be stronger together and we can grow faster. So the real reason to do this is to leverage the competencies that we have, such as our digital ecosystem, our omni-channel network, our supply chain, as you mentioned, our innovation strength, and also the capability of franchisees that we have at Panera Bread, and that we can leverage these assets across all three brands to grow much faster. That really is the intent.
It's also a pretty easy way to tell Wall Street a story. Do you have any timeline on when you might become a public company again?
Well, as you can imagine, we are always thinking about various options all the time, but at this point in time, we have not really made a specific decision on when exactly that might happen or if it's going to happen.
It's Julie here. I have a little bit further questions on bringing the three brands together. Do you expect to have cross-selling? Are you going to have Caribou Coffee in Panera Bread, for example? Are you going to sell Einstein Bagels in a Panera, for example, or in a Caribou? How is that all going to work?
So I think the way to think about this is that we believe that these are three iconic brands with unique roles in the lives of our customers. So we're going to be very focused and dedicated at ensuring the independence of these brands and make them the best version of themselves, respectively for our consumers, whilst leveraging the back end to really turbocharge growth across all three brands. But so I don't really see any cross-selling, et cetera, happening. We just want to delight our customers who are looking for those specific value propositions across each one of those individual brands. I think the good thing is that these three brands are very complementary. So Panera leads on lunch, Caribou Coffee leads on coffee, and Einstein Bagels leads on breakfast. So they're very complementary, synergistic, and we plan to grow them faster by leveraging our unique competencies at the back end.
Yeah, Naren, I was thinking about the different day parts, as you guys will call them, that they fit into, and it seemed to me as a portfolio of, if anything, maybe skewed slightly more towards the morning hours with the coffee and the bagels together. And I'm curious how you guys have seen that part of the business. We hear from a lot of competitors in the fast casual space that they're all very interested in breakfast. They want to make more breakfast investments, but certainly with these three already have a strong foothold there. How have you seen that specific day part as a growth area?
So I think the pandemic has been transformational in the way in which consumers are accessing brands, as you can imagine. And interestingly, lunch has had headwinds. Even breakfast has not been that strong as it was before. The day part that has really exploded has been the dinner evening day part for families at home, working from home, and the weekend day part, interestingly. So therefore, over the last year or so, we have not only protected and strengthened our breakfast and lunch day parts, we have gone very aggressively for evening, end of the day family meal solutions. At Panera Bread, we launched the flatbread pizza, and we launched warm bowls as a meal solution for families for the evening day part or for the weekend. And we partnered very quickly with third-party aggregators so our consumers could access our offerings for that additional day part is the evening day part. So I would think that probably Panera Brands is a unique combination of brands that have relevance across all three day parts, not only breakfast and lunch, as you mentioned, but we are seeing tremendous tailwind and growth in the evening day part as well.
When your parent company purchased Caribou in December 2012, it had about 610 stores at the time of the deal. Now, about 713 or so. Why hasn't growth there been faster in terms of store base? And is that chain profitable?
That chain is profitable. In fact, all of our three brands, the brands are strong, the model is profitable. And I think coming through the pandemic, we have actually become even stronger, all three brands. The brands are stronger, the model is stronger. We're looking at asset-light models go forward across all three brands to accelerate growth even faster. So these are smaller box stores with fewer seats, more off-premise orientated, more digitally fired up, so that we can really serve our customers in the best possible way as they emerge with these fundamental changes in the way in which they're accessing these brands. So yes, all three brands are profitable, they're doing extremely well. And I expect that with this creation of the platform, the growth of both Caribou and Einstein Bagels will be much faster than it may have been before.
And that full interview can be watched at yahoofinance.com. Coming up next after the break, a look at the energy markets as oil continues to slide. That's next.
Oil on the move after China announced some new restrictions in response to the spread of Delta. No surprise, given China is the world's biggest importer of oil. Yahoo Finance's Jared Blickery is here with more as prices just settled. So Jared, how did oil react through the trading session today?
To the downside, and right now we're looking at the energy sector heat map. Just wanted to show you some of the numbers here. Chevron down over 1%, Exxon down less than 1%, but the real action in crude oil hitting the lowest point in about 2 weeks. That would be $65 per barrel at the lows earlier this morning. Now, if we go to a longer term chart, this is a 2-month chart. We can see we hit those levels this was just about 2 weeks ago as we were talking about, and this is a level that's been in play for some time. If we go back 1 year, we can also see the activity to the upside when it was resistant. So 65 a big level, but so is 60. And we've had a couple people on citing potential to go down to that level. Demand concerns with China. They released some import-export numbers overnight. They didn't import as much crude in July as in June. So those lockdowns and pre-lockdowns definitely having an effect. And we're going to continue to monitor the price of oil as that important sentiment indicator all of this week, guys.
All right, thanks so much. Yahoo Finance's Jared Blickry right there with the update. Now, Kristen, I want to just shift gears here, literally shift gears. We're going to talk about used cars, but I heard a rumor that you are purchasing a car today.
I am purchasing a car, and it has been a very painful and also a very expensive process.
You bought new or used?
I bought used. Okay. I had to. I mean, if you look at the new car prices are ridiculous. And actually, you know what? It's not even the prices, honestly, guys, if anyone's out there trying to buy a car. It's literally the inventory. I have been to no less than 6 car dealerships, like Toyota, Nissan, Volvo, Volkswagen, and there is nothing on the floor. They have nothing.
And whatever they do have, prices are...
And whatever they do have is $4,000 or $5,000 over MSRP. I don't know if that's because we're here in New York, and maybe you can get a better deal if you're in the Midwest or something, but prices here are crazy. There's absolutely no cars left.
What'd you end up getting?
I got a Volvo.
Volvo, very safe vehicle.
Fingers crossed it all works out, because that's what every millennial wants to hear about the car they have.
Hopefully they actually have it on the lot. Yeah. But what you're seeing is definitely emblematic of everything that we've been seeing when you take a look at consumer price index data that shows that used car and truck prices were up 45% higher in June 2021 than they were in June 2020. So let's talk a little bit more about this with Roto CEO Nathan Hecht. And Nathan, you get a very good idea because your car leasing platform Roto really tracks a lot of this very closely. So Nathan, I guess the basic question here, why would anyone like Kristen buy into this market?
First of all, guys, thanks very much for having me. I appreciate it. I think the only reason you buy into this market today is if you really need a car. Otherwise, the market's very hot. Market prices for new vehicles are, very close to an all-time high. Market prices on the retail side of used vehicles are also very high right now. So unless you desperately need a vehicle, maybe try and wait until the back end of this year to try to get something more competitively priced.
All right, I feel a little bit attacked because now everyone knows I desperately need a vehicle. But okay, so Nathan, so I hear what you're saying. So then how long is that inflated pricing really going to last? Am I going to have to wait? Am I or others who are tired of these incredibly high prices, do we have to wait until 2022 essentially hits before we can start to see some of those prices in both the new and used car markets start to come down?
So the market is starting to give hints of normalization literally as we speak. Last month, the market corrected for new and used again, but ever so slightly. As we get into September, October, November, new car inventories should start to replenish, not to their normal levels, but just replenish as factory output increases. So as we start to see new car inventories increase, there'll be less of our consumers moving over from new to used, which should soften used car pricing a little bit as well. But you really shouldn't worry, because it's not like you're going to wake up tomorrow morning and suddenly you're going to see this massive correction in pricing, either new or used. So it'll take some time until we start to see this normalization really take place. What time could mean anywhere from 6 to the next 18 months or so.
So Nathan, your company provides same-day delivery service that helps facilitate purchasing and leasing of vehicles. And it was interesting because we just had the U.S. Express CEO, Eric Fuller, on in the 1 p.m. hour talking about how the cost of shipping things on flatbed trucks are getting more expensive. So when it comes to just your business, right, moving cars from where the dealerships they might be and then the person that's ultimately buying them, have your costs increased? And what other types of, price pressures are you seeing that makes it maybe more expensive for even your customers across the board?
Yeah, so actually for us, this is an exceptionally good market because demand is extraordinary. And for new cars, we also buy used consumer vehicles on our app and on our website, roto.com. And consumers really come to Roto to never walk into a car dealership. So if you're in the market to lease or buy a new car, you come onto Roto, you'll see inventory from a vast array of dealers, and you'll see actual monthly lease payments or monthly finance payments. You place an order, and then the dealer that vehicle is coming from delivers the car directly to you. So for us, the market is really healthy right now because consumers need more choice. They want to see a broader array of inventory, maybe from dealers that are not necessarily, that close to them. If they went 50 miles out or 80 miles out, consumers can see dealers that have inventory that they don't have locally. So from that perspective, business has been very robust with consumers coming through. The same for dealerships on our platform. They're looking for consumers really wherever they can find them. So they come to Roto to show their inventory and to receive orders from consumers across the country. So we're really price agnostic. And just the fact that that inventory is so tight right now, consumers are really scrambling wherever they can to find a car to begin with. And the marketplace dynamics of Roto will still allow you to find a car competitively priced.
I'm curious to know here, if you think that some of the pandemic era changes and also some of the changes that people have been forced to make as a result of some of these, inventory shortages, perhaps like purchasing online, not even wanting to go into the dealership. Now, of course, considering trying to buy a car if you're in New York, that might be in Texas or California and having it shipped to you. Do you see that lasting even after the pandemic is over? Do you think these shifts have been permanent or do you think they're temporary?
Sure. So we started this company about 2.5 years prior to the pandemic, and we already saw a shift of consumers moving online to buy a new vehicle. Then, obviously, on the used side, there are some other players that have been selling used cars online for quite some time prior to the pandemic. We think the pandemic, just really, moved things, accelerated them, no pun intended, faster than we were originally anticipating. And there's no hints of a slowdown at this point. When you look sort of at consumer adoption of different products historically, from the offline to online migration, once consumers take to something online, typically they stick with that because it's probably better, more efficient, et cetera. So, we're not seeing any hints of any slowdown, or at least when COVID sort of slowed down a little bit, and we anticipate this trend to sort of continue, if anything, just faster coming out of the pandemic, hopefully soon.
Really quick, Nathan, I wanted to ask if leasing, do you think, has become a far more attractive option, especially as the cost to own and to finance has really increased? Are you seeing more folks transitioning instead into the lease market?
The answer is yes. In general, the trend for the last 5 or 6 years has been consumers moving into leasing versus financing. As younger consumers now come online as well, their tendency is to hold on to things for a shorter period of time. So that also has an impact on lease versus buying. And definitely, as we think about pricing as it is right now, you may want to get something for a shorter period of time and wait until the market calms down a little bit before you commit to something for the longer term. So for all those reasons, probably lease versus finance is the way to go.
All right. Well, I was looking at those car prices, man. I should put my Subaru Legacy with the windshield crack up on the market right now. But Nathan Heck, CEO of car leasing platform Roto, thanks again for stopping by this afternoon. And coming up on the other side of this break here, New York City is about to require proof of vaccination to dine out and drink. But what's the legal backing behind the city's mandate? We'll discuss on the other side.
Welcome back. Vaccine mandates are coming to New York City and will test a very old court case, 116 years old to be exact. We have Alexis Keenan here to break down Jacobson v. Massachusetts and what the decision could mean for government vaccine requirements. Hi, Alexis.
Hi, Kristen. Thanks. So, yes, New York City is set to become the first government in the country to ban unvaccinated people from indoor spaces. That will come starting August 16th. That's for anyone unvaccinated will have no right at that point to visit indoor restaurants, gyms, and entertainment venues. The same goes for workers in those locations. Everyone will need one dose. And the text of that rule, though, has not yet been released. Now, the reason that this policy is so closely watched by legal circles is because it's the first time that a state or a local government made COVID-19 vaccination mandatory for the public. Now, that is entirely different from a company or a university setting vaccination rules for workers or for students, for example. Now, constitutional law experts, they say that New York should absolutely be expecting legal objections to this rule because the law is in an area that is a bit unsettled. Now, the most likely challenges, they say, will come from a scenario where if the city makes no exceptions to that general rule for those who decline vaccination because of a medical condition, a religious belief, or even a disability. But to really try to handicap how the courts or even the Supreme Court would decide these issues, you have to go back all the way to that court case you mentioned. It's a 1905 case, and it's called Jacobson v. Massachusetts. And there the court held that the state's smallpox vaccine was legally okay. Now, despite that decision, though, the court didn't address some of the key points, and that's where the city could get some pushback on this law, as could any other city or state that adopts this type of a vaccine requirement. Now, the court didn't directly deal there with these instances that I mentioned earlier, underlying medical conditions, perhaps a disability, and importantly, there was no Americans with Disabilities Act at that time to even challenge this rule. Also, religious beliefs, those were not raised in this case. So ultimately, these experts say that the strongest legal argument for those who want to oppose this rule will come from the constitutional right to be to freely exercise religion. That's the one that they think is the most key. Whether or not those underlying medical conditions will stand and disability, whether those will be good arguments, yes to underlying medical conditions. But aside from that, really it's that religious argument that has a chance, they think. Now, this new policy, it will be, as I said, officially effective next Monday here in New York City. The inspection and enforcement mechanism, though, will be rolled out starting on September 13th. Kristen and Brian?
All right. Thanks so much, Alexis Keenan, for breaking all of that down. I didn't know I was going to be getting a civics lesson in a very old court case today, but I'm glad that I did. Thanks so much. Coming up next, we've got a preview of AMC's earnings. That's next.
Welcome back. Almost 3 p.m. hour here on the East Coast. Let's take a look at shares of AMC up about 3% ahead of their earnings call after the bell today. Yahoo Finance's Inez Ferre is here in studio with the preview of what to expect. And Inez, I guess the question is, what should these meme stock investors be listening for in that call later this afternoon?
Yeah, that's right. Well, Wall Street will be expecting a loss per share of 93 cents. Meanwhile, revenue of $382 million for the second quarter. Now, that is much higher than the second quarter of last year when the whole country was on lockdown. But if you compare that to 2019, in 2019, the company had reported revenue of $1.5 billion for the second quarter. So, of course, this stock is really trading unlinked from fundamentals, from what Wall Street is expecting. If you take a look at a year-to-date chart, here we go, up 1,490%. In January, the stock was at about $2, just above $2 a share. Then it spiked up on that short squeeze when Reddit retail traders got a hold of this. And then you're taking a look here in June, it went up to a high of $72 a share. So what will Wall Street be expecting? Well, Wall Street expects that you are seeing a recovery when it comes to people going back to the theaters, but still a lot of unknowns when it comes to the Delta variant. So a lot will be paid attention to on that call as far as where this recovery is going when it comes to theaters. Of course, AMC is one of these stocks that, again, trading unlinked from the fundamentals, and really Wall Street is going to be paying attention to what happens to this stock, of course, once these earnings or loss per share are reported this afternoon.
All right, unlinked from the fundamentals. That seems to be the story across all the meme stocks. But Yahoo Finance's Inez Ferre, thanks so much for giving us that preview. Now let's take a look at where markets are again as we head closer to that 3 p.m. hour. The S&P 500 again kind of unchanged from where it ended the day on Friday, but the Nasdaq getting a little bit of a bid by 0.25% there. Also keeping an eye on the U.S. 10-year longer-term bond. It seems like it's lost a little bit of steam, but quite honestly, not that much. Still up if you're rounding up about 3 basis points to a 132 handle. And obviously, we're also keeping an eye on what's been going on in Bitcoin at a 46,300 handle on that cryptocurrency. But we'll be having the full coverage of the earnings over there at AMC. That'll be coming in our 3 to 5 p.m. hour block. Yahoo Finance's Adam Shapiro and Shauna Smith will have you for that coverage. But for Kristen Myers and myself, Brian Chung, thanks for tuning in for the last 2 hours. More Yahoo Finance coverage will continue on the other side of this break.
Dow and S&P retreating from last week's record, and you can see that S&P, though, not too far from the flatline. Stocks tied to the reopening are taking a hit. Energy, it's the biggest laggard. Oil falling to its lowest level that we've seen since May, building on last week's losses as a jump in COVID cases triggered demand concerns. Now, COVID infections are rising. More kids are contracting the virus, and children's hospitals in some states are starting to get overwhelmed. Dr. Sarah Moran-Bodie, she's of the American Academy of Pediatrics Council on School Health. She is going to join us to discuss how to keep our children safe and also what this could mean for back-to-school plans. And AMC, a retail investor favorite, it's set to report earnings after the bell today. Some are calling this a, quote, pivotal moment for the company. The stock is one of the most talked about stocks on Wall Street bets today. Of course, this has been the case for the last several months. Today, though, we are getting those results for you, and we, of course, will bring them to you as soon as they cross the wires. We've got an hour to go as we wrap up the first trading day of the week. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. As we take a look at the markets, they are down. I mean, the S&P 500 is off by 1 point. The Dow is off by 74 points. The NASDAQ, however, it's positive, almost 40 points. And crypto, Bitcoin, is above $46,000 a coin. There's a lot going on in these markets as we start the session of trading for the week. And let's check in with Jared Blickery to bring us up to speed on what's driving all of this. Jared?
Yeah, well, it's a bond market yet again. But first, I want to go to our global indices market or map on the Wi-Fi Interactive. And we can see a mixed market in the U.S., more red than green around the world. But the NASDAQ notably up the most. That's about 0.25%. So not a huge move there. Some of the standouts here, Tesla up 2%. And I'm going to sort by performance. Moderna in the upper left, that stock is up 17%, coming a week after their earnings. A lot of speculation about booster shots, followed by a couple Chinese names which are bouncing back today. Pinduoduo up over 6%. So is NetEase, and then JD.com up over 3%. Other than that, kind of a mixed picture here. And let's take a look at the sector action. Financials are outperforming. We're seeing the 10-year yield surge yet again. That's followed by staples and healthcare and then consumer discretionary. So a combination of both value sectors and also some defensive sectors surging. Now, I did mention healthcare, and I do want to focus in because we have not only Moderna surging, we have the vaccine stocks just jumping out of sight. BioNTech, that's up 14%. Novavax up 13%. You take a look at the 5-day price action, some really impressive return. BioNTech and Moderna both up over 30%. Vaxart up over 20%. Novavax up there just with it. Well, the travel sector not performing. Well, that's over the last 5 days. We're going to go back into an intraday basis and not performing that well today. We're seeing United Airlines, that's down 2%. Carnival Cruise Lines, that's down 1%. So some concerns over the reopening, but a lot of it has to do with China. And we're seeing that reflected in the price of WTI crude. I'm going to go to a 5-day look here, and you can see the drop that we had overnight back down to $65 support. That's coming off of some lockdown talk coming out of there. Also some weak import and export figures. So want to keep an eye on that. And then finally, Bitcoin up over $45,000 in holding. That is some very nice price action. 45,000, one of my key levels. Need to hold above there for about 24 hours or so to confirm, but definitely going to be keeping an eye on that, guys.
All right, Jared Blicker, thanks so much. We're going to be talking about crypto a little bit later on in the show. But first, we want to talk about some of the massive movers that we're seeing in the broader market today. Jared was just talking about the fact that we're seeing some of those reopening plays under a bit of pressure. United, one of those names that he mentioned, off just around 2%. Carnival off around 1%. And this is as investors get a little bit cautious and a little worried about the rise of the Delta variant. So we want to talk about all this with Nancy Daoud. She's Ameriprise Financials, a private wealth advisor. And Nancy, I guess from your perspective, how big of a threat do you view the Delta variant being to stocks here going forward?
Well, I think there's been a lot of talk about a potential shutdown. I happen to believe that that's highly doubtful. I think the general public would feel that that would be a tremendous move backwards, and it would be very, very discouraging. It's more likely that we're going to have many more mask mandates, vaccine mandates, and in more localized pockets of areas, as opposed to, the entire country shutting down again.
So let's look at areas where there's opportunity without shutting down. For instance, healthcare. And you've pointed out, and I think a lot of us are wondering about, the mRNA technology that brought us these vaccines. It's not one and done. Are we going to start seeing dramatic changes in the protocols to treat all kinds of diseases based on these vaccines?
Well, I mean, I'm not a scientist, but the messenger RNA is clearly a breakthrough, and there's a lot of innovation around that, and the technology around it as well. I think we're going to see some amazing outcomes from that in the next few years, definitely in the next decade. But what form it will take place, it's hard to tell. But so far, it has been somewhat of the miracle that we were able to have this vaccine in such a record time, as opposed to the years and years and years that it took prior to develop a vaccine.
So Nancy, with the market at these levels, the Dow and S&P, they're in the red today, but they're not too far from their record closes, obviously, on Friday. Where are you seeing opportunity? You mentioned healthcare there, but outside of healthcare, where else are you seeing some opportunity at this point?
Well, clearly technology will continue to be the mover, as well as healthcare and anything surrounding the vaccine. There's still a very, very large number of the population that has not been vaccinated. So we're going to see more about that. Home improvements continues to flourish. Certainly the real estate boom is very much alive and kicking for a little while longer. Commodities will be up and down. I think it's important to realize that also things that are going up significantly will probably level off after the economy reopens and things feel more like normal again, but still will not go back to pre-COVID levels. It'll still be up.
But we actually had that partially happen earlier this year when people were transitioning out of big tech into more value-oriented stocks. But you don't think tech is overvalued just yet. What's your trajectory on tech?
Again, if I had a crystal ball, it would be so easy. But I think technology is definitely the sector that will continue to flourish. There's so much innovation going on across the board. And it's very far from over still, in my opinion.
Nancy Daoud, Ameriprise Financial Private Wealth Advisor. Thanks so much for taking the time to join us. We need to talk a little bit more about oil because oil taking a pretty big hit today, closing off just over 2%. Some concerns about the Delta variant, what we're seeing play out over in China and what that could mean for demand going forward. We will talk to Scott Bauer on the other side of the break. We'll see you in 2 minutes.
All right, welcome back to Yahoo Finance Live. We're still about 49 minutes to the closing bell. I asked the team to pull up oil to show you what's going on. WTI, $66.81 a barrel. It's important because our next guest, who you know well, actually was with us about a month and a half ago talking about the fact that oil, probably a good time to look at some shorts. And now this individual is looking at going long on oil. Scott Bauer, Prosper Trading Academy CEO, is here to explain what is driving the crude markets and whatever happened to the discussion of $100 a barrel. That was overblown, wasn't it?
Well, it was overblown, at least temporarily. And, everybody got caught up with the reopening play, and, maybe for good reason. But as the new variants started coming into play, which, this didn't happen overnight. This has been out there for a couple months. The demand just started pulling back a little bit. So I could not see us getting above that 75 level. And that was a level that I put out there, in multiple places saying, I really believe this is a great area to get short. Always use stops. So, if the thing does explode, you're protected. I have covered those. I definitely have covered those. I haven't gotten long yet, but I really think that the 65 level, maybe if we hit 64.5, that's a great area to start getting long again. And the reason that we're seeing this big pullback, Jared had just talked about it in the prior segment. Really, a lot of it is about China and, the expansion, unfortunately, of the Delta variant there and their lack of demand, or, the massive slowdown, if you will. And they are just not importing the amount that everybody thought they were going to. So that has really put a scare into the entire marketplace. And then, of course, we have to talk about the dollar, Adam. I mean, the dollar is as strong as it's been in quite a while. And certainly when we see a stronger dollar, that does not help, anything in the commodity space.
So, Scott, it sounds like you think that we're at least near the bottom for crude, at least in the short term. Is that correct?
I do. Can we go down to $60 a barrel? I think we can, but hopefully, and I'm not a scientist, I'm not a doctor, but certainly based on what's happened in the UK, it looks as if maybe 2 to 4 weeks from now, maybe it's even 6 weeks on the longer end, but that we may hit, kind of the top in the spike of the Delta variant. And I think when that happens and we start to see cases go down again, which we all hope is going to be sooner rather than later, we're going to start to see an acceleration again. So I think we're closer to that. I think we're on the other side of the midpoint, if you will. And I really like starting to accumulate some long positions just below where we are.
Scott, when you talk about that strong dollar pushing down commodity prices, we know there's demand for the, inputs. Let's just look at real estate, for instance, like lumber came down, copper has come down. What you just said tells me all of that stuff's going to go back up. Would now be the time to look at perhaps buying some of those futures?
I would. I would start, buying piecemeal into it because, listen, the Delta variant and everything else going on with COVID can change on a daily basis. Nobody knows the exact timing of when we've seen a top, when we've seen a bottom. But given the massive fall off in prices that we've seen from very lofty levels, albeit in lumber and copper, yes, I would start accumulating some longer positions again.
Hey, Scott, when will these prices be reflected at the pump? Because we've seen a massive drop in the price of crude over the last couple of weeks, yet the price at the pump hasn't moved too much. Why is that the case?
It is because what we have seen is actually a big buildup in stocks reported by the EIA of crude, but a drawdown in gasoline. So even though the oil output is starting to come down a little bit, people are still driving. So it's the middle of summer and people are driving. The demand for gasoline is still there. We haven't really seen that wane yet. So you would think that one really should feed into the other. And, I get as upset as anybody when I see that I'm paying $3.50 to $4 a gallon when I see what's happening to the price of crude. So we're probably not going to see gasoline prices come down very much, maybe until we get into the fall, quite honestly.
Shifting from gas to gold, what do you attribute the drop in gold that we witnessed over the past couple of days? What's going on there?
Yeah, so a lot of people were talking about a fat finger, instance last night where we saw the, if you will, a mini flash crash when when gold just got absolutely hammered. But really what I think it was gold hit a critical level around that 1730 to 1740 area. And as soon as that happened, you got a lot of sell orders that came into the market, a lot of stop loss orders that came into the market. Also what happened, because it was overnight, there's a holiday in Tokyo, there's a holiday in Singapore, and a lot of traders were gone. Volume was very light. So I think what happened overnight can be attributed to that. Now, the longer term trend absolutely is to the downside here. And the fact that we broke through that 1730, 1740 area, that is pretty critical. And that's now going to be something to watch as gold rallies, whenever that is, whether it's today, tomorrow, next week. But right now, the pressure is certainly on gold with, the dollar, with the Fed in all likelihood coming to the table shortly to announce that they are going to start tapering, whether that's imminent or a few months down the road.
Scott, how low do you think the price could drop here?
I think we could see sub 1600 or 1700, excuse me. I would look for about 1680 area here. That would be my next point where I'd want to start taking a long position.
I wanted to follow up on that, and the producer is telling me I have to wrap, which is a perfect way to say, Scott, you got to come back because we want to talk about this, especially after Jackson Hole, once we find out if the Fed does give us any discussion about the discussion of when the discussion will take place on taper. And no kidding with the way they phrase that. It'll be a discussion about a discussion. All right, Scott Bauer is Prosper, the Trading Academy CEO. It's always good to see you. Thank you for being here. When we come back, a lot of kids heading back to school, a lot of controversy over COVID-19 protections and whether your school district's going to mandate where they should wear a mask. Some states, the governors are saying that the school districts can't, yet districts are going to not obey those edicts from their governors. Let's talk about all of this with Dr. Sarah Moran-Bodie after the break.
Because of the Delta variant to children, we are seeing this play out in states like Florida, where the number of pediatric cases for COVID-19 are continuing to climb. We want to talk about this first with Anjali Khemlani. And Anj, we saw record numbers in pediatric cases out of Florida over the weekend. What does this tell us just about what we could expect going forward?
Well, this really sets a concerning tone, as we know that, a lot of individuals are watching the trend line for kids and cases specifically with kids as we talk about the start of the new school year. Florida setting the tone for that, as well as other states when it comes to generally and broadly cases and the rise there. We know we've been watching Florida as it became the new epicenter of the pandemic in the recent weeks, and now Texas as well. And the one thing that these two states have in common is that they've decided to really restrict any mandates or any sort of strategies that would help curb the transmission. Florida specifically saying that it would penalize school districts that choose to implement any sort of mandates or other physical distancing restrictions. And that is setting a really concerning tone. Health experts are very concerned about what this means, what the count will then end up being, because as we know, children remain unvaccinated largely, especially in the school age group. So that's something that will be interesting to watch as the days come closer when it comes to the start of the school year.
All right, Anjali Khemlani, thanks so much. We want to continue this conversation, talk about what we could expect really going forward in this school year. We have Dr. Sarah Moran-Bodie of the American Academy of Pediatrics Council on School Health. Also, our education reporter, R.T. Swaminathan, is joining the conversation. Dr. Bodie, from your perspective, I think so many parents who are getting ready to send their kids back to school over the next couple of weeks are very confused. They don't know what's safe and what's unsafe at this point, just in terms of what they should be doing to best protect their children. So what's your advice?
Yeah, great question. Thank you. One of the things we know is that first we want to prioritize getting kids back into school. It was really challenging for kids to have online learning last year. It was not ideal for academics, for social emotional learning. The other thing we know is that when kids did go back to in-person school and schools used those safety measures, they worked. So when kids all wear masks, and that's universal with the hand washing, good ventilation, we can get kids back into school and have it be safe. So as a parent, I think it is really important to understand what is your school district planning to do to help promote those safety precautions, and what are they putting in place to keep your child safe from COVID?
Doctor, we've seen a lot of cases of children contracting COVID, right? So what do we know about the Delta variant? How is it different? And why was the first instance of COVID not as impactful as the variant, right? Lots of questions. So can you help us a little bit about that?
Yes, absolutely. So the Delta variant, has been the predominant variant that we've seen recently. And as COVID has progressed, we've learned a lot over time. And what we know is just like in adults and kids, this Delta variant is just more infectious. So meaning it's easier to pass from child to child or child to parent and adult. And so it's concerning to us if we're having kids back in school without any of those other protections in place. We also know that as many of our older adults got vaccinated, and that vaccine rate is high, our kids aren't vaccinated. So as we're seeing COVID trend, we're seeing more cases in kids. A higher percentage of everyone with COVID is young adults and kids now. And so this is a concerning trend we want to watch and make sure we're protecting our kids until they can get vaccinated.
So what do you make of all these states like Florida who are basically telling it's up to the school district, some of them saying, no, schools can't even mask their children. So it's a really difficult decision that parents have to make. So how do you reckon with this? And do you think these southern states will ever follow CDC guidance?
So I think it is really unfortunate both for school districts and for parents as well, because we put school districts in tough positions when we, number one, don't support them with these safety measures. This worked last year. Students went to school, they wore their mask, we had good compliance with this, and we know that it was effective. And so I think if you're a parent living in a community, it's important for you to have a voice. And so you should be contacting your school district to make your thoughts and opinions known. We know that masking works when everybody wears the mask. So setting those expectations and making it normative for students that everyone should be wearing a mask, that's just the expectation when they get on the bus, when they get into the classroom, will go a long way towards not only getting kids back to school, but keeping him there, not having another outbreak. So for all these school districts, one of the things they need to consider is if they don't put these mandates into place and then people aren't masking their students, then they may end up in an unfortunate situation where they're all back to virtual learning again as they get outbreaks within those classroom settings.
Doctor, I was reading that I think it's the Shelby County school system in Tennessee invested greatly in refurbishing their ventilation systems. And I think they discarded those plastic barriers, which really, I'm told by different doctors, don't do much of anything. What questions are you getting at the council from school systems? Do they involve ventilation? Do they involve other issues?
All of it. So when we look at school districts and help support them, there's so many different measures that can be helpful. So one of them is just the setup of the school, right? So if you're in a high-risk situation, like take lunchtime, for example, when no one's wearing a mask because they're eating, then what can you do to maximize both the ventilation and the physical spacing during that time? How about those high-touch surfaces like lockers and the flow of hallways? We work with school districts extensively at the Academy of Pediatrics and even the CDC to help them navigate all of those different situations. And many schools have certain specific setups. Some can afford to upgrade ventilation in one way. Others are being creative and using a lot of outdoor spaces to help, again, with that natural airflow.
Doctor, I think all of this brings up the question about vaccinating our kids and what that timeline looks like and what it should look like at this point, since the Delta variant seems to be such a threat to our children. What do you make of the timeline, I guess, at this point? And do you think maybe we should think about vaccinating our children under the age of 12, maybe a little bit sooner than we had initially planned?
So I think, the FDA is really going to go ahead and follow their typical process for this. We always say that kids are not little adults. So those studies have not been rushed. They've been done very well and thoughtfully. Pfizer in particular has had great studies initially, and now all of the other vaccines following suit on kids. So I think it is coming quickly. And I also do think we know that if we put these safety measures in place, they work. So until that vaccine becomes available to all of our kids under age 12, we can get them back to in-person learning if we follow these measures. So I think, we're not going to rush it. We're going to study it just like we do everything else. We're going to make sure these vaccines are safe in kids, and we'll go through and authorize those as quickly as possible.
Doctor, returning to some of the cases that we've already seen, what do we know about the symptoms of COVID of the Delta and the Lambda variant in kids?
So we're seeing similar symptoms that we did in previous variants as well. So this can be confusing in the wintertime especially, but even now as kids get back to school, because COVID symptoms in kids can look like a lot of other viruses that we see. So you can have mild cold symptoms. You could even then progress to have more symptoms that look more typical of a pneumonia. And even some kids in rare cases do get hospitalized and need that sufficient respiratory support as well. So one of the things that we really talk about is that in addition to having these safety measures in place, you have to have a process for quick identification and testing. So if you do have a child that has a fever and some cold-like symptoms, it's really important to get them seen quickly to have a COVID test to identify, is this COVID or is it something else, one of the other rhinoviruses or enteroviruses that we see this time of year.
Doctor, I realize the children born in the last 6 months since the vaccine regimens have started rolling out are not school age eligible. Do we know anything about their immune response since their mothers might have had vaccine while they were in utero?
I think that's to be determined yet. I don't think we have definitive evidence either way, but the more that we can get people vaccinated across the community, and there is often passive immunity then that can go around in your community, the better we can protect these young ones from COVID. So again, I think it's still critically important for all of the adults to get vaccinated and do their part to, again, help protect these kids that can't get the vaccine yet.
Dr. Bodie, great to speak with you. Dr. Sarah Moran Bodie of the American Academy of Pediatrics Council on School Health. And of course, our thanks to R.T. Swaminathan as well. And we are going to continue this conversation. We've got a special for you that's airing tomorrow. It's our Road to Recovery Back in the Classroom special. We will be hearing from high school students about virtual learnings, the impact of the pandemic, and also their hopes for the upcoming school year. That starts tomorrow at 4:30 p.m. Eastern Time. You won't want to miss it. We'll be right back.
Okay, we've got the 2 and 2 for you. 2 stocks Shauna's watching, 2 stocks I'm watching. People love Tesla, Shauna, so let's take a look at what's happening with those shares. They've been trading higher all session long, and look at that, back above $700 a share. Right now, up about 2%. Part of this has to do with an upgrade from Jefferies analyst Philippe Hochoy, upgraded the shares of Tesla from hold to buy, cited their earnings, accelerated earnings, as well as the return on investment capital, says it's a benchmark for capital employed. But the other thing in the note they talked about was that the whole industry, the auto industry, they're bullish over at Jefferies about manufacturers' ability to improve margins. They're operating with less and they are using their capital wiser. Bottom line is they're going to wait to see how they build dealer inventories, but because, of course, the chip shortage is having an impact. Then there is Coinbase. Coinbase off the charts today, up about 8%. Stock is trading around $279 a share. Trading since April, remember when they went public, it was a direct listing, priced at $250, it shot up to $429, then it fell, and again, now trading around $279. 90% of the company's revenue, at least last year, came from transaction fees on trades. They're going to report tomorrow after the closing bell. They're going to get their quarterly earnings, and you're going to want to pay attention to their growth in verified users. Shauna?
Adam, let's take a look at Moderna because it's really been pretty incredible what this stock has done over the past month. Today, it's up another, 17% right now, just over 17%. It's the best performer by far in the S&P. It's up just around 100% in the past month. 2 things that are driving the stock today: conditional approvals out of 2 countries, Australia for its vaccine, and then in Switzerland for children ages 12 to 17 years old. And we're seeing gains in the stock, trading today just around $484 a share. Flipping over to Norwegian, now we've been taking a look at these reopening plays that are taking a hit. Norwegian off just around 0.7%. But the big story with Norwegian today is that Florida is saying that it is set to appeal a federal judge's decision after the judge decided with Norwegian Cruise. Now, this is over whether or not the cruise line could enforce vaccine requirements. Florida is opposed to this. Norwegian obviously tested this and pushed forward with this. So Florida is now saying that they are going to appeal the federal judge's decision. Now, Norwegian is sticking with its policy to require full vaccinations for all crew and passengers, including children, for their initial sailings through at least the end of October. Now, the judge ruled that Norwegian, quote, has demonstrated that public health will be jeopardized if it is required to suspend its vaccination requirement. You can see shares under pressure a bit today, along with the rest of the reopening plays, like I said, off just around 0.8%. Adam?
Shauna, we're going to talk about infrastructure because if you have a bad case of insomnia tonight, nothing will cure it like talking about Congress and infrastructure, but there's movement going on there. Jessica Smith is our correspondent in Washington, D.C., and she can give us a trillion reasons why you want to pay attention to this one. Jessica?
Yeah, Adam, we are expecting final passage, a vote on final passage on this bipartisan infrastructure bill at some point tomorrow morning. They worked over the weekend trying to get this done. Senator Bill Hagerty delayed the process. He stopped them from fast tracking it over the weekend. And there has been quite a bit of debate about the cryptocurrency provisions in this bill. We've outlined kind of the problem that they were trying to address, these new requirements and for reporting to the IRS, who would be defined as a broker and would have to submit to these new requirements. Well, today, senators announced a bipartisan deal on those provisions. And Treasury is not going to oppose it, but at this point, it's not clear if it's actually going to make it in the final bill. Every senator would have to agree to it before the vote tomorrow. They may try to do this by unanimous consent, but again, they would need every senator. So we're watching to see what happens on that front, but they are planning on passing this bill at some point tomorrow morning. Guys.
And just after the infrastructure bill, of course, the attention is going to be on the budget resolution. We got a $3.5 trillion plan from Senate Democrats today. What's in it?
Yeah, this is mainly what we've been talking about. We kind of knew the big picture of what was coming here, and this confirmed it. This plan does have universal pre-K. It has 2 years of free community college. It extends the child tax credit. It has measures to fight climate change, expand Medicare and the ACA, paid leave, and much more. $3.5 trillion is the price tag, and how they're hoping to pay for it is by corporate and international tax reform. So raising taxes on corporations, also on the wealthy, increasing IRS tax enforcement. That is another measure they're going to use. And then they say healthcare savings and a carbon polluter import fee. Now, one thing that is not in this budget plan is anything to address the debt limit. As you know, Congress needs to raise or suspend the debt limit soon. And Republicans say that Democrats should do this all on their own. They should do it on through reconciliation, but Democrats are not planning on doing that at this point. So that sets up a fight this fall, trying to get 10 Republicans on board with taking action here.
Jessica Smith, thank you very much. We're going to be watching what happens overnight with that vote, at least in the Senate, on infrastructure. But also want to let you know, as we take a look at Bitcoin, that it is trading. Look at this. It's over $46,000 a coin. It's up 5% today with no end in sight. We're going to talk about what's going on in crypto, not just Bitcoin, with Jeffrey Wang from the Amber Group right after the break.
Just around 18 minutes to go until the closing bell. Let's take a look at where things stand. We have the Dow in the red, still off just around 91 points. S&P off just 2.5 points. They're not too far from the flat line. And NASDAQ, though, holding on to gains. In terms of what's driving today's momentum, some concern about the Delta variant. We're seeing that reflected in some of those reopening plays, some of those travel stocks which are taking a hit. Energy is among the worst performers here after crude fell just over 2%. And you're seeing some of the biggest decliners in the Dow today. It's no surprise that Chevron is among the worst performers, off just around 1.5%. Amgen, United Health, Visa, and IBM, the stocks surrounding out there, 5 worst performers in the Dow this afternoon. Let's talk about something, though, that's moving to the upside, and that's Bitcoin. If we can pull up a chart of Bitcoin, I should say, we are trading now above 46,000. It's the highest level that we've seen in Bitcoin in just about 3 months. So let's talk about this with Jeffrey Wang. He's the head of Americas at the Amber Group. And Jeff, we've cleared a couple of levels of resistance that we've talked about over the last several weeks. Where do we go from here?
Yeah, I think definitely the trend is up. The risk backdrop is pretty strong across other assets, so it's really helped buoy the crypto names. As of right now, I think the momentum is still higher. It's still kind of slow summer trading, but we have seen inflows. We have seen some names add to positions, more and more people coming and adding and buying, not just Bitcoin, Ethereum, some other altcoins. So right now the momentum is still to the upside.
When we talk about that momentum, I want to switch from Bitcoin and look at Ethereum. And I don't know if we can pull the chart up, but when you look at this, up 5% today, 3,000, about $3,161. When I'm looking at this, I'm trying to understand this upgrade they did recently, the London thing, and help us understand. Does this actually decrease the supply of Ethereum going forward towards some kind of, I don't know the right word to use here, but make it harder to get hold of this stuff?
Yeah, I think it addresses the fact that there was no limit to the number of Ethereum going forward. And while it doesn't put a set number on the total Ethereum, such as Bitcoin, similar to Bitcoin, it does address some of those issues, and it does address a lot of things that people were concerned about. So overall, the fact that it was such a seamless fork really helped with price action across the board. So I think really Ethereum, this is probably an Ethereum led rally, and Bitcoin's kind of followed. So we have seen a lot of people interested in talking about Ethereum and ERC20 tokens.
Jeffrey, let's talk about the infrastructure bill. We were just going through where things stand. One of the sticking points over the last couple of days has been crypto, and this all centers around, how to best word a provision in that bill that would require crypto brokers to report transactions to the IRS. There's been some pushback from many people in your industry saying that this could potentially be bad for cryptocurrency here going forward. What's your view, and what do you think needs to be done?
Yeah, I think the pushback has been valid. I think this is something to address, financial operators in the space, and really it's kind of touched much further than that. So, the people that the industry has pushed back on is miners, validators, software developers, which I don't think, the crux of the bill was really aimed at them, but they've kind of been caught up in it. So I do like, the amendment that's been put forward by Tomi and some of the bipartisan senators, and hope that, ultimately we're going to have a practical and palatable solution for both sides, for both the lawmakers and the people in the industry.
So where do you fall on the side of Mr. Gensler? Do you think yes or no? Because there seems to be mixed opinion as to whether or not the fact he understands it is great, but it may not be to the liking of people who actually live in this space and transact in this asset.
Yeah, I think, regulation is obviously one of the big overhangs in the crypto industry. And the fact that, these are being addressed more head on now, I think is great. Obviously, there's going to be discourse and discussion on what exactly are the best steps forward. But overall, I really encourage regulation, and I encourage a level playing field for everyone. So, I think, this is not really the be all and end all, as financial regulation and financial kind of scrutiny is kind of a fluid thing that changes with market as the market adapts. But overall, I really welcome regulation in a practical way.
But it actually could be good then for the industry. So some of this fear around regulation, the fact that maybe we could see prices take a hit as a result, maybe that those fears are a little bit overdone?
I think so. Yeah, I think so. I think the fact that people are investing in crypto is not because they can get around taxes or not have to report, but because they believe in the medium to long-term success of it as an asset. So, Yeah, I think, generally, obviously, financial markets don't like uncertainty, and the less uncertainty we have in crypto, the better. So if we can have, a path to black and white black and white rules on legislation for crypto firms, I think that would be actually very, very positive.
Hey, real quick, wouldn't allowing ETFs democratize this asset? Wouldn't it be helpful to people like us, who are average investors, to speed that process up? I realize that people want regulation, but you can do both at the same time.
Yeah, I think so. I think so. You can already get, exposure to Bitcoin via listed entities, either through futures or trusts. And, I'm based in Canada, and Canada does already have a listed ETF. So I think the more products that you can have that are regulated, that have investor protections, the better.
Jeffrey, what do you make of the fact that there are certain celebrities or certain well-known investors, certain chief executives who have such a emphasis or have really driven the price of not only Bitcoin, but a number of cryptocurrencies in the past couple of months? I guess from your perspective, someone that's in this industry, is that frustrating, or do you welcome that type of behavior?
Yeah, I think kind of, as you touched on, it's kind of a double-edged sword. As generally, they are bullish, and we've had bullish comments, but, on the occasions that they have negative things to say, the price obviously takes a massive hit. And I think ultimately, at this stage of the asset, we do need kind of spokespeople and influencers that help get more of the word out. So, at this time, I think it's still okay in the market.
All right, Jeffrey. Well, it's great to speak with you. We really appreciate you taking the time to join us here. Jeffrey Wang, head of Americas at the Amber Group. Let's take a look at where things stand, because we just have around 10 minutes to go until the closing bell. We're not seeing too much movement, although the Dow taking another leg lower here in the final couple of minutes of trading. It's now off 111 points. The biggest laggards in the Dow: Chevron, Amgen, and United Health. The S&P off just around 0.1%. The NASDAQ, though, is holding on to gains, up just around 0.2%. That's a 26% or 26-point jump, I should say, here for the NASDAQ today. We'll be right back from the floor of the New York Stock Exchange.
little under 7 minutes to the closing bell, and as we head to the New York Stock Exchange, the cheering you are hearing is for 2 Olympic gold medalists. Jared, from the women's volleyball team. What's going on with the markets? Let's get to the cheering as well.
You bet. We're going to hear some cheering in about 6 minutes here. So the NASDAQ is the only leader today. It's up 25 basis points, not a huge move, but you look inside the market, it's pretty interesting to see who the leaders there were. You have Moderna, so that's one of the big leaders. They're up over almost 40% over the last 5 days. We were talking about the vaccine stocks, Novavax doing nicely as well, but also the China stocks. I think these stocks are getting just a dead cat bounce. They've been under the weather for months now as Chinese authorities attack the regulatory structure or attack them under antitrust concerns, gaming concerns, all kinds of concerns, but also seeing some weakness in the travel sector today. We're going to want to monitor that for the status of the reopening trade. We were talking about the move in the dollar and the move down in WTI crude before. Want to keep an eye on that. Energy, one of the underperformers today, but really it's been about tech. Anytime we see the 10-year T-note yield go up, it's usually not been about tech. So a little bit of a reversal today from the norm, but it is Monday in the summer in August, and we got to take that with a grain of salt. I think we'll have much more clarity heading into tomorrow morning during the key reversal period of 1 hour, within 1 hour of trading of the opening bell, guys.
All right, Jared, we're going to get that opening bell with an extra plus today. It's going to be rung, the closing bell rather. April Ross and Alex Kleinman, they are gold medal Olympians from the U.S. women's volleyball team. We'll have that for you right after the break. All right, we have got roughly 2 minutes till the closing bell, and helping us go there are Elise Austin-Baugh. She is JPM's Private Bank Global Market Strategist, as well as Samir Salmana, Wells Fargo Investment Institute Senior Global Market Strategist. Samir, let's start with you. We're past the jobs report on Friday, and it helped reinforce your belief that the labor market's going to do pretty well, 4.7% unemployment rate by 2021. Is this going to be one of the things that drives these markets perhaps higher, the the tight labor market and the fact that companies are still positive to earnings when we talk, what is it, 80% posting beats on the S&P 500?
Yeah, I mean, if you think back to pre-COVID, really it was a consumer that was powering us higher year after year. And at least right now, with earnings continuing to be, coming ahead of expectations, we thought we were ahead of consensus at 200 for this year. And now consensus caught all the way up to us. And we're thinking about possibly raising our numbers. So, with earnings continue to be such a strong driver, with interest rates probably at levels that are still too low given where economic growth is, and much of that can probably be attributed to kind of the smoke screen that you see due to Delta cases starting to rise. We think that's a pretty powerful, potent mix for equity markets to go higher from here.
And we're going to keep an eye on that. We're going to take a quick pause as we get ready for that closing bell, because where we stand right now, you can see the Dow's probably going to end the day down 104 points, with the S&P 500 off by about 3 points. Some of the laggards, by the way, in the Dow today include McDonald's Corporation off by about 1%, Visa's down by about 1%, Chevron, the big laggard, as Shauna pointed out not too long ago, down almost 1.5%. Here is the closing bell.
And that does it for the trading day today. Let's take a look at where things closed. Dow in the red along with the S&P. You can see the Dow closing off just over 100 points. S&P off around 0.1%. The NASDAQ, though, holding on to gains up just around 24 points. In terms of the sector action that we were closely watching today, energy by far the underperformer here. The XLE closing off just over 1%. Some of the other laggards today, industrials, real estate, technology, among the hardest hit sectors. In terms of what was working in today's action, consumer staples closing up just around 0.3%. Financials and healthcare, those three sectors closing in the green today. But we want to bring back in our panel. We have Elise and we also have Samir joining the conversation. Elise, I guess, what's your big takeaway from the action that we saw today? Because clearly investors are a little bit spooked about the numbers that we're seeing from the Delta variant, what the rising cases could mean for the market going forward. How big of a headwind is it in your view?
So I think a lot of the fears around the Delta variant in particular are a bit overblown, to be quite frank. I mean, let's look at the United Kingdom as a case study. Even as we saw cases spike throughout the United Kingdom over the past couple of months, you saw hospitalizations and deaths remain relatively low, and that's going to be really important for the reopening narrative. In the United States, even hotspots like Florida and New Orleans, if you look at indicators like restaurant reservations, for example, you've barely seen those budge. So although I think investors are kind of grappling with the Delta variant and treating that as perhaps a primary brick in the so-called wall of worry, I don't think it's something that derails the longer-term view, because ultimately investors are going to stay focused on those super strong fundamentals like easy financial conditions, robust consumer demand, and also that labor market recovery that Samir was talking about before.
Elise, I don't want you to pick any one particular airline stock, but we had over 2.1 million people go through TSA yesterday. I mean, COVID-19 and this Delta variant have not put a damper on domestic demand, but they can't get back the airline stocks to the kind of profitability they had before the pandemic till international reopens, and Europe's considering perhaps new restrictions on American travelers. So what does this say for, travel industry as a whole on a trajectory of recovery? Are we going to push this back another year or 2 years?
I mean, whether we push it back a year or 2 years is anyone's guess. I am not an epidemiologist, so I don't want to make any, broad conjecture about the path of the virus. But, it might take some time for these airline stocks to recover, especially when you consider that businesses may be slower to return to travel in particular, which is a big source of demand for these airlines. So this could potentially be, a longer stall than we anticipated. But ultimately, regardless if it takes a year or 2 years, we do think that recovery is going to come back as life eventually returns to normal.
Samir, if we're still seeing some runway here to the upside for the markets, what are you favoring in this environment?
One of the things that's interesting is, markets tend to kind of focus on the disparity between expectations versus reality. And what's fascinating is if you look at a lot of the cyclical sectors, the reopening trade, so to speak, it's really back to levels on a relative price basis versus the S&P back to where it was in November of last year. So when you ask yourself what's discounted, at least right now, the market's almost acting as if the vaccine was never invented. And so from our standpoint, this is a mulligan, is what we've been telling investors, is this is another opportunity to position in financials, industrials, materials, and energy. We think those are the sectors that carry us forward. To Lisa's point, maybe it's not right away, but if you're an intermediate to long-term investor thinking 1, 2, 3 years out, that's where the opportunity is.
Also oil. We had a guest on last hour who said, look, it was at $75 was looking a bit pricey. Now it's down around 66, at least WTI, $66 a barrel. Is now the time, Samir, to be looking at oil as, maybe there was a mulligan and people should not discount the fact it's going to go higher?
Yeah, absolutely. I mean, one of the most interesting things right now is if you look at producers, if you look at rig counts, which come out every Friday, you're just not seeing U.S. producers go back to drilling the way they were. And you've got such discipline on the part of OPEC, who was able to reach a deal out to the end of next year. So if you've got all the producers showing discipline, focusing on returning capital to shareholders, we think that's a very powerful mix that could really be good for the energy sector, which has been underperforming for close to a decade now.
One trade that is getting a bump today is Bitcoin. We want to head back to Jared on the floor at the New York Stock Exchange. And Jared, we broke above 46,000, an area I know that you were closely watching. Just what's your big takeaway? And I guess what does this mean for Bitcoin going forward, do you think?
Very constructive price action over the weekend. It's been going up the last 2 weekends instead of going the wrong way. Had a little bit of a shakeout by 29,500, not too worried about that, but 45 to 47, really a big level here. It's looking good so far, but if we were to get a strong sell-off from these numbers, that would be a big short signal, probably heading back down to test 30,000. But in the meantime, as long as 40,000, maybe even 35 holds as support, really want 40,000 to hold as support, has the opportunity to head higher. It looks like all the bad news kind of priced out. Not sure what could actually push it down again in terms of a catalyst. Most of those factors looking bullish, but you never know. The governments anywhere around the world could restart their attack, and we'll have to see what that has an effect on, if that has an effect on price action. But in the short term, in an uptrend. Nice to see.
Jared, thank you. At least want to go back to the discussion about where these markets are headed, because I know a lot of people are going to pay attention to the Fed and to Jackson Hole and just getting through August. I mean, I was going to say an August slowdown, but we really haven't had. We had analysts going into the summer saying, get ready for a 10% pullback. We always pull back 10%, and then we come back. It just hasn't materialized. Doesn't look like it will either.
Well, we'll see, right? It is not unheard of, obviously, for the S&P 500 to experience these intra-year drawdowns, even in the midst of a bull market. You look at data since 1981, the average intra-year drawdown has been over 14%, but the average calendar year return has still been positive 75% of the time. I think going forward, what investors really need to be prepared for is to kind of shift this mentality, because we've been spoiled by the past year of, having the advantage of, so long as you were taking risk in markets and you were invested, you've enjoyed really strong gains. But when you consider all of the progress that the economic recovery has made, we are moving more, into mid-cycle. And although returns do still tend to be strong in mid-cycle, it calls for a more selective approach, and you've got to be more intentional about portfolio positioning.
Samir, I want to call attention just the action that we saw in some of those reopening plays today, and specifically the airlines, because American was off just around 2%, Delta was off 2%, United Airlines also off just around 2.5%. Are you seeing any reason to buy some of these names that are off pretty significantly from their 52-week highs? And I guess if so, what are you looking for just to determine which ones are attractive versus some of the others?
Sure. So we don't get up to the stock level, but we do like industrials. That's where a lot of the airlines kind of live, and we like consumer discretionary too, where we recommend kind of full weightings there. That's where a lot of the booking companies and travel companies are. We think, as you get past some of the, initial shock of Delta, being a newer variant and kind of having cases spike, once you get past the peak, what we think is, going into the seasonally strong kind of November, December, and so on type of time frame, we think a lot of those trades will probably come back faster than investors can jump on them. So if there is weakness in August, September, October, which historically have been weak, we would encourage investors to continue to focus on those cyclical sectors. Where you kind of lost catalysts is with rates being as low as they are, it's going to be much more difficult for technology to do well going forward. So we would say, at this point, trim growth and add to value and cyclicals.
And we appreciate the insights. Samir Samana is Wells Fargo Investment Institute Senior Global Market Strategist. Elise Ossenbaugh is JPM's Private Bank Global Market Strategist. Good to have both of you back here on Yahoo Finance Live. Also good to invite into the stream our Editor-in-Chief, Andy Serwer, because when Warren Buffett's buying back billions of dollars in stock, and they hadn't done that for a couple of years, as you pointed out in your most recent article, people need to pay attention. But Andy, they always have to pay attention when Warren Buffett's involved, right?
Yeah, he announced this quarter over the weekend, and I have to say, it's kind of a all systems go kind of a report. I mean, yeah, the empire did bounce back in that, operating revenue, operating earnings up 21%. Stock is up about 23% year to date, but that's to be expected because this is a representation of the U.S. economy. So you expect the performance of Berkshire to very much reflect that. And yes, Adam, to your point, he is buying back stock, which suggests, once again, that he's not seeing anything to do with that $140 billion plus cash trove on his balance sheet. The last big acquisition was Precision Castparts a few years ago, and he had to write down, there's the 140. There's 140. Wow. So, that's a lot of money. That's a lot of money. And the stock, by the way, today, the first trading after the announcement came up about 0.4%. There you go. So, and then with the market down a little bit. So you got about 50 basis points of outperformance today. And by the way, that's A. B actually outperforms A, and that's because retail investors can buy it more readily.
Hey, Andy, was there anything in here that just gave us a better read on just what Warren Buffett is thinking just in terms of where we are in this recovery? And I kind of reflect back on the conversation that we just having with our market panelists, and it seems like some of the fear maybe related to the Delta variant could potentially be overdone just in terms of the longer term impact it could have on the market. Was there anything within this report or within some of the action that Warren Buffett has taken over the last 3 months that we could kind of extrapolate from that and kind of tell us where we're headed going forward?
I think the takeaway was caution. He's cautious. I mean, he did say he didn't have any clarity going forward. He did not make any big moves. He bought back the stock, trimmed a position here or there. So you didn't see him, doing anything that would suggest that the market is either, wildly undervalued or wildly overvalued. And I think, just getting back to your point in the discussion you were having with the two previous guests, Sean, I mean, you could argue that we would look back at this time and it's like a perfect wall of work for the market, right? In other words, things are good, but you have this big honking thing to worry about, which is the Delta variant out there. And yet the market continues to go up, today mixed a little bit notwithstanding. But, that's kind of a classic narrative, right?
I am muted because they're doing renovations upstairs and the banging is intermittent. You would think we're part of an infrastructure bill. Andy Serwer, thank you very much for joining us. It's what happens when you live in a New York City apartment building.
I look like
when
Dan
we come
Howley.
back, we're going to... You're in the Maine woods, Andy. I don't think they're doing any renovations at the cottage.
No.
When we come back, we're going to be looking at global warming and the fears of what's coming down the pike with Rick Newman.
An alarming report from the UN on climate change, delivering a pretty stark warning just on the current situation right now. And they actually called it a, quote, code red for humanity. So we want to bring in Rick Newman for a little bit more on this. And Rick, I guess my big takeaway is if this report doesn't get people's attention and it doesn't make people take climate change seriously, I don't know what will.
I think you're right about that. So what this report basically said is we are going to hit that that limit of we're going to have a 1.5 degrees Celsius increase in global temperatures, that's coming regardless of anything anybody does for the next several years. And that probably will happen by about 2030, less than 10 years from now. That not so long ago, that seemed like something that was far off in the future and we could worry about it later. And I think what this report is telling us is we now need to address this ASAP. So this does actually dovetail with some of the things President Biden wants to do. He's got big plans to address these problems through getting the electrical grid over to non-carbon by the year 2050. He just came out last week and said he wants half of all new cars sold by the year 2030 to be electrics. This all sounds a little bit easier than it is. These are actually large and very difficult technical barriers. Of course, it takes a lot of money. Biden's going to be asking Congress for trillions of dollars to get this done, and he probably won't get all of that. So Biden wants to do what the report says we need to do, but it's far from unclear that's actually going to happen.
Politics, I mean, I could see perhaps some people saying, look, if we've already lost the battle, why make changes? I know that sounds ridiculous because inevitably you've got to change things. But when you talk about the difficulties the Biden administration will have pushing through its agenda, you know that wall of no, not yet is going to be up there.
We haven't lost the battle yet, Adam. I mean, we can survive on a warmer planet. I think the question is it 2 degrees? Let's talk in Fahrenheit here. Is it 3 degrees warmer, which is roughly equivalent to 1.5 degrees Celsius? Is it 3 degrees warmer, or is it 6 degrees warmer, or it could go as high as 10 degrees Fahrenheit warmer by the end of this century? And every time you increase the range of possible temperature increases, we're talking more flooding, more severe weather, more wildfires, more drought. Certainly higher sea levels. So the question is, how difficult do we want to make this on ourselves? If there's anything that you might consider encouraging from not just from this report, but from the whole series of reports that this UN panel has been putting out since the 1990s. I mean, there is basically mainstream acceptance at this point that this is a problem. We're no longer hearing the majority of the Republican Party, for example, say this is fake science. There is a recognition that this is a real thing. It's causing real problems in real communities. I think one of the big issues is jobs. I mean, if you transform the economy away from carbon and you get into many of these renewables, we've had Gina McCarthy, Biden's top climate advisor, on our programs before talking about this. You're going to lose jobs in carbon, and you have to figure out how to replace those jobs with new jobs in renewable energies in the same place and at the same pay levels and it's in the same numbers as the ones that are going away. So I think that's the nub of the political difficulty here, and we'll see whether Biden can push this forward.
We certainly will see, and something that we all will be watching closely. Rick Newman, thanks so much. We want to get to some breaking news that we have. AMC is out with its earnings results. Ines Ferre has that for us. Ines?
And Shauna, it's a beat on the top and the bottom line, with AMC reporting second quarter revenue coming in at $444 million. That's over an estimate of $382 million. So that's a beat. Also, it's adjusted loss per share coming in at 71 cents. The street was expecting a loss per share of 93 cents. Consolidated attendance was 22.1 million for the second quarter, compared to 100,000 year over year. Of course, last year, second quarter, the country was on lockdown. The street will be paying attention to how this recovery is going for the movie theaters. Of course, with the Delta variant, paying attention to any guidance about the Delta variants with respect to where we go from here for movie goers. But this stock really, Shauna, has been trading. It's a meme stock. It has been trading unlinked from fundamentals, from where the street has a price target. Street has a price target of less than $6 $34 per share on this stock. Today, it closed above $33 a share, Shauna.
Certainly a disconnect there. Ines Ferre, thanks so much. And certainly a name that I think many of our viewers are going to keep in mind as we turn our focus to tomorrow's opening bell. Well, coming up next, a new data out showing that some spending trends when it comes to entertainment, when it comes to travel, is slowing down a bit because of the Delta variant. We are going to speak with Jesse Edgerton. He's JP Morgan, the economist, just about what this could mean for the recovery going forward. We're back with that in just 2 minutes.
News on the move. New York Governor Andrew Cuomo's top aide called it quits late last night. Melissa DeRosa resigned less than a week after the report from the state attorney general that concluded Cuomo sexually harassed 11 women. 2/3 of the state assembly say they favor impeaching Cuomo if he refuses to resign, and a majority of New York state senators have called for him to step down. Scientists from a private not-for-profit lab are asking the FDA to prohibit the sale of sunscreens which contain the ingredient octocrylene. About 2,400 sun-protecting products are made with it, but the lab says the sunscreens may contain a suspected carcinogen that could interfere with human hormones and reproductive organs. Bloomberg reports a trade group calls the lab's report misleading. New WideTech is recalling 2 million dehumidifiers in the United States. The Consumer Product Safety Commission says the dehumidifiers can overheat and catch fire. The recall includes almost 400,000 dehumidifiers sold in Canada. The company says it is aware of 107 incidents that caused $17 million in property damage, but fortunately nobody, I want to repeat, nobody was injured. Let's turn our attention back to what's going on in the travel sector, because as we pointed out earlier in the hour, there was something like 2.1 million people who traveled through the nation's airport security through TSA just yesterday. Now, in a normal year, that would be 2.6 million. But without business travel, you can see we have pretty much recovered, at least when it comes to leisure and domestic. But there's much more going on, so we invite into the stream Jesse Edgerton, senior economist at JP Morgan. It's good to have you here. And we can talk about what's going on with, the different stock values of, for instance, airlines, which won't recover, as we've already pointed out, till you get international back. But you have access to data which shows us where people are spending money. And what is it telling you about our desire to travel and then the reality of what we're doing?
Well, it looks like it's flagging a little bit in response to the Delta variant. So we can see spending on a panel of about 30 million Chase-branded debit and credit cards from across the U.S. And in the last couple of weeks, we've started to see a little bit of pullback in some of the travel and entertainment type categories, and really with the most noticeable pullback in spending on airlines. So there's actually been a pretty noticeable drop of 10 to 20%, depending on how you measure it, in spending on airline tickets in this sample of Chase cards.
Jesse, how does this compare to the data that we saw during previous waves?
Well, I mean, it's still a small decline compared to the absolute collapse, essentially to zero, that happened during the very first COVID wave back in March and April of last year. But then if you look at where we were in the summer wave last year, summer 2020, we hadn't bounced back very far. So airline travel spending was still at a pretty low level, and we didn't get much of a decline. But now that we're at a higher level and people are starting to travel again, to some extent, it looks like they're pulling back more than they did when they were still at very low levels last year.
Is it a definite because of Delta variant of COVID? Because obviously the airlines are saying that they don't see this. Or is there some other factor? Is it uncertainty about the economy? Or people just worried in general? Or is it pretty much, nope, this is the Delta variant?
Well, I mean, we don't really see any more detail on the data. We just kind of see the total spending numbers are down. Like I said, we've only seen kind of a hint of a decline in some of the other T&E categories like restaurant spending and lodging. Those have been rebounding, right, for most of the last year here, kind of steadily moving up. They've at least stopped moving up in the last couple of weeks and maybe, started to dip down just a little bit. But, definitely the thing that stands out in the Chase data is the larger dip in the airline numbers.
Jesse, is it enough of a drop for you to change your projections just in terms of when you're expecting the economy to recover, or is it still a little bit too early to tell on that front?
Well, I mean, at this point, it is pretty concentrated in travel and entertainment and specifically in airlines. I mean, I guess we can also see some kind of slowing in some of the other high frequency data, like the airport traveler numbers from the TSA that you referenced earlier, or open table diners. These things are more like slowing down and kind of flattening out rather than outright falling. But that does suggest, I think, that we're getting a little deceleration here that probably will show up in the aggregate economic data. So, we might see kind of a slowdown in payroll growth. We might get a disappointing number for retail sales in July reported pretty soon here, right? So I think there is a good chance we'll get, this will be noticeable in the macroeconomic data, but it's not going to derail the recovery based on what we're seeing so far.
Do you think we could see, I mean, we always talk about things that get pent up. If people are pulling back a bit, could we get a second wave of pent up demand, especially with the Thanksgiving and perhaps Christmas holiday travel?
Possibly. And I do think we're still hopeful that this will be relatively short-lived. We're not epidemiologists, but if you look at the example of the UK, where it was just a couple of weeks ago that cases looked like they were going straight up, and then they very rapidly turned the corner and started falling again. So, we're kind of hoping that something like that will play out in the US, where I do think we're going to get a very large continued increase in cases, at least over the next few weeks here, probably through the end of August. But looking at the UK experience, that might be around the time when things would start turning back down. So I'm hopeful that if we do get this kind of large but short virus wave, then it won't be much more of a little detour on the overall recovery here.
Jesse, one encouraging data point that we did get out over the last couple of days is that jobs report that we got on Friday beat expectations Of course, people, though, were pointing to the labor force participation rate, and that, of course, is still significantly lower than what it was pre-pandemic levels. I guess, how did you look, or how are you looking at Friday's number, and what are your expectations just in terms of a recovery in the labor market going forward?
I do think last week's report was encouraging. I was boosted a little bit by this kind of funny seasonal adjustment issue in the education sector. But even looking through that, the private job gain of 700,000 was better than we expected and was solid overall. So I do think it was a good report. Did show labor force participation continuing to move up for prime-aged workers, that is 25 to 54-year-olds. You know, the participation rates among older workers have been kind of stuck at low levels, maybe some early retirements there. But, you know, overall, I think that the picture coming out of that report was quite positive. I would caution again, though, that was referring to the reference week, which was earlier in July. And I think these higher frequency numbers that I've just been talking about signal that there's been some slowing since then. So, you know, I do think we had some good momentum going there. It's probably going to take a little dent from the Delta variant here, but, you know, I hope we can kind of get back on that strong upward trajectory after maybe a month or two of detour here.
Jesse Edgerton is a JP Morgan senior economist. Thank you so much for joining us. When we come back, we're going to be talking about the concern parents, teachers, all kinds of people have for students as they head back to the classroom. We're going to do that with a man who knows the classroom well. Our correspondent, Reggie Wade, is a teacher, and he's going to bring us up to speed right after the commercial break.
It's mid-August, so that means back to school for millions of students over the next couple of weeks across the country. But of course, as the Delta variant, the number of cases continue to rise. I think some parents and some students are wondering what's safe and what they should do as we enter the new school year. So we want to bring in Reggie Wade, who has been on this story for us. And Reggie, you recently spoke with a group of high school students, actually, who are preparing to go back to the classroom this fall. What did you hear from them?
That's right, Sean. I went to White Plains High School in White Plains, New York, and we spoke about what it's like going to school during a pandemic. And when I asked the kids about virtual learning, they actually had some pretty interesting takes. Take a look.
Show of hands, how many of you guys enjoyed virtual learning? I see none. Why not?
It was just really hard for me. You know, for me to do well, I have to have connection with my teacher. I have to be friends with them, we talk to them. And when I came back to school, that's exactly what I did. The first day of school, I made friends with my teachers, and my grades went up literally the first week.
I have to agree with him. It's hard for me to do work in my house because there's so much other things I can do in my own household. But at school, you're sitting there in a classroom for like 40 minutes. So you have to do that one thing. But at my house, you can do whatever you want. So it was like really hard to focus on school.
I agree with what they say. So for me, like online learning was also really difficult because like you also had like a lot of other things to do. And the thing for me was that you would procrastinate, you would say, I'll do this later, and you would keep going and going. And then at the end of the day, you wouldn't have time to like do all the work you had to do. Instead, when you're here in school, like you're always in contact with the teacher. If you have any question, you can ask right away. And if you like need clarification on one thing, they could give it to you while we were doing it online. It'll be more like as a whole class. So she wouldn't really like, or the teacher wouldn't really be focused on you for a little while.
Yes, some pretty valid criticisms of virtual learning from our panel of students. And it was more than just, I couldn't see my friends. These kids actually cared about their academic well-being. You hear them say that they really couldn't connect with their teachers, and they were concerned about distractions in their home, really not doing well for their schoolwork. So very, very interesting talk with these 6 kids.
There are a few people who could have that talk as skillfully or as well as you, Reggie, because people may not realize this, but you were a teacher in the school system prior to coming to Yahoo. So I'm curious, your own observations, the friends of yours who may still be teachers, what are the biggest concerns, whether it be the kids or even teachers, about the upcoming school year? How about the kids? What are their biggest concerns?
Adam, their biggest concern is whether or not they're going to start and finish the school year uninterrupted. One of the students brought up the fact that last year, seniors at White Plain High School had to forego the prom and an in-person graduation ceremony. And one of their biggest hopes is that they wouldn't have to miss out on that. That's a rite of passage. And that was one of their biggest concerns. But you're right. I was a teacher many years ago, and I still have many teacher friends, and that's their biggest concern. If another lockdown happens, what is it going to do to the students, not just academically, but emotionally, to be shut down again?
Well, Reggie Reed, we are looking forward to exploring a little bit more on this topic because you have a special that is set to air tomorrow, Road to Recovery, Back in the Classroom. You're hosting it. We will air it tomorrow at 4:30 p.m. Eastern Time, and I think we're all looking forward to learning a little bit more about what these students have been going through over the past year and a half, and of course, the plans here going forward as we do enter the new school year. Well, let's talk about the restaurant space because another big story that we are tracking, Panera Bread, it's merging with Einstein Bagels, also with Caribou Coffee, creating Panera Brands. Now, in today's Best of Yahoo Finance, we spoke with Panera CEO Niran Chowdhury about this formation of Panera Brands and also some of the trends that he's seeing within the sector. Let's take a listen to what he had to say.
The trajectory has been very strong. And as you mentioned, I think as a result of the macroeconomic conditions like stimulus payments, vaccinations, and a general desire for consumers to get back to the life as they once knew it, coupled with some of the pivots we made as brands through the pandemic, more off-premise, more digitally focused, and rapid-fire innovation, we are seeing a tremendous recovery across all 3 brands this year. And in fact, the momentum is building week on week. So we're feeling very good about where we are and how things look going forward.
Take us through why you're bringing all these brands together under one roof. Are they going to share rewards programs? Are they pulling from the same food suppliers? How are you thinking about it?
Yeah, I think so. It's a very exciting development. If you think about it, this creates one of the world's largest fast casual restaurant brands with 4,000 stores across 10 countries, 115,000 employees. So, much larger in scale. And I believe we can be stronger together and we can grow faster. So the real reason to do this is to leverage the competencies that we have such as our digital ecosystem, our omni-channel network, our supply chain, as you mentioned, our innovation strength, and also the capability of franchisees that we have at Panera Bread, and that we can leverage these assets across all three brands to grow much faster. That really is the intent.
It's also a pretty easy way to tell Wall Street a story. Do you have any timeline on when you might become a public company again?
Well, as you can imagine, we are always thinking about various options all the time, but at this point in time, we have not really made a specific decision on when exactly that might happen or if it's going to happen.
It's Julie here. I have a little bit further questions on bringing the three brands together. Do you expect to have cross-selling? Are you going to have Caribou Coffee in Panera Bread, for example? Are you going to sell Einstein Bagels in a Panera, for example, or in a Caribou? How is that all going to work?
So I think the way to think about this is that we believe that these are three iconic brands with the unique roles in the lives of our customers. So we're going to be very focused and dedicated at ensuring the independence of these brands and make them the best version of themselves, respectively for our consumers, whilst leveraging the back end to really turbocharge growth across all three brands. But so I don't really see any cross-selling, et cetera, happening. We just want to delight our customers who are looking for those specific value propositions across each one of those individual brands. I think the good thing is that these three brands are very complementary. So Panera leads on lunch, Caribou Coffee leads on coffee, and Einstein Bagels leads on breakfast. So they're very complementary, synergistic, and we plan to grow them faster by leveraging our unique competencies at the back end.
Yeah, Naren, I was thinking about the different day parts, as you guys will call them, that they fit into, and it seemed to me as a portfolio of, if anything, maybe skewed slightly more towards the morning hours with the coffee and the bagels together. And I'm curious how you guys have seen that part of the business. We hear from a lot of competitors in the fast casual space that they're all very interested in breakfast. They want to make more breakfast investments, but certainly with these three already have a strong foothold there. How have you seen that specific day part as a growth area?
So I think the pandemic has been transformational in the way in which consumers are accessing brands, as you can imagine. And interestingly, lunch has had headwinds. Even breakfast has not been that strong as it was before. The day part that has really exploded has been the dinner evening day part for families at home, working from home, and the weekend day part, interestingly. So therefore, over the last year or so, we have not only protected and strengthened our breakfast and lunch day parts, we have gone very aggressively for evening, end of the day family meal solutions. At Panera Bread, we launched the flatbread pizza, and we launched warm bowls as a meal solution for families for the evening day part or for the weekend. And we partnered very quickly with third-party aggregators so our consumers could access our offerings for that additional day part is the evening day part. So I would think that probably Panera Brands is a unique combination of brands that have relevance across all three day parts, not only breakfast and lunch, as you mentioned, but we are seeing tremendous tailwind and growth in the evening day part as well.
When your parent company purchased Caribou in December 2012, it had about 610 stores at the time of the deal. Now, about 713 or so. Why hasn't growth there been faster in terms of store base? And is that chain profitable?
That chain is profitable. In fact, all of our three brands, the brands are strong, the model is profitable. And I think coming through the pandemic, we have actually become even stronger, all three brands. The brands are stronger, the model is stronger. We're looking at asset-light models go forward across all three brands to accelerate growth even faster. So these are smaller box stores with fewer seats, more off-premise orientated, more digitally fired up, so that we can really serve our customers in the best possible way as they emerge with these fundamental changes in the way in which they're accessing these brands. So yes, all three brands are profitable. They're doing extremely well. And I expect that with this creation of the platform, the growth of both Caribou and Einstein Bagels will be much faster than it may have been before.
I believe I went to a Panera last week, and it, like many other fast casual chains, had a hiring sign. What have you guys been doing in terms of wages? Have you been raising wages? Have you been having trouble finding people?
Yeah, that's a real challenge out there. It's very hard to find workers, as you know, impacting not only our cafes, but also our supply chain. They're also facing the same challenges. So just to give you a sense of how large that challenge is, we've had to hire 10 to 12,000 people in the last 2 months. Now, we've successfully been able to do that, but it continues to be an uphill task. And then also you want to hold on to the employees that you're hiring. So yes, we have moved very quickly on relooking at our entire value proposition for our associates, be that wages. So wages range up to $15, depending on where you are in the country, free meals, additional benefits, career progression, clear career paths for our associates. So it's centering our value proposition. And fortunately, I think our brands are very well regarded by employees as being great places to work. So we are able to find them, but it is hard. I'm actually thinking that maybe this is a short-term friction between demand and supply, and hopefully things should settle down over the next few months.
That was Niran Chowdhury, the CEO of Panera. Coming up next, one company that's helping travelers who test positive for COVID fly home faster, and they're obviously doing this legally. We are going to talk all about this with Ross Thompson. He's Kovac Global founder and CEO. He'll join us right after the break.
We want to invite into this stream the founder and CEO of the company Kovac Global. Ross Thompson founded this company, and they're doing something. There are lots of companies out there that if you happen to be traveling and something goes wrong and you're in a global hotspot, they evacuate you. This company does that if you've got COVID. So tell us more about this and where you're seeing, I know you can't reveal some of your clients, but where you're seeing growth. And I just know from my experience with network news that the networks have hired companies like this for years when they send people into war zones to help evacuate them when necessary. Is that kind of what you're doing?
Yeah, so we have decades of experience with crisis response and evacuating people and rescue. And actually, when the pandemic hit, we ran a global company that responded to kidnap and ransom events. And so we had offices in Florida, Mexico City, London. And when the pandemic hit, we realized that if I travel or one of my guys travel around the world and we get COVID and we get sick, then are we beholden to a local hospital, Medicare system, healthcare system, quarantine? And so we actually looked for an off-the-shelf solution, and none of it existed. So what we did is we took our expertise in crisis response and getting people home in really bad situations, and we took our relationship with the London insurance market, and we came up with Kovac Global. and it's been going strong ever since.
Have you seen a rise just in terms of the number of people that are trying to use this because of the numbers that we're seeing from the Delta variant over the last couple of weeks?
Sure. So this year alone, we've had thousands upon thousands of new members. You're absolutely right. There's been a big spike in the past couple of months with the Delta variant coming out, and really throwing us for a loop. We thought there was a recovery coming, but now it looks like the pandemic is going to be here to stay. Reuters came out with an article today saying the Delta variant could be the most contagious, infectious virus in history. CNBC said the pandemic is far from over. So we're really focusing on the pandemic. Our in-house medical teams are really focused on the variants, how they're evolving, how they're affecting our members, travelers. Obviously, we're seeing vaccinated people overseas testing positive and getting sick.
How do you protect your staff that might use a private aircraft to go pick someone up who's got COVID and bring them back to the United States? And what kind of regulatory protocols do you have to follow once you get here?
Sure. So all of our medical transports are done via air medical transport, so air ambulances. So converted Learjets or Falcons or Hawkers. We even use helicopters. We've even had to use speedboats to get our members from overwater villas in the Maldives to airports where they can meet our air ambulances and our crews. All of our flights are done not only with our expert pilots, but there's critical care paramedics, there's doctors on board. It's all overseen by our global physicians. And so the transport itself is very complex. For instance, we did a transport from Ethiopia back to Washington, D.C. the other week. And not only did we have to coordinate with the Ethiopian authorities, but we had to coordinate with the Egyptians and the Sudanese for overflight permits. So again, it takes a lot. This still is a contagious disease, landing, refueling our complex, and then obviously working closely with the CDC, State Department, Department of Homeland Security, Customs and Border Protection. Those are all key. Our staff comes from a myriad of backgrounds, including federal law enforcement, the intelligence community, military special operations. Again, we have a full in-house medical team. The medical director is actually a former colonel. So again, it takes relationships, it takes expertise, and we have a team that just does that flawlessly. For the hard stuff, we do weekly evacs from Bahamas back to New York, Chicago. Again, great relationship there with the Ministry of Health and Tourism there in the Bahamas. So again, relationships, expertise are critical to this business, and naturally, it's something that we work hard at every day.
Ross, who is this available to, and how much does it cost?
So it's available to everybody. So all nationalities, residents of all countries can become members of COVAC Global. The 15-day COVID-19 repatriation membership starts at $675 for a 15-day trip. We have a 30-day trip. We have an annual membership for $2,400, and that covers you if you get COVID overseas or if you get COVID more than 300 miles from your home. So we will do everything it takes up to $1 million to bring you home. And so that's the COVID membership. But we also have a traditional medical membership. We've taken the successes and the lessons we've learned from our COVID membership, which does not require hospitalization, I might add. So every other company in the world requires hospitalization. We do not. So we took that methodology and that way of doing things into the traditional medical as well. Whereas if you have a car accident, heart attack, slip and fall overseas, we want to get you home to your own doctors and your own hospitals as soon as possible. We have a security membership that will step in if there's any personal security emergency you're experiencing, war, terrorism, natural disaster. We see the wildfires in Greece right now. People are getting evacuated. We saw that in South Africa with the civil unrest, the riots, where we had members on safari that were being affected by that, and we'll get them home for that as well.
$675 seems like an incredible bargain for people who want to avoid any kind of risk. We appreciate your being here and wish you all of the best. Ross Thompson, COVAC Global founder and CEO. When we come back, there's breaking news about that compromise over cryptocurrencies and regulation that would have been in the infrastructure bill. It's not going to be there. Jessica Smith will update us right after the break.
Good new developments out of DC on the crypto amendment for the infrastructure bill. Jessica Smith has that for us. Jess.
Yeah, Shauna, it looks like the original version, this original cryptocurrency measure that was included in that infrastructure bill, is what's going to end up in the final legislation, at least at this point. The Senate did just try and pass that amendment that was announced earlier today, that compromise between Senator Portman, Senator Warner, and a few others, but it did not pass. Ultimately, Senator Richard Shelby wanted to get more defense spending in the bill, and other senators objected to that. So they could not get all 100 senators on board with this, which is what they needed in order to get it done before they actually voted on this legislation, the full bipartisan infrastructure deal, at some point tomorrow morning. So this is a loss for the industry, which had argued that the original language would be devastating for the space. And it now appears that is what is going to end up in the final version of the bill, unless something changes in the next few hours. Senator Toomey, who had been advocating for this amendment, did tell reporters just a few minutes ago that they are still figuring out their next steps. So we'll keep you updated on this one, guys.
Certainly will. We'll have to watch the price of some of these cryptocurrencies, namely Bitcoin. All right, Jessica Smith, thanks so much. And of course, Jess will be on that story for us tomorrow. That does it for us today on Yahoo Finance. Thanks so much for watching. We'll see you back here again tomorrow morning. Have a great night.